हमें ये ध्यान रखना चाहिए कि स्टॉक टिप्स, गलत वादों के छलावे में हम ना आए। नेशनल स्टॉक एक्सचेंज कहता है कि खुद सोचकर समझकर इन्वेस्ट करें। धन्यवाद। क्वारियन एक देवियों सज्जनों, नेशनल स्टॉक एक्सचेंज की तरफ से एक ज़रूरी सूचना मैं कहना चाहूँगा। देखिए, अपने पैसे निवेश करते वक्त हमें ये ध्यान रखना चाहिए कि स्टॉक टिप्स, गलत वादों के छलावे में हम ना आए। नेशनल स्टॉक एक्सचेंज कहता है कि खुद सोचकर समझकर इन्वेस्ट करें। धन्यवाद। क्वारियन एक जाने से पहले एक सूचना आपको हम बताना चाहेंगे। आशा करेंगे कि ये धनराशि का कुछ हिस्सा जो है ये अच्छे फाइनेंशियल इंस्ट्रूमेंट्स में ये निवेश करेंगे और गलत वादों के छलावे में ये ना आए, क्योंकि नेशनल स्टॉक एक्सचेंज कहता है कि खुद जांच करके सोचकर समझकर इन्वेस्ट करें। ओके। देवेंद्र सर, हम आशा करेंगे कि
Hello. I request everybody to please be seated because we'll start in a couple of minutes. So kindly take your seats. Good morning, ladies and gentlemen, and a very warm welcome to the IIM-NSE second annual conference on macroeconomics, banking, and finance. It is an honor to stand before you today as we embark on a day filled with thought-provoking discussions, insightful deliberations, and meaningful networking. To mark the beginning of this significant event, let us all rise for the Indian national anthem.
अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल गंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you. To formally inaugurate the conference, we will now proceed with the traditional lamp lighting ceremony symbolizing knowledge, wisdom, and prosperity. I would like to invite our esteemed speakers of the inaugural session, Shri M. Rajeshwar Rao, Professor Debashish Chatterjee, and Shri Ram Krishnan to please light the lamp. I would also like to invite Professor Mridul Sagar and Dr. Dithankar Patnaik, who are the ideators of this conference, to please come on the stage. Sir, I would also, Sir, MD Sir, could we have you on the stage also, please? With the conference now officially inaugurated, I would request Professor Mridul Sagar to give a brief introduction about the conference and Urupika.
Well, maybe I'll just take a minute So the idea of the conference is extremely important. I mean, we all know economic growth depends on ideas, and Paul Romer got a Nobel Prize essentially on that count, that it's the ideas which derive the long-run economic growth. The idea of Urupika, the Center for Macroeconomics, Banking and Finance at the Indian Institute of Management, Kozhikode, came actually from Professor Debashish Chatterjee sitting here. And he asked me that can we set up a center, and we did set up with my colleagues sitting here, Arvind, Rudro, Abhilash, and Ashok. So there were a few others who are not here. And we named it after Urupika, which was the early coins of Samudri Kingdom, which preceded the Indian rupee. So this conference idea came essentially when I was sitting with Tirthankar Patnaik here, and we said we want to host a conference, and he said, let's do it together. And we decided to do it together. Last time I spoke to Anant Nageshwaran, Kamath, and Dinesh Khara, all of who readily agreed that they will come and speak at this conference, and that's why this level of conference has been set high after the first conference. The conference this time, the idea sprang in London over a cup of tea with basically leading French economist who is a co-author of Esimologu, who is a Nobel laureate last year. And he sort of said, his research is telling that the total factor productivity growth out of the disruptions we are going to see on digital technology would be 0.71% a year. And his co-author said it will be he said over a 10-year period, and his co-author said 0.68% over a year. So the diametrically 10 times difference was there over what this technology will do to growth. And imminently, I thought we should learn more about it, and we should do this conference on this theme. And that's how we're here today, and we will have a talk really around this time. So over to you, and maybe we'll request.
Thank you, sir. May I request Sri Ram Krishnan, Chief Business Development Officer of NSE, to extend a warm welcome to our distinguished speakers and the participants with a few remarks.
Respected Shri M. Rajeshwar Rao, Deputy Governor RBI, Shri Debashish Chatterjee, Director IIMK-NSE, Shri Ashish Chauhan, our MD and CEO, Shri Mridul Sagar, Professor of Economics, IIMK-NSE, Shri Debadatt Chand, MD and CEO, Bank of Baroda, Shri Rajneesh Karnatak, MD and CEO, Bank of India, distinguished faculty members, other dignitaries, esteemed speakers, ladies and gentlemen. It is with immense pleasure that I extend a warm welcome to each of you to the IIM-NSE second annual conference on macroeconomics, banking and finance. It is an honor to host such a distinguished gathering here at NSE, and I'd like to express our heartfelt gratitude to IIM-NSE for collaborating with NSE on this important event. This year, our theme, Finance for Growth Amid Creative Disruptions, couldn't be more timely. As the global economy continues to evolve, the importance of understanding how finance can drive growth amidst disruptive forces, whether technological, economical, or social, becomes increasingly paramount. This conference promises to offer insightful discussions on how our financial systems can adapt, evolve, and remain resilient in the face of changes. India's economic journey is an inspiring one. From being the 10th largest economy in 2014, India today is the sixth largest economy of the world with a GDP of 324 lakh crore rupees. India is projected to become the third largest economy by 2027. The country's growth has been significantly supported by its capital markets, which have experienced remarkable expansion. India's equity market, with a market capitalization of rupees 444 lakh crores or USD 5.1 trillion as of 31st December 2024, is the fourth largest globally after US, China, including Hong Kong, and Japan. The market is also unique, with no other country in the per capita income range of $2,500 to $20,000, matching India's market size. In fact, India's equity market capitalization has outgrown the banking sector. Today, it is 1.7 times the size of the banking sector. NSE has been privileged to play a pivotal role in this growth story. In 2024, we helped raise a record 1.7 lakh crores through 268 IPOs, making us the highest globally in the IPO fundraising. Overall, NSE helped companies raise a total of 17.9 lakh crore rupees through equity and debt in 2024, a 32% year-on-year increase, outpacing bank credit offtake of rupees 7.7 lakh crore to industries and services in the same period. The rapid growth in mutual fund assets, with the total assets under management of rupees 66.9 lakh crores in 2024, further underlines the deepening participation in India's financial markets. At NSE, we are equally focused on fostering an inclusive investor ecosystem. As of January 2025, our unique investor base has crossed 11 crore 110 million, with the total number of UCC accounts at 21 crores or 210 million. Individual investors now hold 18.2% of NSE listed companies. Individual ownership in Indian equities has increased tenfold from rupees 7.9 lakh crores in March 2014 to rupees 79.6 lakh crores in December 2024. More importantly, younger investors are playing an increasingly bigger role, with median investor age dropping to 32 from 38 in the last 5 years. The gender gap is also narrowing, with female investors now comprising 24.1% of the total investor base. Increasing investor participation and strong returns generated by Indian equity markets have resulted in a significant wealth creation for Indian households. Our estimates point an accretion of nearly 30 lakh crore to household wealth in the last 3 years, 2022 to 2024. Today, 1 in every 5 households have exposure to equities, up from just 1 in 14 households 5 years back. These developments highlight not just opportunities, but also the need for strong investor protection and transparency. At NSE, we have placed a strong emphasis on ensuring that trust and transparency remain cornerstones of our financial ecosystem. A series of regulatory measures have been introduced, such as the implementation of T+1 settlement cycle, reduction in mutual fund redemption timelines to T+2, and the ASBA, or Application Supported by Blocked Amount process, which allows investors to keep their funds in their bank accounts while participating in an IPO. Segregation and monitoring of client funds, upstreaming of funds, and many more. Additionally, SEBI has recently introduced critical regulatory changes to protect investors in the derivative segment. Our commitment to investor protection extends beyond regulations. Investor Protection Fund at NSE currently stands at rupees 2,355 crores as of December 2024, which compensates investors in cases where defaulters' assets are insufficient. Further, the Core Settlement Guarantee Fund, with a corpus of rupees 11,674 crores as of December 2024, ensures timely settlement of trades even in the event of default by a trading member. These initiatives underline our commitment to safeguarding investor interests. At the same time, we acknowledge that the future of the exchange business is closely linked to how we adapt the evolving market demands and technological disruptions. The shift to digital platforms, the rise of algorithmic trading, and the increased focus on global integration are transforming the landscape of exchanges. To navigate these changes successfully, it is imperative that industry and academia come together and foster a deeper collaboration that would help us drive innovation, address challenges, and shape a financial ecosystem that promotes sustainable growth. Before I conclude, I'd like to thank the participants who have come to witness the insightful discussions lined up for this conference. I sincerely hope that our discussions will be thought-provoking, enriching, and will lay the foundation for advancing knowledge and fostering innovative solutions in the fields of banking, finance, and macroeconomics. Once again, I welcome all of you to this exciting conference. Thank you.
Thank you, Sriram sir. I now request Professor Debashish Chatterjee, Director of IIM Kozhikode, to deliver the keynote address and set the stage for today's conference.
Thank you. Deputy Governor Rajeshwar Rao, Ms. Ashish Chauhan sitting there, Sri Ram Krishnan, Trithankar Ji, who's the Chief Economist, and very distinguished members from the fraternity of banking and finance, and students filling up a lot of this space. Mr. Rao traveled a year and a half ago to my campus, and we were just talking about why Kozhikode has remained the same. I said some parts of India should remain the same to give you an advantage of what India was like and to be able to reflect on what our past was all about. My heartfelt thanks to Professor Midul Sagar, who's the reason why we are here together. Mr. Sagar heads a center called Urupika, which is IIM Kozhikode's unique offering as a synthesis of academic and institutional knowledge and enterprise. I'm not an expert. I'm an academic. I coach leaders and I invest in minds, not in stocks. So I can reflect a little bit about the human mind and its enormous idiosyncrasies. First and foremost, we start with two questions, and the questions that are uppermost in our minds are, would the financial system live up to the speed and scope of technological disruptions? That's question number one. Question number two is, can finance be democratized to include large parts of India who are not in the ambit of financial prosperity? And so the answer to the first question is that we rarely recognize that we have entered the economy of attention. We are no longer in the economy of information. We continue to believe we are in there, but we are not. In the economy of attention, a Trump speech can put the market on a tumble. A Clinton scandal can get the Sensex going down. But the point is, this economy of attention is not accessible to everybody. We live in one corner of our vast consciousness, collective consciousness, sitting in the stock exchange or sitting in the academic closets, and we speculate. And we speculate based on data, half-baked information. And the result is we are always subject to the vicissitudes of the market. But if you look at what the market itself is, market is a mechanism. Market sorts out the efficient from the inefficient. Market does not decide what is good or bad. And to depend on the transactions of the market to speculate about what is going to happen in the financial world is to take the tail of the dog and hoping that it will wag the dog. It doesn't happen that way. What moves the markets are liquidity. And the word liquidity has a great connect between wisdom and wealth. We are looking at two very disparate dimensions of life, Lakshmi and Saraswati. But wisdom and wealth have one common frontier, which is the invisible dimension. Sometimes you call it investor confidence, so liquidity translates for me as investor confidence. which translates as economic growth, which translates as buying and selling in the market. But if you don't have the investor confidence, just observing transactions will not give you much of a clue. So where do you start? We are starting at wisdom beyond the market. In the academic space, we look at wisdom beyond the market, wisdom that tells Chanakya that taxes should be collected by the government in such a way as a bee collects honey from a flower without hurting the flower of the market. So taxation has a way of working in the larger market space where confidence brews. And so my theme, which is the leadership in the financial world, leadership is a forte of the academic world in some sense because we deal with them all the time, and I define leadership in terms of capacity to change. This capacity to change is determined by what Joseph Schumpeter called creative destruction. You can see creative destruction has three components. One is you do not become idiotically consistent with the past. When technology changes the way it is changing, if you continue to harp on past trends, you're going to be beautifully prepared for a world that does not exist anymore. And so digital transformation that is enhancing customer experience, that is enhancing the operational efficiencies of the institutions are not going to remain static. They're going to change dramatically. Just to bring to your point, the very birth of National Stock Exchange started with a person who was reporting to me in my first job in New India Assurance Company. He was a senior assistant, and he used to come to office at 11 o'clock with a copy of the Economic Times and his lunchbox. And he would vanish at about 11 o'clock with the copy of the Economic Times, come back for lunch, and then again go to wherever he was going to at 3 o'clock. He would not be visible after that. So my boss, his boss's boss told me, where does he go? I said, he goes and plays in the stock market. So he said, why didn't you transfer him to Mahalakshmi from Churchgate, Flora Fountain, where his office was? When he was transferred, he looked at the transfer order like a claim that was false, and he put it away, and within 7 days he resigned. After 3-4 years, he emerged as Harshad Mehta, the big bull of India. He was reporting to me. The stock exchange was born out of that inconsistency. NSE was born out of Harshad Mehta's scandal. So you can recognize that a bad turn is not so bad after all, because it is preparing you to deal with those inconsistencies of the past. The second aspect of leadership is the path of a leader is different from the path of an achiever. How is that so? When J.R.D. Tata says money is like manure, it stings when you pile it, it grows when you spread it. He's talking about the path of the leader. Path of the achiever is to achieve, to make money. Path of the leader is to create wealth. This is what Dhirubhai Ambani did when he said, I have to create a phone call as cheap as one postcard. He was talking about the path of the leader. Achiever's journey is not necessarily a leader's journey. You know, I was interviewed for a job by one of the co-founders of Infosys, and he was interviewing me in a small hotel called Lytton. I said, Infosys' co-founder staying in a category C hotel in Calcutta interviewing me, but I did not know that there was this invisible wealth which was hidden away, tucked away somewhere, which is not visible on the surface. The third and the last element is leadership is about creating trust. It is trust that mobilizes energy. There used to be a time in our days when it used to be said, Juta hai to Bata ka, Naukri hai to Tata ka. Not that I'm advertising Bata or Tata, but I'm simply saying this trust is entrenched in the human psyche in very simple, memorable lines. And we have a way of reducing the complexity of the market into these one-line slogans, which is trust. And I hope NSE, the tremendous work that it is doing under the leadership of Mr. Chauhan, is able to generate trust in our entrepreneurial spirit, in the energy and creativity of the Indian entrepreneur, so that our wealth does not stay stuck in one place and it gets democratized in the true sense of the word. Thank you for your attention.
Thank you, sir, for the thought-provoking address and the kind words. I now request our chief guest for today, Shri M. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India, to deliver his inaugural address.
Dr. Debasish Chatterjee, Dr. Mridul Sagar, Mr. Ashish Chauhan, Mr. Krishnan, Mr. Devdat Chand, Rajneesh Karnatak, Mr. Varadarajan, other distinguished guests here, ladies and gentlemen. Good morning, everybody. I would like to thank IIM Kozhikode and the National Stock Exchange for inviting me to deliver this inaugural address at this second conference. The theme for the conference, Finance for Growth Amid Creative Disruptions, captures the essence of the transformation we are witnessing in the financial sector today, not just in India, but globally. Disruptions in finance are not new, but what sets this era apart is the unprecedented pace and scale of change, fueled by digitalization, artificial intelligence, and the resulting confluence of these changes leading to emergence of new business models. These changes make it essential for us to understand how to harness them for sustainable economic growth. For India, this transformation is particularly significant as we strive towards Viksit Bharat, a vision of a developed and self-reliant economy. Our goal of becoming an advanced economy by 2047 will require us to effectively integrate technology with finance to deepen the markets, expand financial inclusion, and drive economic productivity. Innovation in finance has always been a double-edged sword. On one side, it drives efficiency and inclusion, but on the other, it can destabilize traditional structures if they are not managed well. This is where the distinction between a creative disruption and creative destruction becomes crucial. While both the terms may seem similar, they carry different implications. Creative destruction, as popularized by the economist Schumpeter, refers to the complete dismantling of old systems to make room for new ones. In contrast, creative disruption is a more nuanced process. It's about evolving existing systems, refining them, and making them better through technological innovations. We are not simply looking to replace what exists, but transform what is to the better. This sets the context for my talk today. I would like to share a few thoughts on how digital transformation is reshaping finance, the role of artificial intelligence, the way forward for more meaningful financialization and inclusion, and how the regulatory landscape must evolve to foster responsible growth. The financial sector has undergone a profound transformation in the digital era, reshaping how individuals and businesses access and utilize financial services. The shift from a cash-driven, paper-based transactions to seamless, technology-driven ecosystem has been one of the most defining changes in modern finance. India has exemplified creative disruption in finance through innovations like the Unified Payment Interface, the Account Aggregator Framework, and the recently launched Unified Lending Interface. This has complemented the other components of what is collectively known as the India Stack. In the context of creative disruption referred to earlier, these initiatives have not just supplemented the traditional banking systems, but have also strengthened it by making transactions more seamless, expanding the financial reach, and improving efficiency. Similarly, the rise of digital lending has not rendered conventional credit channels obsolete, but has complemented them, bringing the underserved segments into the financial fold. In my opinion, what truly sets India apart from the global peers is the open approach. Unlike many other countries where these advancements have come as walled gardens, India's financial infrastructure is built on the principle of openness and accessibility. Our platforms are designed as plug-and-play systems, enabling any entity to build on top of it, fostering innovation, competition, and inclusion. Whether it is the UPI, the Account Aggregator Framework, or the United Lending Interface, our guiding philosophy remains the same: creating an open ecosystem. UPI stands as a prime example of open digital infrastructure that fosters both innovation and inclusivity. It provides an interoperable framework for instant payments, enabling several private players to build seamless financial solutions on top of it. As on date, there are 39 third-party application providers in the UPI ecosystem, enabling the UPI payments besides the apps of the banks. With over 16 billion transactions processed monthly, UPI demonstrates how public digital infrastructure can empower private sector innovation to promote financial inclusion without the risks of exclusivity. A research article by the World Economic Forum has estimated that UPI has saved the Indian economy approximately $67 billion since its inception in April 2016. While the India Stack has successfully built the digital pipelines that power a seamless and inclusive financial system, as we move forward, I believe artificial intelligence and machine learning will become the engines that drive the next phase of financial transformation. These stand among the most transformative advancements of our times. This growing significance is reflected in how both financial institutions and regulators are increasingly engaged in artificial intelligence-related topics. An analysis of the annual reports of the scheduled commercial banks has revealed a sharp rise in reference to the AI and its applications in recent years. Further, this trend is not limited just to the regulated entities. Central banks are also devoting more attention to artificial intelligence in their public interaction. A review of the speeches by the central bank officials globally shows a similar pattern, where the discussions on artificial intelligence-related topics have increased significantly, especially post-2022 generative AI wave. This underscores the increasing awareness and strategic focus on AI within the financial ecosystem. While the artificial intelligence adoption in financial services is increasing, it can make a significant impact in three areas: risk assessment and credit scoring, enhancing customer experience, and fraud detection. Traditional credit evaluation relies heavily on structured financial data such as credit history and income statements. However, AI-driven models enable analysis of a vast amounts of alternative data, including traditional transaction patterns, utility bill payments, e-commerce behavior, to cite a few, which can help to assess a borrower's creditworthiness more holistically. This is not only useful in the initial underwriting, but also in proactive monitoring of existing borrowers to detect stress at an early stage and take remedial measures. It also enables offering of hyper-personalized financial products, leading to enhanced customer experience. Another use case gaining prominence, is fraud detection. Unlike traditional rule-based fraud detection systems, which rely on predefined parameters, AI-based techniques continuously learn and evolve, adapting to new fraud techniques and identifying subtle anomalies in transactions and payment behavior. This is especially critical in the era of real-time payments and digital transactions, where cyber threats, frauds, and the use of mule accounts are becoming more sophisticated. On an earlier occasion, I spoke about the risks associated with the artificial intelligence and machine learning models and the guiding principles for their responsible use in finance. Today, however, I want to highlight a fundamental point. While artificial intelligence raises critical issues such as algorithmic bias, fairness, data privacy, and security, the root of these challenges and many others lies in the lack of explainability. Many advanced AI models, particularly the deep learning systems, function as black boxes, producing outputs that even their developers struggle to interpret. In a sector where trust, accountability, and regulatory compliance are paramount, a lack of explainability undermines confidence in the AI-driven decisions. In the absence of explainability, human intervention can end up becoming mere rubber stamping rather than responsible oversight, increasing the likelihood of systemic errors. The second-order effects of unexplainable AI is that AI models continuously learn and evolve based on new data. While dynamic adaptation can be beneficial, it also makes the model susceptible to data drift and concept drift. Data drift refers to the phenomena where distribution of data inputs that an ML model is trained in differs from the distribution of data inputs that the model is applied to, while concept drift is an evolution of data that invalidates the data model. These changes can cause models to misalign with the real-world trends, risking incorrect financial decisions and instability. Regular human oversight and explainability are critical to prevent such risks. A less appreciated risk of AI-based decision models is the automation complacency, where people rely too much on technology, even when situations need careful judgment. As the aphorism goes, all models are wrong, but some are useful. While algorithms can provide valuable insights and efficiency, they should be used as tools to support, not replace human judgment. A significant yet overlooked barrier to responsible AI adoption in finance is the shortage of professionals who can interpret and oversee AI models. If financial institutions lack personnel with the necessary skills in AI, data science, and regulatory oversight, the explainability problem is further exacerbated, and decisions made by the AI models may remain opaque. Before I delve into the way forward on financial inclusion, another critical distinction is in order. Financialization and financial inclusion are often used interchangeably, but they represent distinct aspects of economic development. Financialization refers to the increasing role of financial markets, institutions, and instruments in an economy. On the other hand, financial inclusion focuses on ensuring that every individual, especially those from the underserved and the marginalized communities, has access to basic financial services like savings accounts, credit insurance, and digital payments. The two are inherently complementary. Without inclusion, financialization risks being concentrated among a privileged few, limiting broader economic participation. Conversely, without financialization, inclusion will remain superficial, as access to banking alone does not empower individuals unless they can also save, invest, and grow their wealth. The Reserve Bank's Financial Inclusion Index, a multidimensional composite index that captures the extent of financial inclusion in the country, stood at 64.2 in March 2024, up from 60.1 in March 2023 and 43.4 in 2017. The index is based on three sub-indices: access, quality, and usage. India has made remarkable strides in expanding financial access with the success of schemes like the PM Jan Dhan Yojana, ensuring that 80% of the adults now have a bank account. Till date, 54.84 crore bank accounts have been opened under the PM Jan Dhan Yojana, with a total balance of Rs 2.45 lakh crores in these accounts. However, true financial inclusion goes beyond merely opening accounts. It requires meaningful engagement with financial services. As the chart which I put in my written speech shows, usage is one which is lagging the other two, and that is something which needs to be addressed. A bank account should serve as an entry point for individuals to access a broader suite of financial products, including credit, insurance, pensions, and investment opportunities. Without this deeper engagement, financial inclusion remains superficial, and the true benefits of a formal financial system do not reach every individual or business. It is encouraging to note that the improvement in the Financial Inclusion Index in 23-24 was largely contributed by the usage dimension, reflecting deepening of financial inclusion. While this shows that we are moving in the right direction, there's still a long way to go, wherein most of the vulnerable populations and low-income groups have access to secure and affordable finance. One of the significant gaps lies in the access to credit, particularly for the informal sector in the economy, which is a major contributor to the economy employing millions. Traditional credit models, which rely heavily on collateral-based lending, fail to accommodate first-time borrowers and small businesses with limited credit histories. As a result, such entities and individuals either remain underfunded or turn to informal sources of credit, often at exorbitant interest rates. Another critical gap is in insurance penetration, which stands at just 3.7% in the financial year 23-24, which is significantly lower than the global average of 7%. Similarly, pension assets in India account for only 21.5% of the GDP, 17% under EPFO and 4.5% under the new pension scheme, which pales in comparison to 80% in the OECD countries, 80% of the GDP in the OECD countries. To bridge these gaps, we must harness the power of digital transformation to make financial services more accessible, efficient, and inclusive. Technology-driven solutions can democratize finance by breaking traditional barriers and bringing a wider range of financial products to the underserved segments of the population. As I highlighted earlier, having a bank account is not very useful if it does not lead to further financialization, that is, ensuring quality and usage. In case of payments, UPI meets all three dimensions of access, quality, and usage. Given the omnipresent nature of UPI for retail payments and its ease of usage, it has become essential for many in the informal sector. This has created financial footprints for a large informal economy, which was earlier mostly dealing in cash. Access to these financial products has been enabled for the financial services providers through the account aggregator frameworks, and it can be employed by lenders to underwrite them using new age models and combining it with alternate data to offer hyper-personalized financial products. This approach is particularly useful in extending credit to new-to-credit individuals, gig workers, and small businesses who may lack formal credit histories but demonstrate strong financial discipline through alternative indicators. Thus, the account aggregator framework acts as a bridge allowing banks, NBFCs, and other financial service providers to access a more holistic and accurate picture of a customer's financial profile. Further, increasing the formalization of MSMEs through the GST, the e-commerce sales data, etc., can help the lenders assess creditworthiness more accurately. To augment the data-driven financial inclusion, Reserve Bank has also facilitated the setting up of a unified lending interface as a digital public infrastructure in the lending space, which will unlock critical financial, non-financial, and alternate data for lenders to enable informed credit decisions. As of December 6, 2024, over 6 lakh loans amounting to rupees 27,000 crores, including 1.6 lakh loans amounting to rupees 14,500 crores to MSMEs, have been dispersed using the ULI platform. 36 lenders, including various banks and NBFCs, have been onboarded. These lenders are using more than 50 data service providers, including authentication and verification services, land record data from 6 states, satellite services, data transliteration and property search services, diary and milk pouring data, and identity and document verification. While technology and digital innovations are driving financial inclusion and access, they also bring with them the risk of excessive exposure and over-leveraging, which can create significant vulnerabilities for both individuals and to the broader financial system. However, as it's said, the presence of too much light can also lead to blindness. We must be aware of the risk of reckless financialization. Of late, we have seen some concerns of excessive borrowing in unsecured segments and from the derivative euphoria in the capital markets. The temptation of short-term gains can easily overshadow the long-term financial security of individuals. Financial entities have a duty to ensure that the customers fully understand the risks associated with the leveraged products and also of speculative investing. While RBI, along with other financial sector regulators, is taking progressive steps to educate the customers, financial sector entities also need to shoulder part of the responsibility. Absence of financial literacy leads to people to fall prey to unscrupulous players, which erodes the trust of the people in the system. Increased financial literacy will help to increase trust in the sector and its participants, whose benefits will accrue to the entities themselves. While educating customers helps protect them from fraudulent practices, regulation plays a critical role in maintaining stability and preventing systemic failure. Financial services are regulated because their stability is crucial for broader economy. Failures in the financial sector have severe real-world consequences, often requiring costly taxpayer-funded bailouts. The 2008 global financial crisis is a reminder of how lax regulation and excessive risk-taking can lead to widespread economic distress, job losses, and prolonged recessions. The cost of restoring financial stability in such a scenario is often much higher than the cost of preventive regulation. While strong regulation is essential to prevent such crises, determining the optimal level of regulation remains a delicate balance. Too little regulation may increase the systemic risk, while excessive regulation can stifle innovation, limit credit availability, and raise costs. Thus, regulating finance in an era of fast-paced technological innovation is a delicate balancing act. At the same time, regulated entities must develop the necessary capabilities to implement and comply with the evolving regulations. As financial institutions integrate AI, cloud computing, and API-driven finance into their operations, they must invest in robust governance frameworks and risk management protocols to ensure compliance and customer appropriateness. Financial firms cannot afford to view regulation as a barrier to innovation. Rather, compliance itself must become a core component of their digital strategy. A strong internal culture of risk awareness, ethical artificial intelligence usage, and customer-centric innovation will be critical in navigating the evolving financial landscape effectively. Change is the only constant, wrote an ancient Greek philosopher, and yet change can appear daunting, destabilizing, and even threatening. So will the technological changes lead to creative destruction and really replace the traditional financial institutions like the banks? The specter of the banks being dead. This has been raised in the past also. A quarter of a century back, the issue was examined in the light of disruptive financial innovations of those times, such as securitization, which was touted as evidence enough for erasing the need of banks as financial intermediaries. As the passage of time has shown, these predictions have proved false, and the banking sector emerged even more resilient from these disruptions. Although history does not repeat itself, the potential of the current wave of disruption is arguably bigger. It may be prudent to be cautious while making predictions about a future of banking. For banks and NBFCs, however, the message is clear: adapt or risk being made obsolete. To remain competitive, the financial institutions must invest in digital infrastructure and pivot to a customer-centric, data-driven approach in this new landscape. At the same time, institutions must navigate the risks of excessive reliance on third-party technology providers, ensuring that regulatory compliance and cybersecurity, while ensuring that customer protection remains their top priority. The challenge is ensuring a balanced and resilient financial ecosystem for the future. The key is to harness the benefits while managing the risks. Thank you very much for a patient hearing. Thank you.
Thank you, sir, for the insightful and very informative address. We would now open the floor for the Q&A. In the interest of time, we'll only be able to take 2 or 3 questions. Professor Mridul Sagar would moderate the session.
I hope it's okay. You'll take 2, 3 questions. Floor? Yeah, please. Open to you. Yeah, please, you can ask. Yeah. Yeah, I'll come to you. Is there a mic?
Hiring specifically in the banking sector. So my question is, with more banks adopting technologies such as artificial intelligence, how do you think this will change the employment scenario within the banking sector itself? Are we looking towards a sort of scenario of technological unemployment, or do we not have to worry about that? And what kind of skills do people within the banking sector, do they have to skill up? Those kind of questions are coming to my mind.
I don't know whether it's audible. It's audible, right? Okay, I think that's a very fair question, I would say. Yes, the risks of artificial intelligence impacting on employment is something which we will have to confront. But I think what will change is the nature of the jobs which are being done, and perhaps in today's era of where the banking services are being disintermediated across various spectrums, the nature of the jobs being done will change. There will be greater demand for the AI scientists or data scientists to do the analysis. There could be demand for better cybersecurity professionals, maybe the network professionals. So those kind of employments may actually rise. That is one. But having said that, within the bank, yes, there will be need to really scale up your skill sets so that you are able to be the man in the middle. As I said, the human has to be in the center of the entire interface. He should be able to explain the logic. He should be able to interact with the customers. Having a call center on a computerized basis with AI will not really help many of the people unless there is a human who can understand the problems with the customer faces. And I think in a country like India, which has a diverse geography and a segment of people, starting from the extremely financially excluded to highly sophisticated investors and multi-billionaires, I think there will be a space for a lot of human interface to address the various segments. So I don't think employment may really come down. And again, as we grow into an advanced economy, the amount of financial services which need to be offered to the economy is going to be very large. So in terms of the expansion of the financial services, I do feel employment will rise, but the nature of employment would change.
Thank you very much.
Thank you. In interest of time, just one last question, because our esteemed guests have kept to time. We must also keep to the time. We have a tight program. He had raised his hands first, so I can maybe next
question.
session.
What are the RBI investment in through AI in preventing mule accounts, which is a problem for, I would say, last 15 plus year, except that mule account hunter.ai started and few advertisement. What are the investment of RBI in that front?
No, RBI has an RBI Innovation Hub where this issue is being dealt. I think Mule Hunter is a app which is being developed by them, which would have quite extensive use for the banking sector as a whole. As I said, the technology behind AI would actually help to address some of the key areas like fraud prevention, maybe detection of money laundering or mule kind of accounts. So those kind of data AI would be helpful, and this kind of app could provide kind of a common factor which can be used across the banking industry. So that would be one area where we are looking at. Thank you.
Okay, with my due apologies, I think we'll sort of close this session here, because we have time limits for each session very strictly following, and my request, I know a lot of people want to interact, so over the tea and the next session we have bank MDs and CEO, the same questions could be probably directed to them also. Thank you.
Thank you, sir. We'll now move on to the felicitation ceremony. I would request our MD and CEO, Shri Ashish Kumar Chauhan, to please come on stage to felicitate our speakers. Could we have the memento for RBI DG Shri Raj? Yes, please. Shri M. Rajeshwar Rao. We have the second memento for Professor Devashish Chatterjee. I'm Kozhikode Director. Thank you so much. As we come to the end of this inaugural session, I request Dr. Tathankar Patnaik to deliver a vote of thanks. So I request Professor Mridul Sagar to felicitate with the IIM Code mementos. We have mementos from IIM Code too. Okay, Dr. Patnaik, over to you.
Thank you, Ashiana. Ladies and gentlemen, as we conclude the inaugural session of the NSE IIM Code Conference on Macroeconomics, Banking and Finance, it is my privilege to deliver the vote of thanks on behalf of NSE. First and foremost, I would like to express our sincere gratitude to our chief guest, Deputy Governor Shri M. Rajeshwar Rao. Thank you, sir. Your thought-provoking address, which looked at so many dimensions of artificial intelligence, the opportunity, the risks that it entails, has truly set an inspiring tone for all our discussions going forward, sir, motivating us to think ambitiously about the future of capital markets and banking in this era of technology. Thank you, sir. Next, we're grateful to Professor Debashish Chatterjee, Director of IIM Code, for your insightful keynote address, for giving us the opportunity to host the conference at NSE. I'd like to convey our heartfelt appreciation to the faculty of IIM Code, particularly Professor Sagar, who's here, my partner in crime, for this collaboration. I'm extremely grateful to the cooperation we received from our colleagues at NSE. Your commitment to excellence and attention to detail have ensured that this event has been done very well. I would like to thank our MD and CEO, Shri Ashish Kumar Chauhan, and our Chief Business Development Officer, Shri Sriram Krishnan, for their support and guidance. I would like to extend thanks to our media guests for their coverage of today's conference. Lastly, but certainly not least, I'd like to express my sincere gratitude to all of you, our participants and attendees for this conference, both here and online. We are thrilled to have over 400 participants here attending the symposium in person and an even greater number joining us virtually. Your involvement truly makes this event special. Let us carry the insights gained from this session into our forthcoming discussions through the day and continue to build on the foundation that we have established today. I hope you find valuable takeaways from this conference. Thank you.
Thank you, Dr. Patnaik. We'll now break for a short tea and coffee. I request all of you to assemble here by 10:45.
Inaugural in financial stability amid global spillovers. We are thankful that National Stock Exchange other disruptive shocks that generate financial market turmoil. The resultant chaos and disorder rip through the economy with social upheavals, with several small and large businesses folding up, millions of livelihoods lost, and deep recession leave permanent scars with lost outputs of mega proportions. The conference will improve our understanding on this and how to prevent this.
The name of the it was one of the coins early in the circulation in Calicut during the kingdom of Smoothies, which has given the name to the modern rupee.
At Urupika, we analyze both macro and micro issues related to money and banking. We do macro forecasting and policy impact analysis. We study financial
सोचकर समझकर इन्वेस्ट करें। धन्यवाद। ओके, देवेंद्र संजो, हम आशा करेंगे कि ये इस धनराशि का कुछ हिस्सा जो है अच्छे फाइनेंशियल इंस्ट्रूमेंट्स में निवेश करें, और निवेश करते वक्त देखिए, ध्यान रखिए कि अनरेगुलेटेड ट्रेडिंग एप्स के छलावे में आप ना आए। नेशनल स्टॉक एक्सचेंज कहता है कि खुद सोचकर समझकर इन्वेस्ट करें।
Sony Entertainment Television और Sony Live पर
एक जाने से पहले एक सूचना आपको हम बताना चाहेंगे। आशा करेंगे कि ये धनराशि का कुछ हिस्सा जो है ये अच्छे फाइनेंशियल इंस्ट्रूमेंट्स में ये निवेश करेंगे, और निवेश करने वक्त ये ध्यान में रखें कि स्टॉक टिप्स, गलत सलाह का, गलत वादों के छलावे में ये ना आए, क्योंकि नेशनल स्टॉक एक्सचेंज कहता है कि खुद जांच करके सोचकर समझकर इन्वेस्ट करें। ओके, देवेंद्र संजो, हम आशा करेंगे कि ये इस धनराशि का कुछ हिस्सा जो है अच्छे फाइनेंशियल इंस्ट्रूमेंट्स में निवेश करें, और निवेश करते वक्त देखिए, ध्यान रखिए कि अनरेगुलेटेड ट्रेडिंग एप्स के छलावे में आप ना आए। नेशनल स्टॉक एक्सचेंज कहता है कि खुद सोचकर समझकर इन्वेस्ट करें।
Sony
Everybody to take their seats. Welcome back, everyone. We will move on to the second session of the day, the panel discussion on transformative finance for growth amid disruptions. In an era of rapid technological advancements, policy shifts, and global economic fluctuations, the role of finance in driving growth has never been more critical. To deliberate on this, we have with us an esteemed panel of leaders who bring deep expertise and unique perspectives on the table. Please allow me to introduce them. Shri Debadat Chand, MD and CEO of Bank of Baroda. Shri Hitendra Dave, CEO of HSBC India. Shri Rajneesh Karnatak, MD and CEO of Bank of India. Shri Srinivasan Varadarajan, Chairman of Union Bank of India. The discussion will be moderated by Dr. Mridul Sagar, Professor of Economics at IIM Kozhikode and former Executive Director of RBI. May I request all our panelists to please come on the stage. We'll have a group photograph first. Before we dive into the panel discussion, we have a quick quiz for all our young participants here. Let's test your knowledge with a quick quiz. Please participate actively and be quick. Let's have the QR. Yes, so this is the QR to enter the quiz. Please scan the QR code displayed on the screen to go to the Slido link. If you're not able to scan, you can go to www.slido.com and enter the event code IIMK. Enter your full name followed by your institution if possible. There will be 3 multiple choice MCQs in all. Each MCQ will have 4 options. The questions are related to the panel discussion topic. You'll be given 15 seconds to answer each question before moving to the next question. The timer will be visible on your mobile screen. The top 2 participants who answer all the MCQs in shortest time will win a prize. Can we move to the first question? The second one. the third question. And the last one. Congratulations, Virag and Tushar. You may collect your prizes after the panel discussion. Please come to the stage after the panel discussion. I now hand over the session to our moderator.
Thank you, Ashena. So let me quickly kick off the discussion by requesting each of you to tell me which one or two things do you feel is extremely disruptive for the financial services and how banks might be coping with that. So, Mr. Devadatta, go first.
So first of all, thanks for inviting me. Per se, disruption as a bank, we don't see as something negative. Rather, we feel that disruption, unless and until something very sudden, these are all positive for the bank. Couple of things that's happening in the market for last many years, which again we are prepared to face. One is the innovation happening. That's a positive one. Innovation happening on the fintech space, capturing on the payment process and small ticket transaction. That's a great innovation that happened in Indian banking. Secondly, another innovation which is likely to happen where we as a bank quite prepared is a AI-based innovation in banking. That something is very initial stage, but I think there is a great value when we move on the innovation. Something negative, which again we as a bank quite prepared, is something on the cybersecurity space. And that's a negative disruption that can happen. All the banks are quite well prepared to face those challenges. But per se, disruption create a bit of more resilience in my system. Disruption creates a bit of more slightly bank like us having 116, 17 years more agile structure. So in that way, we're quite prepared to face all the disruption in the market, at the same time create value, not only for the bank, but also for the system.
Good morning, everyone. I think since this is a student-led event, I think one of the big disruptions that is taking place is that a lot of young people, their relationship, their engagement, the number of times they communicate with the bank has changed dramatically. This is a generational change which has happened, frankly, within a decade or so, and we will need to see what happens when the students start becoming income earners, but they choose to straight away disintermediate and deals directly with capital markets. So that, I think, as an industry, we need to be able to relate to how we win their trust back, how we win their confidence back, how do we make them understand that a bank has a role and an investment has another role. It's not, not to mix the two up. Don't keep comparing FD returns with stock market returns. These are very different sports altogether. So that is one definitely, I think, which is a disruption, which I think the banking industry has to start planning for, preparing for. Because it's a behavioral change. I think Saurabh spoke about technological change. I think the other thing is, in many payments that a lot of us make, right? There is a bank always at the back end, but you don't think you're dealing with the bank. So you take out your Google Pay or your Phone Pay or Paytm or whatever. And that has become such a ubiquitous way of making payments that the role of banks is not visible to the user, because at the back end of Phone Pay, there is always a bank and things like that. So I think the fact that a lot of users don't think banks are doing payments or banks are involved in making payments, that's the other disruption, because once again, it reduces almost the criticality or importance of banks to how money moves in the banking system. I would say these two, sir.
I'll come back to you later on the disintermediation aspect. So I think that's very interesting to see the challenge. But yeah. So
Yeah, thank you so much for having me here. As far as the disruptions are concerned, there are 2, 3 things which come into my mind. The first thing on the positive side is the IT disruption, which has happened over the last 15, 20 years, and the way the banking has shifted from normal traditional banking to the IT system. And today when we see UPI, ULI is also there, account aggregator is coming, ONDC is also there, all the Jandhan accounts, everything which has come, Aadhaar-enabled payment system, all these things, definitely a lot of things have been going towards the digital banking stuff. So days are not far off, maybe 4 or 5 years down the line. There today we have a segmentation in the balance sheet where we have to tell what is our wholesale banking, what is our retail banking, and what is our corporate banking. The day is not far off. I feel that the balance sheet segmentation would also have what is the digital banking, what is the out of the total business, what is the digital book, and what is the book which is created manually at the branch level, at the brick and mortar level. This is the kind of disruption and the technology which is coming in, and most of the balance sheets are getting into digital. Now we are having additionally certain banks which are totally fintech banks, and they do not have any branches. All the journeys are straight through journeys. There are no bank branches. Some fintechs are there. So these are the things which are there. That is on the positive side which is there in the system. As far as the caution side is there on the disruption is with respect to the cyber security and the cyber frauds which are happening. That I also feel that it is a clear disruption. Disruption in the sense that we are, when we say banks, we keep money on the behalf of our clients as a trust, that whenever they want the money back, we have to give them back. And if a fraud takes place in any account, whether it is a liability account or a asset account, a cash credit or a overdraft operative account, definitely a disruption is there, and definitely it shakes the trust and confidence of the customer of the bank also, that some money has gone through cyber fraud or some kind of thing. So that is one disruption we have to very clearly find ourselves and way forward. A lot of banks are doing a lot of things on cyber security in that, but definitely these fraudsters are one step ahead, and a lot of things are happening. We are on a daily basis reading. That is one disruption we need to control and make our systems more agile and resilient as far as that is concerned. The third thing which is beyond IT, I would say, in today's world is with respect to the CASA. The CASA ratio which is now coming down, the entire talk about the liquidity management, the LCR and other kind of things. If you see the RBI data of December also, scheduled commercial banks have a CASA percentage of around 40% odd, and it is coming down over the years. And the other day I was reading one report, which is the World Bank report of December 2023, which states in the entire global system, the CASA ratio is only 20%. So how it pans out it as you develop as an economy from an underdeveloped economy to a developing economy, and then finally a developed economy, the CASA percentage will come down because there will be more avenues to invest as an asset class, and number two, there will be more financial literacy. So this is one clear disruption which is happening, and definitely CASA is a great challenge for all the scheduled commercial banks.
So I'll request Srinivas to make the opening statement, but I have a question for you immediately after that. Maybe. Yeah.
A very good morning to all of you. I think just taking forward from what Hitendra said, I think the key disruption which is happening is for banks is who owns the customer. Typically the banks ultimately trade through the rails which are provided by banks, but the customer actually is coming through interfaces which don't belong to the bank. More and more of the transactions which are going through the banks in terms of actually the transactions which are being put through by the banks, I think are not originated through the bank systems or from bank branches. It is coming from various other participants. So therefore the customer is clearly not being owned by the banks, but of course he's a bank customer. How do you sort of deal with such customers, and how do you make those customers provide value to banks, and in terms of in actually how do banks monetize some of those things is something which the banks need to sort of adapt to, and I think that's the process we are in. So the user interface which people use may be multiple today, but ultimately it's all going through the banks, but the customer doesn't belong to the bank. I think that is something which is unlikely to change. I think that's something which is going to keep accentuating, and the banks have to adapt to it. So whether it is there are whole issues related to that, but clearly I think who owns the customer? It's not necessarily the bank, and more is not going to be the bank, and that's something which I think is a big change. The second is something which more internal to the banks, and being part of banks for the last, whatever, multiple decades. I think if you look at every note which the banks internally put up, every proposal, everything which the banks internally do, if you look at what technology can do today, I think anything can be done in a few minutes by technology. Populating various formats, if you take any scorecard, if you take any form, if you take any proposal, if you take anything, which is all lots of numbers and some analysis, some ratios, I don't think so humans are required to do that any longer. So what are all those people going to do is the key question, because there is a judgment issue involved, but we don't require so many. So if I look at it, if you sit in the corporate office of a bank, typically which a corporate office of a bank, which is primarily doing sort of MIS, data analytics and stuff like that, I think tomorrow if you just say all of you vanish, I don't think so things are going to change much in the new world. Because the corporate office is just aggregating data, analyzing data, and giving the same data back to the people. Do you need those guys to do it? Well, can technology do it? I think technology can as well do it even today. I think that it's taking time for the bank. It's more a question of how do you deal with the change. But I would think that banks have to sit up and take notice that, do I need these guys here? So what do you do with the people in the bank? Because technology can do most of the work which typically, that's what I'm saying, take any form which you have, take any proposal which you have, see how much technology can populate in a matter of minutes, which possibly takes a few weeks today. I think these are the two changes.
Great. So, Mr. Rajneesh, like you raised the issue of your CASA and all. What I want to understand is the distinction between current account and saving account evaporating with the kind of technological disruptions we are seeing now? I mean, every account is linked to UPI. The number of hits are going much larger. So how does it affect your bank financials, and what is it that you are doing as a strategy on that?
Yeah, so as I said, CASA is a challenge today for the public sector banks. Personally, I see that within CASA, saving and current account is one product which will diminish more rapidly in this changing environment, because see, when you talk about the CASA, within that current account, lot of current account in the banking system was also from the government side, both the central government and the state government, central PSUs and the state PSUs. Now with the just-in-time already implemented in most of the central government accounts and also in the state government accounts, this current account balances with the banks is now going away. Similarly, the entire working capital cycle has now within the corporate sector, also in the industry also, whether it is a proprietorship firm, whether it is a partnership firm or a limited company, they have also now optimized their working capital cycles. Less and less balances they keep in their current accounts because of the funds, rationalization of funds and other kinds of things. So current account is a bigger challenge within, if you compare between the saving account and the current account. And this current account will dwindle even further, because no one wants to keep idle balance in current account typically. Similarly, for saving account balance, there is a simple product with all banks now. Everyone wants a sweep in, sweep out account, wherein the balance, only a limited balance is there in the saving account. Remaining balance automatically at the end of the day gets transferred to the fixed deposit. So that is also bringing down, that kind of product is also bringing down the overall saving balance in the system. So banks are, all the banks, all scheduled commercial banks, typically the large private sector banks and the 12 public sector banks, are adopting lot of strategies. In fact, now the strategies, the more we are into IT, the more we are into digital, the more products we are able to give. There is a concept called the product per customer. The more product we are able to give to the customer, our saving account customer, the more engagement he will be having with that saving account. Typically, what we have seen is that any individual has 3 to 4 saving accounts across the banking system, one in a public sector bank, one in a private sector bank. And the operative account is one where the products are linked, where his SIP is linked, where his insurance premium is linked, where other kinds of payments are linked. So if you are able to have more products linked to the saving account, account, the more will be the transactions in the account, as you rightly say, UPI and other kinds of things. So that is the key now. Through digital and technology, we have to link these accounts, and the more agile and adaptive the system of the bank is, and the more agile and adaptive it is with respect to the transactions flowing out of the saving accounts, the more transaction will happen in the saving account, and the more transaction directly means that there will be more balances in those saving accounts.
Interesting. Yeah. So clearly, this is there now. The saving deposits, the more like the internet mobile deposits, and have you assessed the likely runoff out of those deposits in case of a stress situation? What is it that should be done with regard to this? Because I think there's this big issue about how tight financial regulation should be and what are the costs of regulations, especially in terms of the liquidity coverage ratio. So what is your assessment how we can go about this?
See, as far as the saving fund deposit account is concerned, it's something which has not only given, it gives a huge stability to the banking system. And the product has been there for decades therein. Yes, with the increasing the digital operation part of the account, there can be volatility in that. So all the banks, we do have all the models to factor in all this runoff and then preparing a contingency plan for that. And as on today, in case we look at the volatility in the saving, I mean, I don't think it's much to look at a concern with regard to really impacting the deposit base of saving. Couple of things which are very important at this stage, why there is a lower accretion of saving fund deposit at this point of time, because the rate of interest in the market has gone up significantly high. And many of these depositors are moving to the fixed deposit market. Many of these depositors are again moving to the capital market. So this typically a scenario at which I mean, there is a change preference leading to a slightly lower growth. But to my sense, because of the benefits available in the saving fund deposit, where you can do all the operation without almost at free charge, I think the product is going to stay. The deposit growth would be slightly lower, but then that's a critical product for the banking system and also for the entire system. Scenario building in terms of stress testing and all the banks are adequately prepared. And I don't think a scenario would happen where something like global scenario where there are some runoff on some banks on some scenario. It's going to have any materially any potential impact in the Indian market.
Okay. Yeah, please. Yeah, Mr. Hiten Dave.
No, I just wanted to just share that you know, LCR. There's a lot of students in this room, right? It's the amount of liquidity you always keep with you, assuming how much money you will need in the next 1 month or so, deposits maturing, loan disbursements, and then you will take some assumptions on how much of your current accounts and savings accounts will flow out and things of that nature. But in reality, sir, if a bank is in trouble, you can keep as much liquidity as you want. But if at 8 o'clock at night there is a rumor about one particular bank, your buffer of liquidity will evaporate in half an hour. Okay, so unless you ask banks to keep all their liquidity all the time available to meet all the outflows, it's a very complex issue, because in this day and age, with the WhatsApps and everything else available, if there is a rumor, then the amount of liquidity you keep is totally irrelevant. You can make it LCR of, like, you know, you can say for digital accounts, keep more because they can be digitally, but we have 24/7 RTGS. Any corporate can withdraw money at 3 a.m. in the morning. Any amount, there is no capping of the amount they can withdraw. So I think when we design regulations, we need to be real context of the how can you even react to that speed if it's 3 a.m.
So now the elephant in the room is out. So in the sense that I think very nicely explained the concept, because they are students. The liquidity coverage ratio is about what you have to keep in high quality liquid assets to meet the liquidity outflows in a 30-day stress period, as you may see from the past data. Now the past data won't tell you what's the future first. So that's one issue. And as Mr. Dave has very cogently argued that the deposits can just fly away, and all of them can fly away. then there's an issue of trust in the banking. If that is the case, we need to really, really solve this. And we need to have a clear dialogue between regulators, between banks, between academics, industry, to really think how we can deal with this problem. It's a very, very serious problem. Just because it hasn't happened in India, it happened in SVB case, is something that doesn't give us much comfort. So we really need to work out. Are you sort of advocating that there should be some limits on the deposit withdrawal, which itself will erode the trust? So that cannot be done?
No, all I'm saying is there is an overarching assumption that you keep a high LCR or keep higher outflow assumptions and the problem is solved. The problem doesn't solve. Just imagine, we are in 2025. When the financial crisis took place in 2008, if we had the level of digitization that we have today, right? The weekends over which all these people were negotiating, US Federal Reserve, US Treasury, they wouldn't have had that luxury because, you know, everybody on the phone would have withdrawn. So it's a very all models have to incorporate the speed at which money can move out. India is one of the few 24/7 RTGS markets, right? And to your point, sir, it's not happened in India is because we've not allowed it to happen. Yeah. So in a way, conservatively run banks have no advantage over adventurously run banks because the central bank has provided a put to depositors, and therefore depositors don't go to extraordinary lengths to say Bank of Baroda is a very good bank. Even if he pays me lesser interest, I will keep with him because you don't, if he's giving 6 and somebody's giving 9, nobody's doing the fact that that 9 reflects a higher level of credit risk. Indians are not used to the fact that the banking industry has credit risk.
I just want to supplement this. I think what Hitendra said is totally true. I don't think so we can provide or plan with whatever model for a situation when public loses trust in a bank. I think what the regulator is trying to do is to signal to everyone that every bank is conservative. They have enough money to provide for deposits or outflows over the next 30 days. So they are all in a great shape, and therefore all of you can trust the bank. For whatever reason people don't do it, nothing can be done. The only thing is that right now, everyone has to take comfort that RBI has made sure the system is robust enough and not let it slip, and therefore they will take care. So the put option is there, but trying to excessively stress and trying to sort of model and try and put excessive regulation in terms of trying to manage for such scenarios doesn't help the bank nor the real economy, in my view.
Can I just add one point here?
Sure.
See, there can be flight of deposit that can happen, that's real, right? But then if you compare the Indian market vis-a-vis the global market, the resilience of the Indian market is much high because of a high reserve requirement. We operate globally, nowhere we have a reserve requirement which provides a huge stability to the market. And that's the strength. A scenario which unfolded overseas, the probability of happening in India is very remote. That's the take.
No, I couldn't completely grasp why you think. Is it because of the put or something else? So
the put price is this.
The put price is this. Okay.
If I can just add on this with data, see, like we are operating, Bank of India is operating in 15 countries, different countries. The LCR ratios in those countries ranges from 100 to 20. So in one country, there is only LCR ratio by that regulator at 20 only. In one country, it is 40. And there are a few countries which had 100, like we have 100 over here. So the different things are, the LCR is different at different places ranging from 20 to 100. But beyond that point, which I would like to make over here is we, in our country, like we have a SLR and CRR also beyond that. So we have a SLR of as on date 18% and a CRR of 4%, which means 22% of the cash which is deposited or the bank deposit is parked with the RBI and through SLR and the CRR. So having said that, if you see the SLR and CRR kind of thing in other developed countries, it is not there. And even if it is there in some of the countries, it is at a very low level. So already our deposits are cushioned in the fact that 22% is parked with the Reserve Bank of India. So that is something which is clearly, and you can see it with data also. If you take out the data for all emerging economies and developed economies, what is their CRR and SLR is there. So that is one very important data point which should be kept in mind before deciding. So presently when RBI is having a LCR of 100, and all banks have kept their internal threshold much higher. Some have kept it at 115, some have kept it at 120, and I do not think any of the bank has gone down below the level of 100.
So Rajneesh, that's a fact that our regime has 100. I think every credible regime has LCR of 100 or more. So let's not talk of those 20s and 40s who have not kicked in the global financial regulatory reforms. So we are in a kind of a globalized country. We aspire to be advanced economy and stuff. So we can't really pull back regulations to that extent of weakening the LCR. But I see your point about SLR. And this was something I was asked on the Business Today conclave yesterday, where Dinesh Khara was there. And my answer is very simple to this. I mean, one would like to dispense with SLR over a period of time. If you have LCR, it's practically you have the liquidity. But the essential thing is we need more fiscal consolidation, more fiscal reforms, because you are essentially doing a financial repletion by having these instruments and directing credit to the government out of it. So let everybody compete for the funds and credit, and where the returns are, let the market efficiency prevail and get to that. But till such time that is possible, I think already the SLR has been reduced and converged to a level, some reasonable thing. But the LCR problem is more dynamic. I mean, it's something which could really come in a big way. I don't know if your bank is toying with tokenized deposits. Are you toying with tokenized deposits?
Sir, we've been evaluating that subject for a while. The broader subject of the entire tokenization, crypto and all those things, at this juncture as an organization we haven't taken a definitive view. But clearly, for example, with the Reserve Bank of India really trying to promote the central bank digital currency, right? You can make out that the position of RBI till fairly recently has been very clear that that's the only digital currency which will be permitted in the country. But on tokenization, we have started some tokenization efforts around the world, gold, and you can acquire some other things. But we are still backing conventional asset classes as opposed to new generation asset classes.
So that's where the difficult part is. And I'll come back to your first question, because if tokenized deposits are coming, if we can't even handle internet and mobile deposits, the tokenized deposits with programmability could really cause a flight of deposits in macro nanoseconds. So then how do we deal with that? I mean, where are the regulations to handle that? So it's a really mind-boggling question. And the future of banking could get at stake, and I would rather come at this level to discuss the first question you raised, vis-a-vis capital markets. And Srinivas is from capital markets. In earlier days, you had that role very prominently. So is it that the pace of disintermediation will now increase a lot more, or are banks doing something to deal with this challenge?
No, I think the one thing is, like I said, all the young people have only seen one-way markets, right? You put money in the market and you make money. They haven't experienced anything else. So it feels very silly to take a deposit paying you 7% after 1 year when you're used to making 7% overnight or in a week or something. And that is one. The fact that India is a young country has many, many advantages, but one of them from a banking system perspective is adoption of digitization, new trends is much, much faster than in many other parts of the world. We observe that Indians are embracing change a lot more faster than in many other parts of the world. Second, like I said, you see Japan, for example, had 30 years where the stock market didn't go anywhere, right? Now, nobody's wishing that on Indian stock market, of course, but you do need people, as last 7 months, we are already seeing some flight of deposit back because people have put money in the market and lost something and again reinvested and again lost something and again. So therefore, I think people will begin to distinguish between what is a 100% guaranteed product, right? Bank savings account or deposit is a 100% guaranteed product. While anything, even in a debt mutual fund, the prices can go up and prices can go down. So I think we haven't done a great job as an industry of distinguishing ourselves, right? Mutual fund sahi hai, mutual fund sahi hai. Which bank said banking is also sahi hai? Right now we should be out there, no? Saying that you put so much money on September 30, it is worth 85 rupees today, right? But my money is 101 rupees or something. So I think we are a slightly reticent industry. Over a period of time we get used to it. But I have confidence that so long as people value the safety of their money, banking will have a role to play. It's just that we'll have to discover how to communicate and how to almost position banking as a service.
I have my heart with the banks. I mean, banks are unique. They are the ones who create money. So I have some sympathy there. And to put the numbers correctly, even today, the financial savings of the household, 30% are bank driven. It's 8% for the MFs and other equities. So that's the share of financial assets in the portfolio of the households.
I think whether mutual funds are here or banks are here is one question. I think we are believing that all of these are push products, meaning people are buying this because someone is selling it to you. I frankly don't think so. I think if you look at any retail investor, even if he's not sophisticated, clearly I think he has a view in terms of what gives him reasonable return for the risk he's taking, and that's why if you see whatever has happened, if just look at plain gold, I think the amount of money which has gone into gold from retail investors, forget all the buying gold as a jewelry or buying gold as a thing which you typically do. The trend changes. If you look at last month's even mutual fund thing, the gold ETFs have been seeing the biggest spike. So the point I'm trying to make is that the use cases should be relevant for the investor and he should find that useful. Equity markets, whatever, has happened. And again, the asset allocation of equity in everyone's portfolio was so low. Even though markets have not performed, I think it's willing to stick with it as of now. Meaning incrementally there may be some adjustments. But what we need to see is that fixed income products are actively discouraged by the government in terms of taxation. So if there is a huge benefit in terms of post-tax returns on some products versus something else, the hurdle rate at which they will come in is going to be much higher. So unless you need capital protection, you'll not come to a bank FD. Only if you believe I need capital protection, and that is as you grow older and stuff like that, I need capital protection and therefore I need to go to a product which returns are not something which is important for me, but I need capital protection. That's the time you'll go into a bank FD or a fixed income product. Because the post-tax returns are skewed in terms of products, and that unless you level that up, you cannot say the asset allocation from an investor side is wrong, and therefore because someone is pushing something harder, it is working. Mutual fund say was there even before. Of course, the amount of money they are spending because they're making more money is only gone higher, but the campaign has been running for a much longer time.
So, okay, let me turn the track on a simple footing now. From your personal lives, maybe one or two of you can answer, has AI, machine learning, improved in MIS from the perspective of a CEO? So from the CEO's angle, do you have to now monitor a lot more information, though digitized, and are flooded something which you can't read? Or does the AI or the ML enable you to see things where exactly you want to focus? So this is, how do you eat the elephant in the room in your bank?
See, there was a question earlier also, is technology and employment, there was a question earlier. Actually, the fact of the matter is that technology is not going to reduce employment per se, it's going to improve the quality of job. And that precisely for a CEO also, when we look into, there is a huge data, like 10 years back, I never would have thought that the entire approval process, as far as I am concerned, is through a paperless work. I mean, file doesn't move to me. It's through entirely a paperless approval system. I cannot think of like, suppose I want to interact with all my regional head in half an hour time, I can very well touch base with them with a Teams network or some other network in half an hour time. I cannot think of a scenario where the decision support system to act on a particular issue, there is so much of MIS backup, so much of data backup in case I want something to be given to me, it is given immediately because of the usage of AI and ML. So hugely the life has changed as far as the CEO perspective. And the important part of the technology which you believe is that it can improve your quality of job, at the same time significantly improves the productivity. So we take it in a positive in terms of how do you look into technology and banking, and for a CEO perspective is very, very important. Everything I look at my own product process, anything I look through the technology eye, and that's completely churning in terms of the way the delivery is happening at the ground level. So I think it's a very positive one. It gives a huge comfort that you are making the right call, right decision, using a huge efficient process as compared to earlier.
Is AI lending a risk at this juncture? Are you having correct information based, if you depend completely on AI? Is lending a risk?
So important question on AI. Before I answer this directly, just on the AI ML, all banks are investing a lot on AI ML. And our bank also has done a lot of things on data lake project through the AI ML, and we have this project called the Star Aditya project, in which we have a dashboard coming to each one of the leaders in the bank, which we call a click. In the click, what happens is that the entire data every morning comes to us. In fact, it is 24/7, the entire bank data, and I can modulate the data which I want to see as a MD and CEO. If I want to see the total business, if I want to see the run rate at which, weekly run rate of the personal loan which is getting disbursed in the bank, that also I can customize myself that I want to see on a daily basis, that kind of thing. Similarly, we have customized it down up to the level of the branch heads. If he wants to see what business he is having, what kind of disbursements are pending, what are sanctions in the branch which have been sanctioned, and what is the disbursements which are pending in those sanctions, he can see with the click of a button. Similarly, for the zonal head, the FGM, and the general managers at head office, the CGM, the executive director, everyone can customize the data which they want to see under that project, which is the data lake project.
Yeah, that's fine, but the quality, the risk, the
so I'm coming
risk
to that,
profile of the person to whom you are lending.
Correct. So when we are going for digital banking through the AI, the algorithm which is there, it is something which is very important to check the algorithm and double check the algorithm. What we are doing in our bank is that once the sanctions also are taking place through the channels, which is the digital channels, our audit teams and other teams are also validating the sanctions, whether the rule engine is correct, whether the algorithms which have been set is correct. If we have given a CIC score of say 700, we cannot do a personal loan with below 700. Has any loan got sanctioned which is below 700 CIC score? All these kinds of data checks we are also doing, back testing we are doing to check that. I fully appreciate that there have been some cases where there have been some misses which have happened through the system, where some misses have definitely happened through the system. And it is a learning process for the entire system, banking system, whether it is a bank, whether it is a NBFC or other fintech company which are going through these digital channels. So we need to have customized things under the audit to backtest our data which is coming after the sanctions and after the disbursements, whether the algorithms which have been put in place are robust enough and they are agile enough and they are catching up as per the metrics which we have put in the system.
So the worry which I was slightly having was, see, the banks don't seem to have information for working out the expected credit loss. Not all the banks have enough data for that. So the advanced approaches you can't depend on, and you have to have standardized approaches and stuff. Now, with this kind of data, would AI be throwing good quality data on the lending quality? I mean, if we can't introduce ECL framework and we are moving to complete dependence on AI, where do we end up with?
As far as ECL is concerned, the banks do have the data. Actually, the banks have been preparing themselves for ECL almost many years from now. And the right sizing of the data and the quality of data available as on today. So in case the system decide to migrate, the banks are quite capable of migrating and managing that. AI typically helping in terms of the decision support, that you have scenario building and then telling you what is right. Like there is a quiz and one particular item has a higher take. So the usage of AI is that when it supports the decision, it is also supporting you in terms of the probability in which your decision would come right. So I think these are maybe related, but then banks are prepared. There are almost 15, 18 years of data now with the banks here. The advanced approaches on the capital is not because of data per se, because of the quantity it captures the capital. That can be one issue, but otherwise banks are well prepared.
Thank you. Let me change the track a bit. None of you have mentioned climate finance as a disruption. Globally, I think that's one big disruption which is coming. Maybe Hitendra would be the right person to tell us how is it causing disruption or not disruption in your Indian environment.
No, I think it's a very good topic you've introduced, sir. And I think again, there are cities which are getting rains when it never was supposed to rain, and when it rains, it's hot. And while that's news for many of us, for banks that have lent in that city, right? Whether your factory gets submerged with water, or for many people who are earning daily wages, the daily wages have gone to zero. So I think globally, most banks have tried to introduce this risk element into their decision models. Is it as advanced as conventional credit risk assessment? Obviously not, right? Because the climate change, there is not enough golden sources of data almost, but I think just given the sheer amount of change, we had extreme heat last year, right? I mean, that caused an economic slowdown. Now, how do you factor that into your model, that an economic slowdown causes lower employment, or it has increased sales of air conditioners, for example? That's also the upside. So at this juncture, at least I am aware that almost all global specialists sitting within their risk and operations team, these people do provide inputs, but it is not like if you are selling steel, okay, this is the cost of steel. If it falls below this price, then the operating cash flows will, it's not gone to that level, but I suspect as climate change is felt by all of us more and more, it will be introduced. But the interesting point is, given the change stance of US on this, we will have to see how that flows through regulations and Basel 3.1 and other things, etc. And at a broader level, the one-way street that regulations and regulators has been challenged now by the US administration, and it will be interesting to see its adoption. There are Basel standards which are now live in Asia, but not in Europe and America.
Okay.
So we'll have to see how that flows back.
Great. So would you want to add to that?
Yeah, I agree. I think we should not look, I think tendency has been to do this green finance bonds and green, All these are, I don't think so. There are pools of capital which is available, which may be there, may not be there, depending on how the world looks at climate finance. But what is key is that it should again be something which people believe has to be factored in for doing business. It should be incorporated in a way of doing business. If I do this, I have an issue. If I finance an agri thing here, the risk has substantially increased because of change in weather patterns. Or something, clearly the use case should come, like what Hitendra is saying, in terms of it being looked at as a risk for doing business. If I do this industry, I have increased risk because of certain things. These are things which need to be built in, and that's when I would think money will not go to certain pockets which should not go, and will go to certain pockets which are useful. So I think we've not got there. We've clearly not got there. We are looking at this as more as saying, I'm doing renewables, therefore can I raise some cheap fund money under a different row item? I think that is being very short term.
Yeah, but the greenium on the green bonds is fast disappearing. So it's
no reason for it to be there. I don't think there's any reason for it to be there.
So does that worry you? No, not at all.
Meaning, if you actually do the right things as a business, I think it will come back.
Okay. And any of you planning green deposits?
Yeah, I do have actually a green deposit, and the outstanding deposit in this particular scheme is very significant. Maybe as on today, I think the highest deposit, green deposit, is there with Bank of Baroda. That's the data which available now. So it's not the premium.
What is the differential you give on that?
There is no differential. That is what the point I'm driving. So this deposit at par with a normal deposit, actually the concept at which the depositor, at the concept at which the issuer, like the bank, were attached to the concept, and that possibly driving the deposit to go significantly.
This is really music to the ear, because I can understand why green bonds are sort of by the investors. I mean, there are funds which have a clear mandate now not to give funds except for the green. Biggest funds in the world.
I tell you
but deposits coming from the retail level you are getting, or the corporate level?
It is on both. Actually, the advantage is that there is a disclosure requirement with regard to how much you have invested into green bond or green deposit, and that possibly driving a significant pickup there.
Okay.
If I can just come in over here, we also have that green deposit, and just an interesting thing that we are getting query even from the corporates for that. So what has happened the moment we launched and we went to the corporates also that we have green deposits, there were many queries also what extra rate of interest you will give and other kinds of things. In fact, now corporates are mentioning in their balance sheet how much they have invested in green deposits. So in fact, if you see our retail deposit from retail investors and the corporate depositor is both equal. So that is the kind of thing, and that is the kind of the interest which it is carrying now these days, green deposit.
Okay. Maybe last two questions. One, how are you, which areas of the banking you are implementing AI more and which less? I mean, as I said, there's elephant of the room. You either eat it or you then basically perish, to be honest. Or if you eat it, and then do you eat it in parts? You have to probably not incorporate the whole AI immediately. So which are the segments which are driving the AI investments in your banks?
I'll give two statements here. One is that on the risk management and fraud risk management, underwriting, there is a usage happening for last many years, established now. The incremental part that we are using AI is on the relationship side, not to market, but then we do have a virtual relationship manager, which is Aditi, creating a global buzz also on that particular relationship manager, which is covered by Gartner. Microsoft CEO talked about that. So that's more on the relationship side, making the customer experience much better as compared to the past.
I just wanted to mention again, I think, for example, we have fed in the entire FEMA, all our historical experiences of what RBI approves, does not approve, because there's lots of rules and there's this. So I think, for example, now when we get a FEMA query, it's much easier for our teams to be able to just say this will go through or not, rather than say, let me go to the RBI or come back or not, because we have historical, and the second thing is, for example, on our credit policies, we have made our AI engine digest all our credit policies, so the RMs know that whether specific types of loans, etc., will be approved or not. So I think you can make it micro or you can make it macro, whichever way you like it. But I think the sense is most organizations are not 100% in, nor are they 100% out. We are all discovering how much of AI we want to incorporate into which part of our daily and management routines.
My last question, how do you see in this disruption the next generation of banking reforms should be, how should they be shaped? Not that the first generation has been fully implemented, but they have been reasonably implemented. There are misses, there are positives in that. You had public sector bank consolidation, 27 to 12 or something. And do you see further consolidation in the banking sector coming with this threat of disruption, which will obviously put competition very high with the securities market firms and others? So what are the key points there?
I think one thing which is, which even from the previous cycle, which we should learn, which possibly is most important as we go forward, is that, as all the CEOs are saying, the amount of investment which is going into technology, cyber, or AI is mammoth. And each bank is spending thousands of crores, if you put it lightly. And almost all of them are doing the same thing. The areas of focus are broadly fraud reduction, risk management. We can list out the areas, but I would think the areas are broadly the same. I always wonder, is there a way to have a service or a tech stack architecture which is owned by the banks, which of course they can customize to? Meaning you got a off-the-shelf product which they pick and they customize it for whatever they, because I don't think so we can afford investments of this scale, bank after bank after bank. We need to.
But the nature, the future of finance would go into a differentiated lending.
I'm saying that's what you have a stack.
They will customize to each customer and deliver on the doorstep the financial services.
You have a tech stack which is on the shelf, but you take it and customize it. When you look at what does every IT firm do? They have a set of off-the-shelf products, and you say, what do you want, and then they will customize it for you.
Okay.
So I'm not saying the bank just does whatever has been given to them. You take the core product, core architecture from there and customize it for what you want to do for your customer. But everyone investing in that core architecture, everyone investing in the backbone, everyone investing the multiple thousand crores, to me looks like no one's going to go to get the ROI. To me, it looks like for the ROI and the investment across banks is going to take a long, long time. So we got to look at a different model because a lot of this is uncertain.
Fair.
You don't know the returns. You don't know when the returns are going to come.
Fair point.
We need to see, so the ability to take punts on what can happen is a lot higher if people can work together.
I guess that's why multi-factor productivity growth numbers are so low, because the returns would take quite a while. How many, do you think public sector banks should be privatized below 50% holding? Should there be further consolidation?
So see, consolidation is something which the government has to decide finally, but definitely on the point of view of the equity capital percentage of government, yeah, it can be definitely brought down to a significant level, definitely, because in future there will be requirement of capital as the banks are growing, as the economy is growing, more capital is required. The percentage of Government of India holding definitely can come down.
Any governance?
Yeah, no, I think banking, as we all know, is a unique business, right? There is no other organization in the world where you will give your cash and feel safe about it. Nowhere else in the world will you disclose your salary, but not even your wife knows, but the bank teller knows what your salary check is and all that. So it is a unique business, which I think many people don't actually appreciate sometimes except regulators and the regulated many times you feel, because you're able to create credit, right? I mean, you're able to create money, which is a magical power given by the license to operate as a banking unit. And therefore, if there is an index of governance, the governance in banking companies or banks needs to be at the top end of that index. You can't even be second best, because you are dealing with a very unique institution which is licensed to create money, and therefore, because you are licensed to create money, the regulations always have to be super tight and super good.
Last word, quick, short one.
No, I mean, there's absolutely a stakeholder call with regard to merger and consolidation. And as on today, if you look at the 2 rounds of consolidation, the banks have achieved a significant scale. And they're adding also significant profitability in that way. So further scale to add further efficient, actually that's a time only would tell, and the stakeholder would take the call on that.
Thank you. Thanks for the wonderful thoughts. I think we'll end us here. Thank you.
I request speakers. May I request Dr. Patnaik to please come on stage and felicitate our panelists. We also have a memento from IIM Kozhikode. I request the panelists to please be on the stage. We have mementos from IIM Kozhikode also for the speaker. Dr. Sagar, can you be on the stage? We have felicitation for our quiz winners. So we have the top 2 quiz winners who are here. Could we have you on the stage? Could we have the prizes for the quiz winners, please? Yes. Professor Chatterjee. So, Virat. Do we have the second prize winner here? Tushar Mishra, who is the second prize winner. Thank you so much. Moving on to our next panel discussion, we focus on a crucial pillar of economic growth, infrastructure financing. Infrastructure is the backbone of any economy, but financing constraints often pose challenges to its development. This session will explore solutions to overcome these constraints and unlock the potential for infrastructure-driven growth. We have an outstanding panel of industry experts with us today. Shri Raj Kiran Rai, MD, National Banking for Financing Infrastructure and Development. Shri Suresh Goyal, MD and CEO of NHAI Invit. Shri Rakesh Singh, Group Head, Investment Banking, HDFC Bank. Shri Govindan Ramaswamy, Senior Vice President and CRO at L&T. May I request all our panelists to please come on the stage. This session will be moderated by Professor Abhilash S. Nair, Professor of Finance, Accounting and Control from IIM Kozhikode. We'll first have a group photograph of all our speakers. Before I hand over the session to the moderator, let's have another engaging quiz for our audience. Get ready to test your knowledge. Could we have the QR scanner for the quiz? Could we have the QR scanner for the quiz? We have the first question. Most of them are getting it right. Okay, so the last one. Congratulations, Dhruv and Arjun. Please collect your prize after the panel discussion. I now hand over the stage to Professor Nair.
So India's growth story is a work in progress, and a very important cog in the wheel is India's infrastructure story. So the modern generation thinks of digital infrastructure, but there is a lot more still to be done in the basic brick and mortar infrastructure. So we have a stellar panel, and we're going to discuss a lot of the issues threadbare and maybe have some war room stories to embellish our discussion. So the National Infrastructure Pipeline sort of established almost a 20 plus lakh crore sort of investment needed annually. And the budgetary allocations, if we could see, have been coming down. So from 12.5 lakh crore to 11 plus crores. Where will we get this gap from? Where will we fulfill that? That's the important question we'll discuss. To kickstart the discussion, we'll have a small presentation from Mr. Rajkiran Rai, and that will be opening up our minds and a lot of issues for subsequent discussion. Over to you, sir. Thank you.
Very good afternoon. When we talk of infra, particularly for the investor, we have a lot of recency bias because we saw a lot of issues around infra in the last decade. So naturally, investors are not very attracted to infra. But then when we talk of Viksit Bharat and 2047, the 30 trillion economies, the biggest lever is going to be infra. So the highest investment has to happen in infra. And government is doing the heavy lifting at this point of time. But we are looking for more and more private sector investment. With that in mind, actually, this institution was created by an Act of Parliament in 2021. National Bank for Financing Infrastructure and Development. And in 22, we actually operationalized this organization. And as we talk, in the last 2 years, our sanctions are close to 2 lakh crores. And with the disbursements are close to 70,000 crores. And we are growing very fast, ramping up operations. And we have a developmental agenda. There are, because bond market development is an essential part of infra financing. Even though last 20 years we are talking about bond market development, but not much has happened except the AAA category and the G-Secs. So now actually the partial credit enhancement is a product which was a part of the budget speech also, where the NAFID is given that role to develop this product. So we are already into that, and hopefully this will trigger investment into the infra bonds with the credit enhancement coming in, and there are many other activities which we are doing as a developmental institution. Now at the macro level, I have a presentation that, that how this infra space is evolving. I actually many times mentioned that today infra asset is as safe as your housing loan. You have to forget what happened because there were many reasons behind what happened earlier. But most of those issues actually fixed. When I complete my presentation, maybe you'll have a better picture of what is happening in this space. So the content part is divided in 4 parts, basically infrastructure-driven growth, then the policy enablers which have come in the last 10 years, then channeling the financial resources to infra and the recent trends, and NAFID's role as a catalyst. So actually the infrastructure-driven growth for the economy, actually these are some points which we have, actually what the improvements we see. Enhancing productivity and efficiency. The World Bank ranks India 38 on logistics efficiency. Even Honorable PM speak about logistics efficiency because, with the GST we did the biggest turnaround. You would have seen the trucks waiting near the gates earlier entering state to state. With the GST, actually, we have cut down. If a truck used to take 7 days to reach from south to north, now it takes only 2 days. Okay, that efficiencies have already come in. But then the road, which is meant for this thing, that high-speed corridors are being built. Now we have the Western Corridor and Eastern Corridors, and there are many investments happening around this, both on the railways and the road side, and the port-related development on the logistics side. It is actually improving our efficiency, and we are already, this is the World Bank ranking, that we have made substantial progress. And on the power side, actually, we are self-sufficient. Today, we don't see that, where the power demand overshooting the supply. We have created adequate capacity, and the planning is on. Because for a high growth country like ours, the power consumption, actually the power demand is likely to grow around 4-5%. Planning that, actually, the country is planning, and once we realized the focus was on renewable, and once we realized that renewable is not going to cope up with the demand what our country has, again the push has come on the thermal, and this time we have seen the push on the nuclear side also. So I think country is planning it well so that we don't go deficit on the power, because this is one of the important factor for the productivity. And then 77 Gati Shakti multimodal cargo terminals have been commissioned, because these are the places where the efficiency comes in. Because when there is a delay, there is a cost. Actually, if you have to be efficient, your logistics should be the world class. Then the second part is the job creation and skill development. Because actually now the infra and manufacturing, the kind of employment they're creating are 11.4 and 12. So, the capacity to create more jobs. Now, for example, I'll say the shipping. Now, the shipbuilding and financing ships are becoming a part of infra as per the budget speech. Now, the kind of employment creation it can happen through this actually is phenomenal. Because we have the best demography in the world today, young population. We need to skill people right, but then there is a huge investment because they are coming under infra, so they'll get a lot of benefits out of it. Already there is a maritime fund created of 25,000 crores, which will kickstart this investment, because we have done it in the renewable space, we have done it in the road space, we have done it in the transmission space, where the financing models have evolved and where we are creating more and more assets without much problem. Now, this is another area where the government policy interventions will come and the support will come, and a lot of job creations and skill developments will happen. Since we have a lot of young population, actually, here, the young audience, I'll tell you, it is not the degrees which are going to be important, it is the skilling which is going to be important. You need to be very clear, and the academic institution also are tuning themselves, because everybody needs a particular skill, actually. So you need to identify which area you have to get in and develop those skills. Then it is a boost to trade and industrialization. The port turnaround time is one of the best indicators of how a country is evolving. Today, we have one of the best port infra, and actually these are all data which are available in the economic surveys and the World Bank reports. See, we are very efficient today, 0.9 days, it's roughly 22 hours is the turnaround time as per the latest data, better than USA, Australia and Singapore. So, we should feel proud that, our interventions and infra has worked. Today, we have the best managed ports and the efficiencies are very good. Because I don't know whether you realize, when the port is parked, when a ship is parked in a port for a few days, it is so much of waste actually. Because actually they are good in shipping actually, not waiting in a port for unloading their containers or the goods. So this is the efficiency we need, and government has approved 12 new industrial smart cities with an investment of more than 28,000 crores across states with the 8 additional sanctioned projects. Then crowding in private capital, because if you look at the NAFID site and the mandate, this is one of the big mandate for us, the crowding in the private sector investment. So the foreign direct investments have gone up substantially in the last few years. Particularly, there was a mention about INVIT in your quiz. Actually, if you, that numbers, if, on the REIT side, actually it is only 18,000 crores, but the INVITs, which basically take care of infra assets, one of the INVIT boss is sitting here, NHA INVIT, which helps the country's monetization. The investment which has come is 1,11,000 crores. It is very substantial, and we have the biggest private equity investors, whether it is the Brookfields of the world, Blackstone, or Ontario Fund, Canadian Pension Fund. Everybody has invested actives in the INVITs, and it's a substantial investment, and it's growing very fast. Actually, we are able to flip the assets on completion, when the cash flow stabilizes to these kind of structures, which is giving, see, these funds are coming repeatedly and investing more and more. That means they are getting good returns. So anyway, we will talk about the policy interventions which has enabled this in the next slide actually. So government is leading the way. I said we are doing the heavy, like the public spending or the government investment is the biggest spend today. So infrastructure capital expenditure has witnessed 20% CAGR from 21 to 24, because this is where actually the COVID and post-COVID period, like, where substantial budgetary allocations happened for the infra. So, and 14 lakh crores in 24, which is a budget allocation, and it is expected to reach 15 lakh crores in 25. The share of private investments are also growing at around 9% and likely to be 12% in 25. Similarly, the CRISIL estimates that the 24-30 period, it will be twice the investment what happened in the previous similar period actually. So we are looking at 143 lakh crores of infrastructure spend over a period of 24-30. That is almost doubling the investment. And green investments are also coming because these are very important. Actually, these also 5x today. I think the renewable capacity addition, you must be seeing the articles. India is doing the highest in the world today on the renewable capacity additions. Similarly, some graphs on the capital expenditure, because time, actually I will not get into this data. So these are the interventions which have happened in the last 10 years. On the top, I'm talking about the regulatory interventions which have happened and the government schemes. Actually, these are the structures on which this is being built actually. If you look at actually in 2014-15, we had hit a road bump, like, no investment was flowing because all the accounts were becoming NPA, there was stress, there was delays, environmental clearance was an issue. So the government came with the HAM model where actually the revenue risk actually got shifted to the government, particularly the NHAI. So it is only the construction risk. With that, actually, the capital needed for a promoter to build asset went down. Government started contributing upfront. And this was a model which is very, very successful. Today, on the financing side, actually, HAM models command the lowest interest rate in the banking system. Today, banks actually compete for this financing these projects. Actually, if you think that infra financing is difficult, you should go and talk at the HAM, this thing. Whenever the HAM project gets allotted, there will be banks queuing up to finance this, because that's a structure which has evolved, very successful model. And these projects actually which are completed, because these are annuity based, most of these assets are getting into InvITs actually, because this is a steady cash flow giving good returns. And after this, actually, we have also not seen much time overruns and cost overruns. Everything happens within time schedules. And the toll operate transfer models, which are again, the monetization part, basically on completed road, actually government is monetizing so that the money flows to clear the debt and also for the fresh investment. Then the PPP model, actually a lot of amendments have happened. This is where actually ultimately the foreign investors or other investors look for a solid contract on which this is based. This is very important, and the counterparty is very important. This is what happened with these new contracts and the modifications. We have SECI, we have NHAI, we have Power Grid. So these are kind of central counterparties owned by government, giving comfort to these contracts. And these contracts are also modified to an extent that private investors are happy with this contract, attracting more and more investment. Then the tax reforms have come in. Then actually the BOT model, that is actually, it was the earlier successful model which failed for various reasons. Now, in the HAM model, there is a lot of stress on the government balance sheet. Now, BOT model, ultimately, this is where the private sector investment has to come in a larger scale. Here also, now actually we are already talking about few projects coming under this model, and the ecosystem has evolved to take care of this, and I am very sure that, as this get launched, these will also get the same support. Here, actually, the risk is more on the builder, like the construction contractor, basically, because his revenue risk is on him, the toll collection, so they have to actually... I'll be quickly doing that, and these are the, government, the interventions creating a national infrastructure pipeline and the Gati Shakti and all that. This actually, very important slide. I'll cover this and close actually. If you see this, we had the highest NPAs in infra in the year 2014-15 around actually. So it was 22.6% and now it is around 2.8%, mostly resolved and closed. And the average default rate is around 4.6 if you look at the 2010 to 24 period, but now it peaked to 8.5 in FY16 and reduced to only 1.1% now in the year 24. So that when I say it is as safe as housing loan, housing loans are typically has a 1% default rate, and today infra also last 6-7 years the default rates are averaging around 1%, and actually in the investment grade is still less actually. So the median rating also of all infra asset classes, we have done a study of about 2,500 rated SPVs, and it is the data flowing from that actually. So that is what it is leading to that. And I will close my presentation here because this presentation will be shared, and the role of NAFID and all that we'll take up maybe during the panel discussion. We'll take care of that. Thank you.
Thank you for that insightful presentation that opens up a very, very important question. I mean, for a common person, a REIT is an instrument which has an upside potential, and an InvIT has limited upside. I mean, how much can roads and bridges appreciate? But as we see, you have about 25,000 which is raised, crores which is raised through REITs, but a 1 lakh crore, almost 4 times, which is raised through InvITs. What is the secret to this push?
Yeah, can you hear? Yeah. See, InvIT, if you look at the last, basically InvIT is what? You're buying land, building commercial infrastructure in that, getting rentals, and then monetizing it. It has got a permanent life because the land also is a part of the InvIT, right? So usually it gets around 6.5–7%. Commercial rentals are around 7–7.5% of the value of the asset. So 6.5–7 is distributed every year. Over a period of time, the rentals will go up in line with the inflation or the land price increase or combination, right? And that is what is put in InvIT. While infrastructure is a limited life asset, 25–30 years, whatever is the concession period. So you have cash flows. It's a cash flow asset, while REIT is more like equity. Land, the upside of land belongs to the REIT holders. The challenge we have had in the last 10–12 years, land, because of the slowdown in the economy, we had only 4% growth rate from 2014 to 2020, right? 4–4.5%. NPA problems, recognition, evergreening, all problems got sorted out. GST introduction slowed down the economy a bit initially. So lots of things have gone wrong on the real estate market. The prices, average price increase, commercial real estate is sort of almost flat over the 10-year period. Maybe it is 10% nominal, which is like 1% per annum, right? You have not seen anything over the last 10 years, and that is the reason the real estate market is doing very well now, because it has got a lot of catching up to do. You have not had any price increase, nothing has happened in there. It's getting reflected in REIT. After the work from home stuff, commercial buildings.
The surprise is the scale at which InvITs have beaten REITs with limited upside potential.
No. Because there have been no cash flows during COVID, right? Everybody, the commercial real estate market is what REIT is all aligned with. The cash flows have not been there, so it's taken a lot more time to come up. So the InvIT yield on a private listed InvIT yield, you get 12.5% for a 20 to 25-year period. In
So
REIT,
I think it's a classic
in REIT, it is only
clientele
6%.
effect.
REIT, we have got only 6% till now. So there is so as a company, we invest a lot more in InvITs because I want cash flows. I'm investing in yield product. I want cash flows. 12.5% return is spectacular even compared to equity market. Equity market from NSE, the day NSE, this building got formed and NSE got listed, average NSE growth over the last 30 years is something like 13.25% compounded. REIT gives you 12.5% compounded. I mean, it's as good as equity over a 30-year time frame. And post-retiral and post this thing, this is one of the best products. Like all my investment, post-retire investments is in
Yeah.
REITs.
So-
Is in
So
InvITs.
if I have to summarize what Mr. Govindan said, so what you're saying is there's a clientele effect, and people who seek capital gains would probably be benefited by investing in REITs, and those who want a regular income, they may be better off investing in InvITs.
Not just regular income. You look at it is as it's very low volatility, very low risk, no capital market movement, 12.5%. 12.5%, you will not get
I mean,
in
there
any
is
instrument.
no
Bank deposit-
surprise that the
bank
moment
deposits are at
InvITs
7.
open.
12.5 is like over a 20-30 year period. It's almost equivalent equity.
Correct. So there's no surprise that, the moment an InvIT opens, by the, within few hours, it's fully subscribed. So have you faced any regulatory challenges while raising InvITs? I mean, especially recently, SEBI raised, recently in the last 2 years, the amount that we can borrow or raise using InvITs from, I think, 40% to 70%. So does that affect investor confidence?
Actually, InvIT structure permits a 30-70 ratio. Actually, they can go up to 70% debt. But on an average, what you have seen, they are around 40. So they are AAA rated structures. All the InvITs are AAA rated structures because they have higher equity component. So we don't see a problem. There is no regulatory issue. There is only one issue bankers face because it is a trust structure. So this is not under Insolvency Act. So you can't take them to the insolvency route in case of their default. So that is one thing, but then hopefully this will also get addressed. But otherwise, we don't see a challenge. InvITs have taken off very well. There is a substantial investment coming into the InvIT route. And one point I want to add to what Mr. Govindan said, it is a supply of assets. In case of REITs, actually, we don't see that kind of supply of assets who are willing to flip it to the REITs. Because they are such good investments, everybody wants to hold on. Whereas infra, actually the supply of assets are so big, and the good quality assets, particularly the annuity-based model, that's why the supply of assets have made big difference.
Correct. Is there any stress testing or some sort of risk analysis that has been done on InvITs saying that, to what extent can I further raise capital through InvITs on a given asset? The traffic can vary, so many things can change.
So I think first of all, we have to put this in the context of supply and demand of assets and capital, right? And I think we need to broaden the definition of this a little bit from just a return and only a retail investor participation into InvITs. I think there's a much larger pool of capital that exists in the world and in India, which is on the institutional side, which is the pension and the insurance money. Now, they historically have allocated 10 to 15% towards alternate assets. And they are happy to take a long-term exposures with low volatility as a return expectation for them. So they normally are the ones that come into these instruments first. And I'll come to your question in a moment, but I just want to set the context of whom we are talking about when we are talking about REITs and InvITs. Retail forms a very important part of this, but retail is not the major part of capital that is coming into these assets, because these assets are, let's all accept it, these are complex assets. These are contractual agreements that exist between the concessioning authority and the concessionaire. There are challenges that come through, there are litigations that happen along the way, etc., etc. So now, having said that, these investors who are looking to kind of lead investments into infrastructure as an asset class, and InvIT becomes a very efficient vehicle for them to make the investment, are looking at this instrument from a conservatism lens. They are not looking at this from a high return lens. I think the point that Govindan Sahab was making and Rajkumar was making is that the issue here is that if the investor is of the kind who is looking at this as a conservative asset class, then the regulations may allow us to go to 70%, the regulations may allow us, many things can happen, but the capital allocator has to give us that capital, and they would be happier if we are also offering them a conservative case, which essentially means that the leverage has to be such that, irrespective of 50%, 70% or whatever number, the leverage is such that you would be the investor would be comfortable absorbing that risk should the world go topsy-turvy, like it happened in COVID. It is in a form and structure that even issues coming over the next 15 to 20 years in the infrastructure asset class can be absorbed. And that's how the management looks at it and puts it out. I'll give you one example of NHI InvIT, and that'll answer your question with regard to stress testing. When we started, we knew that we were launching this InvIT for the first time, and both as a product and as a concept was very, very nascent, at a nascent stage. So why, despite the regulations allowing us 50% leverage, we started with less than about 25% leverage. And the purpose was very simple, that the investor looking at it would say, okay, even in an extreme situation, I'm not going to lose capital. And the banks would be extremely happy to give us debt at 25% leverage because they'll be extremely competitive, and that by improving the whatever valuation that we have. With successive 3 rounds that we have done, we have gone leverage from 25 to now 43%, and we are at the cusp of launching the next round, which will take us leverage to 49%. When we are reaching 49%, but the size of the InvIT is 47,000 crores. Right? It's got 41 toll plazas, roads in 11 states, etc. So you're not investing on the road, now you're investing on the India GDP proxy. Right? So I think that's how we should look at it. The stress testing bit is already embedded in the way the proposition is put to the investors.
I mean, at 49%, I think, and you're enough buffer.
Yeah, absolutely.
So pretty safe.
Basically, you're not allowed. The regulation is clear. If it is a single asset, you can't cross 50. You can't raise cash, you can't raise debt and distribute dividends to unit holders. The leverage above 50 will have to be only for acquisitions. If they buy assets from the market, they can use additional debt, and if they take additional debt, and if they buy an asset which yields, let's say 4% higher, right? 4%, 3-4% higher, then the overall yield goes up, right? So it is not for standard assets, more than 50 is not allowed. It is only for acquisition it can be used. Even 70 is not possible for the same asset. You have to buy new assets, for that they allow leverage. So it's a very conservative stuff from a SEBI, you can't cross 50.
Interesting. So had I known about the quiz, I would have suggested a question. But since I did not know, let me say the answer and the quiz question right away. One of the biggest investors in Bangalore airport is a private equity firm called Fairfax, 74%. I think that's a success story that we need to trumpet across the world. I mean, a private equity firm having trust on the top management of a particular infra asset and trusting them to run the asset properly. So when such kind of deals happen, what are the kind of safeguards that private equity funds put on their term sheets? I mean, trust is one thing, but they would actually put certain tripwires. What would be some of these tripwires they put in a term sheet?
So if you look at airports per se, they're a very reasonably secure asset, because if you look at the DIL model, there's a hybrid DIL model and there is a user pay model. So if you look at So maybe if you look at the models, there is a TIL model, a hybrid TIL model, where you take non-aero revenues and they take aero revenues in a certain proportion. And there's some ones which you take only aero revenues as such, single TIL, yeah. So if you look at it's a very safe asset, because during the 30-year concession period, you have to redistribute whatever your capex is in the recovery in a user pay regime. Unlike the electricity sector, in an airport till now, no regulator has stopped hiking the user pay tariff till now. So airports have basically been on a single way. It has been the most, I think, successful asset, because the regulators have let it function the way it should function.
Okay.
Okay. So that's the single answer to your question. So if it allow the maths to function the way it should function, every industry will function, including electricity sector. to, and all bankers sitting here, most of us bankers and finance guys, if you allow maths to happen, then both sides of the equation will, adjust. Only when you interfere with the mathematics, that is when the problem starts.
I think that's to my a big credit coming from senior bankers for Airport Economics Regulatory Authority. I mean, they probably live by the line of feather touch regulations.
I'd like to supplement this question, and I'm kind of looking at the average age of the audiences here. So perhaps, we need to go back about 15 years here. So there was a time when there was a lot of private equity that was looking to invest into Indian infrastructure. I'm going back to the period of 2007, 8, just post GFC, leading up to probably 2013 when the Fragile Five happened in the macro. And pretty much the who's who of the international private equity world was looking to invest equity into India, and the rupee was 45. And at that 45 rupee, we were each holding about $1 billion of capital to deploy only in India. So even if you assume there are, let's say, 7 to 10 investors, we were holding at that price point about $10 billion of private equity to invest into India. Now, how has this story played out? And probably IIMK-NSE at some point in time would like to write a case study on that, because that story has not played out well. The risks that were taken, the risks that were assumed by the investors, how the regulatory framework evolved, I think everybody was learning on the go. And a lot of those learnings led to that capital kind of pulling back from the country. A lot of the capital was lost. And the fact is that that's why the point that the slide that was presented by Raj Kiranji is that most of the capex that is being shown to be put in now is actually led by the government. So 2.7 lakh crore that was shown as investments into the roads in the last, every year it's about 2.5 to 2.6 lakh, 7 lakh crore, has actually been led by the government now.
But that's actually a failure, because we are not a resource-rich economy. We don't have oil, we don't have gold, so we need private participation.
So that's possibly not the best way to look at it, and I may take a slightly, controversial position here. The biggest balance sheet in the country is the nation's balance sheet, okay? Anyone here cannot take a toll risk at the end of the day. No private sector enterprise can take a toll risk because we are going to build more and more of roads and more resources. So it is very important that we recognize that the risk can only be taken by a large balance sheet which takes it like a portfolio, okay? Right here you can see Nifty ETFs, right? If you look at a single stock vis-a-vis the ETF is less riskier because it pushes the risk across. And my friend Govindan, is possibly the master from all students can learn. One of the best risk managers in India is sitting here right in front of you. So you must learn risk management from him. But to the younger audience, I just want to appeal all of you, because all of you are change makers, and you have at least 50 years ahead of you, at least at the very minimum. You must encourage population to embrace user pay. If you use a service, you must look how we can pay for it. Because if you don't pay, the taxpayer will pay. If the taxpayer will not pay, somebody will borrow, the future taxpayer will pay. Somebody has to pay for it.
So building on that, actually our nation's credit rating is just about investment grade. So does sovereign rating of the nation hamper our access to a lot of funds that external PE funds or external funding agencies can bring into India? Be it pension funds, Canadian Mubadala.
I don't see. I think the largest players are the Canadian pension funds and the Singapore and all of that. They are the largest players. So basically the whole country is working, infrastructure is working for pension industry of Singapore and Canada and maybe US. I can't understand why Indian pensions and Indian provident funds can't invest. There is enough money available. We don't need foreign money. What you need is technology, which you don't do well enough. I can't understand why DeepSeek has to come in China, $10 million, you can do it. We say IITs and very proud, but hardly any innovation happens here due to certain reasons. So innovation and what he said on infrastructure Logistics cost 15% of the total economy, right? The normal commercial organizations pay 15% of the logistic cost. Normal international average is 4 to 5%. You have to go down to 6%, 9% will be the saving in infrastructure. The government is thinking about it. I think the Gati Shakti and all of that, the last mile connectivity. So there will be an improvement of 9-10% of productivity improvement because of logistics costs coming down on power and all of that. Then you need to have innovation and you need to have scale, right? Once you do that, India can be like China. It can be much, we can go forward, China forward, because today products and services consumed in India will not be made here. Products and services made in India will have to be consumed all over the globe, right? So you'll have to raise that bar, and infrastructure plays a significant role, very significant role. Innovation does play a role. We also have to innovate. There's a lot of innovation on the fintech related which the government has done. It has not happened from private sector. Private sector.
True, but then till then we need mechanisms to fund. Till the time
funding,
our funds.
I don't think funding is a constraint. Foreign funding has initially helped kickstart. I think some other provident funds are looking at infusing a lot more money. We need a lot more project finance institutions. NAFID has done a good job, but we need a lot more. Earlier used to have all the commercial banks used to lend. Because of the NPA problems and some of the issues 10 years back, infrastructure has become a bad word. No commercial banks lends, right? Good. So we'll have to create that mechanism or the incentive structure where the commercial banks also start, at least post-construction they should come in. Pre-construction risks will be taken, and the government agency should, as Rakesh said, user fees will have to be paid. Some changes in government organization is required. Today, if you look at Bombay, you've got MMRDA, you've got BMC, right?
Multiple
MMRDA
agencies.
owns assets, MSRDC, State Road Transport. So if something has to happen between Bombay to Pune, who will have to build the asset? Tax collection power is there with BMC, right? So cash flows are with BMC. Land is available with MMRDA in certain areas. Land is also owned by a lot of other state entities. Now, if you have to build something, how? So the bank, if NAFID has to lend to, let's say, MMRDA, they don't know what owning a road means. They have to learn to do it. And they have only land. They don't have cash flows. So the government, the way the states goes about doing it, there has to be some sort of reorganization. If they do that, cash is available. State government, it's possible.
Fantastic.
Central government is possible. It is not impossible. It is there.
I'll put some numbers into what Mr. Govindan said, because we do a lot of work around this. Actually, the insurance industry, because as the country is growing, as the per capita GDP is growing, a lot of savings is happening. What we see in SIP mutual fund is a very small portion actually. Insurance has 75 lakh crores under their assets under management. Okay. Insurance. Pension, PF, insurance put together, it is 117 lakh crores. It is 50% of scheduled bank deposits as we talk. So it is not small. And this 117 lakh crores is growing at very high double digits, where the government, like the scheduled bank deposits are growing, struggling to grow at close to double digits. So now if you take 117 lakh crores and a 15% growth, so you are adding 16, 17 lakh crores every year. And that is my infra need. We are thinking of 20 lakh crores investment every year. So what Mr. Govindan says, India is generating that kind of long-term liability. And insurance and pension needs 30-year bonds. And this is only infrastructure sector can supply this. So the money is there, only that bridge between that fund and the infra, that is where we come in by partial credit enhancements and many other products, so that that flow happens. Once that flow is established and once that money starts flowing here, we may not need, actually today when you are paying user fee, you are taking care of a Canadian pensioner, not an Indian pensioner. So,
so frankly speaking, I think we are a blessed generation to witness a time where, pioneers of Indian infrastructure say that we can find resources. We are not constrained by resources. We just need ideas. I think that's a very, very good note. So building on this initial discussion that we started this conference with, that is of trust. Now, trust is something like, damned if you do, damned if you don't. So to attract private investments, we sort of come up with model concession agreements which, accommodate for a whole bunch of things. I mean, some very, very supportive clauses like NPV protection clause. So we do all these kind of clauses. And then there can be times when the private sector doesn't rise up to the mark, and maybe they come up with their own interpretation of these clauses, and then this entire thing goes into arbitration. So if we do things to ease business, there is an issue. If we keep an iron curtain, still there is an issue. So the million-dollar question is, where do we draw a line?
I think NHI and some of these frameworks what has come, right? In banking, to call it intention to pay and ability to pay, right? Intention to pay is more critical than ability to pay, okay? If there is sense of fairness, which I think has come and in the road sector, you see a lot of fairness in the renewables, you see fairness in power transmission, right? That same sense of fairness will have to be there in multiple sectors, right? It is not there today. It is not there. It is an unfair, nobody, let's say if you want to do a metro under PPP, the government will, the public sector, the private will own. We have one and we suffer. Basically because all rights belong to the golden shareholder. Without putting in money, the government or whoever wants to control everything. I mean, typically that is the way it happens. And it can be in roads, it can be in any area. Certain sectors have been cleaned out in the sense that they have made it fairness as a primary area in which they use to attract capital. And it's in those sectors you have InvITs and REITs and all have come. Wherever it is not fair, fairness is not there, fairness quotient is not there, those sectors struggle. You have to have a belief, as Rakesh said, if you build a road, somebody has to pay for it, right? Now you need to have a mechanism to do that, and if it is there, all sectors can come into this. Infrastructure can be there in roads, sports, dam, even educational institutions. It's possible to do a PPP model. It's possible to do that. That sense of fairness is required. That fairness, if it is there, everything can be sorted out.
So just
it is there. We have seen it in 5-6 sectors.
So I just want to make a point, because a lot of your students here, whenever you take a project which has a completion period of any time, defined time frame, 2 years, 3 years, 4 years, in the capital sheet, you will do a minus, you will do this minus on an Excel spreadsheet, put dates there, calculate an XIRR, and then XIRR is arrived at. Any delay that happens in deployment of the capital has a cost of capital that keeps increasing. Very simple logic, yes or no? Yes? So if the cost of capital keeps on increasing, but the user does not want to pay a higher fee, then who's going to pay? Govindan pays for it. And when Govindan pays for it, then he becomes very unhappy. And actually, this is exactly where, in sectors where there is fairness, by going by principles, so if there's a delay, somebody has to pay for it. And that should come from the institution or the concession provider to ensure that the cost is taken care of by them and not by, and that is what the change that has happened in NHI, which is why NHI has been the single largest implementer of road projects, I think possibly in the world today. Yes? Suresh?
Yeah, no, that's correct. That's correct. And just to supplement to all those points is because I belong to that organization. So I think the whole BOT program started, the PPP program started with them only. And in their history for the last 20 plus years of PPP program, never they have changed a concession agreement with retrospective effect. All changes have always been brought with prospective effect by grandfathering the previous clauses. Now that makes a huge change in the way the investors look at it, right? And that confidence that has been built over successive years of multiple rounds of concession agreement give people the confidence that yes, I can continue to deploy capital. And that is why on one side the government is putting a lot of capital into building the roads, and the second side is then they are looking to then monetize those roads through InvIT and other modes, again which is attracting a lot of capital, both from the retail as well as from the institutional side. So again, a personal experience I would like to give you, and anybody interested in the audiences also need to reflect on it, that it is in the nature of the contract that there will be some litigation or there's some arbitration or some conflict that will come through. Particularly if these contracts for 10, 15, 20, 30 years or so, the world changes and this will come through. I think what we have failed as a nation is not only to factor what will happen, but more importantly to, with a sense of fairness, create a platform or a basis for us to have that dialogue and resolve that. And indeed, if that conflict turns into an arbitration or a legal case, how to resolve it within a meaningful time frame. And again, here, the beneficiary of all this in our inefficiency has been, surprisingly, not surprisingly, been Singapore. Most large arbitrations happen under SIAC, SIAC structure, in which our own conflict, our own lawyers, our own promoters, our own capital actually takes a flight, goes to Singapore, pays the SIAC fees, pays them the fees, pays their legal fees, etc., settles arbitration and comes back. I think that's where we need to fix it, for us to really talk about large monies to come through. And then money is not a problem. This is a core problem for us.
I think that touches upon the root problem, the root cause of all the issues. That is a fairness in arbitration process, wherein we take it at an arm's length and resolve it.
There's one more issue actually. So since there are students here, there's one more issue actually. There is, and I guess Raj Kiranji is absolutely the right person to expand more on it. If you look at project planning, okay, when you plan a project, the depth of detail that has to go into project planning itself is a very big issue. So if you are from Bombay, for example, and if you look at the ceiling, okay, the ceiling turned one fine day in a certain direction into Worli. Now we are rebuilding the ceiling in a different way. So any changes in project, how you build, how much detailing you are going in, the topography, the kind of surface which you are using, the kind of materials that have to be used, all that, the project planning is a very critical skill. And the changes in project planning lead to what is called a change of scope, okay, which is what goes into roads more say, sometimes in transmission project, much lesser into thermal or even renewable energy projects. And that is a very key component which leads to these changes which Suresh was talking about. And any concessionaire will go back and represent to the regulator that these things have changed, how can I get compensated? And that is where the issues start from. Either it starts from project planning issues or time delay issues. Those are the two critical big issues from where the dispute starts. If it is settled on time, a lot of this can be ironed out and resolved much quickly. It is getting done, but the faster it is done, the better it becomes. Raj Kiranji.
Yeah. Actually, the root cause of most of these problems what we face is in the DPR. Actually, there is one minister, famous minister, who speaks about it regularly. If the DPR is prepared properly, then we don't have so much of problems. Actually, the root cause of most of this infra-asset problem is the DPR. If it is not assessed right, actually, where it passes through, what are the environmental issues it can face, the land acquisition issues. So many of these are settled through Gati Shakti. Now, if you look at the Gati Shakti portal, this is where a lot of things are getting addressed. Actually, Gati Shakti evolved. Anything above 500 crores get listed in Gati Shakti. And this is a very, like a lot of technology support in this. And if you look at this website, where all the government departments sit together. So after this, actually, if you have seen the infra project implementation in the last few years, we are not seeing time overruns, cost overruns because of the support which comes from Gati Shakti. They are able to see upfront, because if you put a project, it will give you exactly where it passes through, which are the lands it will pass through, which survey numbers, how much is government land, how much is forest land, all these things get fixed actually. So ultimately technology is a solution for most of this problem, but any DPR preparation which is not factoring into this issue will lead into this problem. But again, coming back to this, we tend to highlight the problems more than the solutions. Today, comparatively, most 90-95% of the projects are getting executed in time. So we don't see a cost overrun, time overrun. Actually, I have funded now maybe about 160 projects. We have hardly 5 projects. They are not into trouble, but then there is a time overrun or cost overrun because some land acquisition issue, and that not because of the promoter. So what has happened is the quality of promoters who are executing projects have gone up. And again, the board governance there, again, if you look at all the renewable players, look at their boards. There is a private equity investment and there is a, lot of directors sitting there who are very professional. There are professional people sitting in every board today. So the governance standards of these construction companies also have gone up everywhere. So I think qualitatively, things have gone up, like what Mr. Govindan mentioned, like, these kind of projects actually. Here actually what has happened, actually while metros are very important in urbanization, because the next phase actually, having got our energy side right and the road side right, and maybe ports right, airports right, now the focus is getting into urbanization. There is an Urban Challenger Fund already, like, which is launched and all that, where these metros and urban transport will come in. I'm very sure these issues also will get fixed, actually, because there's a realization. Because having invested so much money, you're not making the returns, and if they're forced to take a burn, actually, I have seen L&T doing PPP projects long back. And last 10 years, they have stopped. And if a company like L&T is not into PPP, what else we are looking at? Because, ultimately we have to address the issues what they face. The biggest, actually today, the order book of L&T is 10 times more than anybody who is next to him. That is the kind of order book they have. And if they're not doing PPP, then we should understand there is an issue. So we need to address this issue on the contract side.
Yeah, I think not just in building infrastructure, even contracting framework, that QCBS, we had a quality-based framework which the government taught. It's not been implemented at all, right? So that sense of fairness which I mentioned, it is not there for even in contracting business. I'm not talking about owning a project, I'm talking about even construction. It is there in certain sectors, like what he said, roads, renewable energy. There is a sense of fairness because the ecosystem is built like that. It has to move to a lot of other areas. If you look at a standard, let's say hydrogen, can it be under PPP? Can I make hydrogen and supply to a large public sector company, right? Hydrogen, they need to have hydrogen, green hydrogen is required. Can I do that? It's possible. But as an owner of the project, typically you will see that fairness will not be there. They push all the problems to the guy who's owning it and all that. So it's not there in every sector. It is there in 2-3 sectors. That's it.
Here is the concern now. Look at how we have all on the stage avoided one question. We said power sector is nice, we have reformed, but I think we have addressed a part of that, that is transmission is safe. But distribution, I think the power economics is, it's not appropriate. So we have a long way to go as far as power sector reforms are concerned. Maybe if I may just use some cliched terms here, that is the less fair of the assets, those are the ones still in the government kitty. Whereas the fair ones, which are in a better domain where regulations exist, revenues exist, they are the ones which are amenable to funds from the private sector. So we need more of the fairer sector if we need more funds.
Yeah, that is because the users don't pay the charge, right? Why
That's
power
right.
sector is in
Absolutely
trouble? Because you want to power at 1 rupee and then give subsidies, right? It's political. So that's the reason those things have to lie. If you want to give subsidies, then it will be with the government only. It has to be with the government. Wherever that fairness is there, it will move to the private sector.
But yeah, but in a forum like this, I think we need to realize and highlight that there is a fair side of the infrastructure and there is a not so fair side where other considerations come into play.
Like you have a beautiful coastal road, fantastic. It is not tall today, right? But I keep thinking, I used to that coastal road daily. I would be very happy to pay because I know that money will go and develop some other asset somewhere, right? I think it should be there, but you have to do the existing assets. There are lots of assets are there in the country which can be monetized, and then money is available for new assets. As long as you have fairness, lots of things are possible. I mean, to have, I was just doing how big India's market cap can be. Right now, what, $3-4 trillion, right? I was just thinking whether it is possible to go to something like $100 trillion, right? Possible. In 40 years' time, 30-40 years' time.
Power of
it's
compounding.
possible to do that. But if you have to do that, you have to do work on the ground. You have to create that fairness, you have to improve productivity, education, all of that. Produce goods and services, which is globally required. Be at the upfront of innovation. Have great infrastructure, improve productivity. I mean, you'll go back to 1200 AD where people have seen that Ponniyin Selvan, 1200 AD, India's GDP was 45% of the world. We are at 4% today. It can become 40% of the world. Why not?
So we'll just take 1 minute to wind up and put out prescriptions for the future. So could each of you say what you have experienced and what is lacking, and say 1 or 2 suggestions that would address those issues?
I think looking forward, we have to look back a little bit. So while we feel very happy about how much the investment has been done in infrastructure, but since it affects all of us, it affects the quality of life. We are still under-investing into infrastructure because as a percentage of GDP, we are still not crossing 30, 33, 34%, which doesn't lead to much. So on a nominal basis, it's growing, but GDP is also growing. So if you look at last 10-year data, 15-year data, I think it's hovered between 30 and 34%. We need else exists. And from my perspective, I think what we need to really think about is resolving 2 constraints. How do we ensure domestic capital comes into infrastructure? And second is how we strengthen the contractual frameworks so that people feel confident putting capital behind it.
So Suresh has already talked about 2 very important facts, which is the strengthening of the contractual infrastructure, increasing domestic flows. So adding basically drawing 2 very basic fundamental points, which as students you are learning. The first chapter is time value of money. That can never go away whenever you do, whatever you do, and that has to be seen in the context of any infrastructure project that is getting implemented. So the project has to give returns, it has to pay, and that will translate into a user pay regime, which means every user which uses any service, whether it is electricity, healthcare, roads, transportation, metros, airports, will need to pay for it, and that culture has to come in. Whether we use a cross-subsidization mechanism till a fairness comes in completely is a different matter, but a user pay regime has to come in the minds of every citizen of the country. That's a very important, and it emanates from the time value of money. And the second thing is, I think a lot more importance needs to be given by youngsters like you in project planning. I do believe that if you plan things properly, then the surprises will be much lesser at a later date. And you need not plan for a short term. And a good way to look at some of the cities which we inherited from the earlier, prior to independence, there are certain infrastructure which is built, which is still lasting us after 75, 80 years. So we must examine how did they think and how did they build that infrastructure with what kind of things in mind. So today, a high-speed rail corridor may look, why are you spending so much amount of money? But 10 years down the line, 15 years down the line, who knows? Look at how our airports have changed. All airports were thought, why are you building terminals? Look at how overcrowded our airports have become. So we need to build infrastructure. We need to do planning better so that once we plan, it is good enough for 20, 30 years, and we are not revisiting those plans at a very frequent intervals.
Yeah, I will give a different perspective. Today, government does the heavy lifting. If you are allocating 14, 15 lakh crores for infra and project financing from the budget, actually this money can be better spent on healthcare, education, because that is where the investment should flow. But actually why government is pushing money here is because if you are looking at growth, actually unless you put this kind of money, growth will not come. But then actually we have limited resources, so budgetary allocation is going up every year on this. Actually the private sector has to come in and lift this load so that this money can get into the social infra, education, healthcare and all that. That's the ideal situation. Because like you can't increase your income substantially, so this is the way you can. So for the private sector investment to come in, a lot of enablers are already in place. So our target is to see that the remaining sectors also, like, the agreements are such and the DPRs are so good quality and, the investors come. And actually success, see, institutions like us are working on this. Government is very keen to fix all those issues which are affecting, the private sector investors who are not coming in, so that the concession agreements are getting redrafted. The legal, like, you would have seen in the aircraft side there was issue. Recently we saw that government came in with amendment to see that in future we don't have that problem. So like that, no, government is very quick to respond and these issues are getting fixed. The success of all this will be seen when L&T bids for the first PPP project.
I have nothing much to add. It's just say fairness in whatever do other areas other than the roads and transmission line and solar, right? Fairness increase and quality will have to be super focused. We can build a thermal power plant with Chinese boilers, which will work 10 years, and after 10 years, you can use it to make tea. वो power तो नहीं निकलने वाला है वहाँ से, right? They sell, I mean, but if you look at the costing, it will look cheap. If you look at a good quality boiler, it will work for 50 years. So there's a difference between 50 and 10. We are all short-termism. We will have to look at long-term quality as a country. If you do that, life will be good. I think it will grow somewhere.
I have to add one point. I just recently read on Twitter, which is a very important point, said that, you know, when Japan tariffs were imposed on Japan by America, then what Japanese did, they accepted the tariffs, but they adopted a simple philosophy that we will only use Japanese goods. Time has come for Indians also to think like that.
So let me summarize that the key thing which we have learned is we need to channelize domestic funds through institutions, through private sector, to infrastructure so that it leaves some space for the government to focus on social infrastructure, which will be in the long run adding to our capabilities. So thank you for a very enlightened discussion, and I think this forum was a very important place to air these concerns. Thank you to the audience.
Thank you.
Thank you to all our panelists for a very engaging and insightful discussion. I request Dr. Tathankar Patnaik to please come on stage and felicitate our panelists. I request our panelists to please be on stage. We have Professor Ashok who will give the IIMK code. So you may give it to our staff, they will pack it and give it to you. We'll now break for lunch and we'll assemble at sharp 1:50 to start our third panel discussion. Request you to please. Oh, sorry. Oh. So the winners of the quiz, we'll have the presentation after the third panel. So please come near the stage after we have done with the third panel discussion. We'll begin at 2 p.m. Welcome back, everybody. After a refreshing lunch break, we now shift our focus to an exciting and transformative theme, harnessing new technologies for creative disruption. The world is witnessing unprecedented advancements in AI, fintech, and digital finance, fundamentally changing the way businesses operate. To guide us through this fascinating discussion, we have a distinguished panel of thought leaders and tech innovators. May I call Shri Manish Gupta, Director of Google DeepMind, India. Srimati Rohini Gupta Srivatsa, CTO, Microsoft India, South Asia. Shri Ranjan Bajaj, ED, Northeast Small Finance Bank and founder of Slice. Professor Ashok Thomas, Professor of Economics at IIM-Kozhikode. This session will be moderated by Professor Rudra Sen Sharma. He is Professor of Economics at IIM-Kozhikode. We wanted to have a group photograph first. Okay, before we go into the panel discussion, could we have the quiz, the QR for the quiz? The QR for the quiz? Okay, so scan the QR and you can join the quiz. Let's have the first question. Okay, the first first question is on the screen. Next. Next. Next question. Okay, 65% got it. Next. Next. Okay, so Arjun and Sampuran, please, you're the winners. Please collect your prizes after the panel discussion. Also the winners of the second panel discussion, you may also come to the stage after this session. Thank you. I hand over the stage to Professor Rudro.
Thank you very much. So, good afternoon. I hope all of you enjoyed your lunch, but don't doze off. We will try to disrupt your post-lunch nap with this panel on creative disruption using emerging technologies. But if you doze off, we will just pretend that you are deep in thought, using deep mind, seeking deep. Okay, so enough with the poor jokes. This is a very important topic, as you know. There are so many disruptions happening in the technology space, and no sector, no space of personal or business life can escape the changes we are experiencing on the technology front. So we have a power-packed panel, and we have a lot of interesting questions to discuss on this theme on emerging technologies and creative disruption. So let me start right away with Rajan. Rajan, Slice is known to be a disruptor in banking. So, how do you see Slice or in general creative disruption in the banking space? What kind of disruptions you think we will be seeing in the coming years in banking and finance?
Thanks for having us here, Rudra, first of all. I actually don't like the word disruption that much and to be labeled as a disruptor. But creativity, on the other hand, is a very interesting word. I think, I don't know about most of you, but I don't understand how creativity works. I believe many people do not. But I have some sense of it. It comes from a place which is beyond all of this. We don't know how it comes to us, how we become creative at some moments and other moments we are not. So it's something that I believe is still beyond our understanding. But there's some elements of it which we all can feel and relate to. Like, I think fundamentally creativity is about finding out some form of a truth that once you see it, you cannot unsee it. And to me, when you say Slice is a creative disruptor, we want to be on this path of truth seeking where we figure out some pieces of the puzzle, which we have taken thousands of years to build this financial service industry, but there are some pieces of puzzle which can still be much more efficient than they are today. And they've been built by people like us only. Like, we have had 100 billion people living on this beautiful earth in the last 300,000 years. We're 7 billion right now. So these 93 billion people built what we have today. There's a lot of respect for them. They've done a wonderful job. There's a, but we cannot meet them today. So our only way to thank them is to build on top of what they have done, and there's a reason they have done what they have done. But be able to understand, and understanding is also a form of creativity, why they have done what they have done, and then after you understand it, being able to get that creativity from some other place and being able to tweak it a little bit, to me, that's everything.
Okay, thank you for setting the context, Rajan. Let me come to a very specific disruption. So if you have been following the news and social media, you would have heard of something called Majorana 1, which is a huge leap apparently in quantum computing, which Microsoft has announced a couple of days back. So I'll ask Rohini to tell us a little bit about how exciting is this, and is quantum computing going to solve climate change, find a cure for cancer, make all our problems go away? So how big is this disruption?
Okay, let me first, how many of you understand what quantum computing is? Okay. Maybe for the rest, I'll give like 30 seconds. So today when we work on computers, every information is stored or processed as a bit, which means it is a 0 or a 1. In the quantum world, which is actually the real world, every piece of information is a superposition. It is somewhere between 0 and 1, nobody can tell where it is. And that is the idea of superposition. There are similar such very interesting physical phenomenon, which is what quantum computing uses for a paradigm shift in computing. It was conceived by Richard Feynman many, many years ago, and a lot of companies have been in a journey to harness the quantum nature at very deep subatomic levels to create a new paradigm in computing. Now, what was referred to as the Majorana is a different approach to developing what is called a qubit. Qubit is the basic building block for a quantum computer. There are many other approaches, and there are organizations, IBM, Google, Honeywell, many others who have been at it for many years and have been creating different approaches to creating a hardware qubit. This approach we are as an organization betting on it because we believe this approach leads to scalability, leads to better, more reliable, less noisy qubits. But it is again a long bet. And I think I would leave with saying that some of these technology bets are just that. They are long-term bets, and you have to have that ability to put some of these bets in innovation, because the time length for some of these disruptions is neither predictable nor certain.
Rohini, if I can just add, your comments reminded me of this conversation more than 20 years ago. I was at IBM Research in those days at the US. There was this strategy meeting, and there was this technology person who was talking about how CMOS technology and so on is running out of steam. And he said, we need something. We need a plan B. Then this person said, and there was already a team at IBM Research in those days working on quantum computing. He said, what about quantum? He said, quantum is my plan Q. Right now I need a plan B.
No, actually it's a very good point, because, I mean, again, right, to your point, it is again a technology that will not solve every possible problem. People who are looking at quantum as an approach to computing are looking at some very special class of problems. Just like when you do numerical math, etc., you solve very special libraries to solve special class of problems, this is also going to be an approach for a special class of problems. So don't expect it to be replacing classical computing anytime soon.
Okay,
or
so
if ever.
okay, okay. So we have to, moderate our expectations a bit. Manish, coming to you, let us talk about generative AI because everybody is curious about it. So whether it is Gemini or any other kind of work that DeepMind is doing, like Alpha Protein or Alpha Code. So where do you see the possibilities in future? So are these the biggest disruptions we have ever seen in the last 100 years? And where does the future lie?
Yeah, so while there is a element of hype, at least we feel that yes, there is a certain hyping in the short term, but for the long term, we believe there is actually under-hyping of AI as a technology. We believe it is going to be just like if you think about industrial revolution, IT revolution, we believe this is going to be possibly the most profound invention humanity has ever had, and it will shape basically every industry, every aspect of the world. So very specifically, kind of, why is generative AI such a big deal? So I mean, and if we think about the history of AI, it started as a very broad field, and there were many, many approaches to AI. There was one approach that took off, which was machine learning, right? Maybe making machines learn from data. And then machine learning started out, again, there were so many different approaches to machine learning. There used to be all these support vector machines, various kinds of regressions, and so on. And deep learning, which was based on artificial neural networks, which in fact, in the early 2000s, the machine learning community had pretty much like given up on artificial neural networks as a technology that just doesn't work, which made a comeback, right, in the form of deep learning. So what was special about deep learning was that after they showed those breakthroughs in image classification, identifying what object is in the image, very soon after that, pretty much for a very broad class of problems, be it speech recognition, be it machine translation, all kinds of tasks, deep learning became the best way of solving those problems. But still there was a problem. There was an issue, right? That you needed lots and lots of labeled data, often millions of data points, labeled data points before you train a model. And B, for every problem you had to train a new model from scratch. And that's the problem which now has been tackled by the current generation of foundation models. In fact, the reason for the term foundation models that was coined by Stanford researchers is that these models today are providing the foundation for a very broad range of solutions that be it any kind of task, ultimately. So it's very surprising in hindsight that there's one architecture, transformer architecture invented at Google Research, which is underpinning kind of such a broad range of applications. So one in the short term that we are quite excited about is this whole notion of a universal assistant that each one of us, every person on the planet will have available at our disposal very, very powerful universal assistants, right, which would help us lead healthier lives, learn, kind of plan our careers and so on, right? Various aspects of leading a more fulfilling life. But one aspect which I think doesn't get enough attention in India, so any opportunity now I get, I try to talk about it, is the potential for AI to accelerate science, scientific discovery. And this year's Nobel Prize, right, you mentioned AlphaFold, are a sign, are a signal, very powerful signal that something very profound is happening. Protein folding, again, back to my IBM days when I worked on a machine called Blue Gene, protein folding was one of the driving applications. That can we understand the mechanism of protein folding using simulations. In those days, it used to take almost like 3 to 5 years of PhD level work, research, to uncover the structure of a single protein. It used to take about 5 years. And after AlphaFold kind of came up with this AI model that works, now it takes about a second to, given that chain of amino acids and so on, to predict the structure of the protein takes barely a second. And this team basically made the structures, or at least predicted structure of all 200 million proteins known to humankind freely available, and AlphaFold freely available. So today, again, researchers are using it for all kinds of exciting things like drug discovery, even designing plastics. But it's not just biology alone. You now look at chemistry, you look at physics, pretty much every aspect of science, you see, again, the impact of science, of AI being felt. Something like, which is very, very important to the world, right? Clean energy. Fusion, if we can make fusion actually generate more energy than the amount of energy it takes to get a fusion reaction going, controlled fusion, not the one on the sun, it could be an abundant, provide an abundant supply of very clean energy. And there are, again, our researchers, my colleagues, I just met them 2 weeks ago, who are working with these fusion kind of startups. They believe that in the next 2.5 years, right, we will reach that point, 2.5 to 3 years, we will reach that point where you get more energy out of that controlled fusion than what you put into it. So again, possibilities are endless. It's going to be a very, very exciting world. So certainly the students in the audience, I'm always very envious of you because, I mean, I entered my career when I opted for computer science when I'd never even seen a computer at that time. And you are entering your careers, right, when you have all these very, very powerful computing technologies and AI through which you can make a difference to the world. So it's going to be a very, very exciting world.
Yeah, indeed. Yeah. So as one of those ancient Chinese curses go, may you live in interesting times. But we are glad that we happen to live in a very, very interesting time. So we talked about the possibilities of quantum computing, generative AI, or AI in general. Now moving from big tech to fintech in terms of financial applications. So Rajan, what is your view about how these technologies are changing the world of banking and finance? So, can AI help to address problems of financial inclusion or financial literacy? So how is it impacting the industry?
So there are two big use cases that we see in the next, let's say, 5-year horizon. One is all the search is getting replaced through AI, which means most of your UI is search in a way. When people are doing onboarding, they're trying to figure out which category to choose. Am I salaried? Am I freelancer, etc., etc. Then what is my income stream? Where am I getting money from? So what we have all done is we have designed very generic selection UI for all types of customers. But that's going to go away. AI is going to completely overshadow UI. And we'll be able to ask a farmer in Shillong or in UP in their own natural language that, can you explain me more about the way you earn this money, the way you have your expenditure? And that will be the new UI. That will help increase approval rates, that will help increase conversions. People will move more towards this formal way of accessing credit and financial services generally. And the other is a form of thought partner or coaching, etc., which is basically customer service in the financial services world, but also some form of a banker assistant. Like you will have a bank CEO at your disposal. It will not actually be a bank CEO, but the feeling that you get is like a bank CEO because contrary to many people's beliefs, I think humans will have much more bigger role to play, powered by AI, even in customer service. Everyone wants that personal attention when things are not going right. But by having access to the tools that we have now, humans are going to be able to service 100 customers with the experience of bank CEO level experience. And those 100 customers will feel much better than they feel today. Their problems will get solved faster and more accurately. So I think these two things will eventually lead to more access to credit and much better customer protection consumer experience, the NPS scores could be much better with the standardizations.
So that sounds fascinating that, giving a CEO level experience to the customer. But as Manish said, each of us are also going to have our own AI assistant. So I wonder whether our AI assistant will end up talking to the CEO AI of the company and then advising us in turn.
Yeah, I think that's what is going to happen. We're going to have multiple models also, not just a UI AI assistant. Under that AI assistant also we can choose the model based on who's a better thought partner to us. Like finally these models are like some form of a thought partners, like humans. So we can pick and choose, this is the kind of thought partner I like more under the UI layer, and then that thought partner is talking to some other company's thought partner which they have chosen based on their taste or the kind of company they want to be. It just makes a lot of sense.
Right. Okay. So let's talk a little bit about the economic impact of all these technology developments. So I'll come to you, Ashok. In terms of economic theory or economics research, how do we see the impact of these technologies on aggregate GDP growth, per capita income, long-run prosperity? What are the macroeconomic effects?
Professor Rudra, I'll answer in two ways. One is on productivity, other is on inflation, which are the two bedrocks of sustainable macroeconomic growth. So the economic theory basically worked on, from Paul Romer, I would say, basically understanding innovation as the key for long-run growth, right? And productivity, output per worker basically increases. There was a problem in the neoclassical economics by Solow telling that after a point of time, US would stop growing and Ghana is going to converge. But that never happened. The empirical theory saw that US kept on increasing. That's precisely because of the innovation, the amount of money which has been put into R&D, and there is an invisible value of theta, which I could relate with Manish, the ability to basically create new ideas given the stock of ideas. So it is a trait of certain countries to basically do this. So once this has picked up, we had this tremendous productivity growth, which almost stopped by 2000, 2010, I mean, close to this GFT. So then we had a productivity slowdown, and this productivity slowdown is a matter of concern, which though we are telling that R&D expenditures of most of the countries have gone up, but productivity has not improved over time. So this is precisely been studied in academic literature, and some of them point out that small companies, because they are small, are willing to innovate more. And it is the non-corporation, or less competition at some point of time, regulations helping bigger companies to innovate much faster, or could be that the web of patents, which is not allowing diffusion of knowledge happening for smaller companies, which could be the reason why productivity growth is not increasing. But coming to the second important point about inflation, which is a growing concern. Economic theory basically talks about, let's say when technology goes up, inflation basically comes down. This is a there's a recent paper on financial innovation which looks at aggregate advanced economies and emerging economies, and you see that 10% increase in internet usage in India increases the GDP by 1.67%, and inflation reduces by 0.06%. Now, how does it work out? By simple economics, we could say that when innovation happens, digitalization happens, well, there could be a reduction in marginal cost, which you have studied in your class, and therefore prices, cheaper goods come, and consumers can have second. Second is online presence allows people to basically choose a lot of things, and which forces companies to reduce their margins, and that's how inflation can come. Innovations in digital spaces, especially fintech spaces, etc., therefore allowing access to credit to go, and cost of credit comes down. Labor markets, basically digitalization helps in creating or reducing demand for certain goods like automation, etc. takes out. Wages comes down, and these things can basically significantly influence innovation. So what, at the end of the day, economic theory basically talks about innovation as a key driving force for economic growth, long-term growth, productivity as well as reducing inflation, which are the two important macroeconomic objectives of every country.
Can I ask? I think in the context of India, just to your comment, is it only about productivity or is it actually about access to certain services like, or being able to have inclusion, meaning a greater number of the population being part of the economy with education, healthcare, skilling, etc. I mean, how do you think about that? Because that to me is more than productivity, right?
Exactly.
Just curious about your comments.
When it comes to, let's say, digitalization, there should be two complementary factors which should work out. One could be the education, whereby these skilled people could use digitalization. Second is the role of governance, which basically improves the quality of living and make sure that corruptions are less and it reaches, the benefits reaches every one of them. So it's not only productivity, but there should be complementary factors which should help this to
So yeah, so I think we get too focused on productivity in terms of purely GDP per capita, but you're right. I mean, unless that translates into overall well-being by providing access to each of these social infrastructure to the people.
See, I think for India, if I may just build on that point, I think for India, the greatest opportunity is the ability for a very large section of people to have access to healthcare in their language using AI at where they are. And I think that bridge, I mean, Chandra has written a very good book called Digital Nation. I keep quoting that all the time. But in sectors like, think of education, now the ability for a child, for a student to have a personal tutor, that changes the whole equation of access to education, access to opportunities. I think for India, that is the greatest opportunity and maybe Manish can build on that. But to me, I feel, you know, we keep talking, sorry, I picked up on the productivity, but I think we talk about demographic dividend, we talk about, you know, skills and all of that, but the way this today's AI is able to cross the language barrier, cross the barrier of the AI can see, can hear. You can show it a crop that is spoiled and can tell you what is potentially wrong. That changes the paradigm of access to information, opportunities, health, at a scale that could not have been possible earlier. And to me, India, that is the greatest opportunity.
You wanted to...
So I absolutely agree with Rohini, and if you allow us to kind of feed questions, right, for ourselves. I mean, that has been the entire focus, at least of my team in Bangalore, since we started our journey 5.5 years ago. I consciously picked this theme of inclusive AI. And being in India, I felt it was kind of our responsibility, right, to think about how do we develop AI in a manner that brings benefits to everyone, especially the billions, right, who have previously not been touched by AI in the world, and definitely hundreds of millions of people in India. And what at least our experience has been, it's been very, very gratifying journey, because a lot of our work has not only led to kind of tangible benefit, right, that we have seen to people in India, but beyond India. Like, it has led to global leadership in certain things. I'll give you one example of languages. An obvious area, right, for us to work on was make these models work, right, for Indian languages. And there is a big gap between capabilities of all models, be it OpenAI's ChatGPT, be it Anthropic, be it Google. The capabilities, the quality of the model on English is far better than the quality of the model, right, on other languages like English and so, like Hindi and so on. So our team has been working on making these models massively multilingual. Part of our work prior to Gemini to build that previous generation of model work over 1,000 languages allowed the Google Translate team then use that model that our team built to, in one shot, they added 110 new languages to Google Translate, covering 614 million new people whose native language was included for the first time. And the joy that it brought, I mean, it was heartwarming, some of the messages we saw from people. And likewise, I mean, even sometimes it takes you in unexpected paths. So, like another team that I told, I gave that direction that make our AI models work on these mobile devices. right? Because mobile devices are the only digital device for hundreds of millions of people in a country like India. So as they develop their technique, that is when this whole LLM revolution happened. So, and this became a multi-billion-dollar problem on the high end, on the servers, because it's no secret. I mean, I'm not even sharing any confidential data. I don't have access to confidential Google data. I pick it up from the public statements that Google, Microsoft announced, right? They are investing $80 billion in AI, hardware for AI. Google announced $75 billion investment. So every company is investing tens of billions of dollars per annum in hardware that is serving these Gen AI workloads. And our team's work has already gone into kind of giving significant efficiency benefits. Because a lot of those techniques were previously developed for mobile phone, but then when adapted to servers, they ended up delivering extremely large gains, again, giving at least a lot of, we take pride in, okay, Gemini 2.0 being extremely, in fact, it was great to hear Rajan telling me privately that, one thing which I really like about Gemini 2.0 is very fast. I said, okay, I'll convey the compliments because our team's work has gone into making those models very fast. So there are all those benefits, right, that you get by pursuing that path of inclusion.
So continuing on India, one of the things that everybody talks about is the technology battle is being fought between USA and China. US is investing billions of dollars. Stargate project is going to spend $500 billion. And then China has come up with DeepSeek, which costs much, much less. So where do you see India in this? So for example, Rohini, when will we join this race, and what is Microsoft doing in India? Do you see any investments in this direction, and where India will stand in the future?
So the answer, okay, let me take an India view and then a Microsoft India view.
Yeah.
I think India has shown some very promising approaches, if you think about some of our India stack, Aadhaar, UPI, etc. Innovation at scale, at price points which are to be compared with the rest of the world. I think AI is one place where, while India today is adopting AI and needs to do more of it, whether it is from the government side or the startup side, I'm looking at those two lenses. So the government, as you know, has an India AI mission, and that has got fairly comprehensive plans to create the AI ecosystem in the country. What I do see is the place where India will adopt AI is from the startup side. Because I feel the startups are where their ability to disrupt, their ability to see the technology and its potential and connect it to real problems in a way that is economically viable and grows at scale. We had the previous panel, remember, and was talking about the willingness to pay. And I think that ability to create those viable business models is where I think India has the strongest ability. Now, the second point I would say from a Microsoft perspective, we've been now in India for 30 years. Microsoft Research has been in India for 20 years. Very recently, we celebrated that. And a lot of the work that happens, just like Google Research, a lot of the work that we do in research in India also has a fairly strong social impact element. So if you've heard things like Digital Green, if you've heard things like Karya, Bhashini that you know is the national language mission, a lot of these have spun out or have had contributions from Microsoft Research. Having said that, I think the one organization, and of course from a investment perspective, our CEO was here recently and all that will keep going. But I think the ability for India, our young people here and our startups to really understand this moment, this technology, and what is the art of the possible with this technology today, and grab problems and take that risk and go after them with an entrepreneurial mindset is, to me, the need of the hour to be able to capture this moment. No one company, the large Microsofts, Googles of the world are going to do this for India. That's for India's youth, India's startups, India's entrepreneurs to really do. Microsoft, Google, all these are providing platforms. These are platforms to help you accelerate any innovation, experimentation that you want to do. But at the end, the last mile of problem solving, value creation, scaling has to be done by entrepreneurs.
Manish, absolutely agree with Rohini. And if I could, again, back to your original question, right? In fact, I've been propagating for a long time, long before DeepSeek entered our public consciousness. I had been arguing, despite being at Google, right, and providing our foundation models, that yes, India should be developing its own foundation model, right? Multiple organizations in India, right, should be developing foundation models. And there was that kind of a, whatever, sometimes what I feel, and sometimes people say, oh, is it money, or we don't have the money, we don't have the talent. I've heard a lot of these arguments. And my view is very simple. It's not lack of money, it's not by any means lack of talents. It's usually lack of ambition, lack of boldness, lack of guts that comes in the way. A lot of times we in India, we are very scared of doing, if there's anything that has never been done ever in the world before, we are very scared of doing it. And we are very skeptical. Oh, what if there's a fail? What if it doesn't work? We are very afraid of failures. And I think space is a technology, we were talking earlier, which has shown the way. I mean, ISRO has, despite being so far behind, right, starting so far behind other nations. In fact, we were hosting Dr. Narayanan, ISRO chair, at our office 2 days ago. And it was such an inspiring talk. He talked about how he was a child in a village in Kerala when he heard the news about man reaching the moon, and how far behind India was when the space program started. And then he reeled off a whole bunch of things where India is the first country in the world to have done it, right? Things like landing, soft landing on that other side of the moon, launching a set of 100+ satellites in one go from a rocket. The Mangalyaan, the cost at which we did it. So I think we have seen some shining examples, right, where people have had that guts to go and do things, right, first of a time in the world. So to me, in a way, it was disappointing that it took DeepSeek for people in India to now arrive at a consensus that, yes, we should be building foundation models. But then I say, der aaye durust aaye, the Hindi saying, okay, better late than never. But going forward, I hope we will have the guts, the confidence to do things which have never, ever been done before.
In fact, I remember discussing with some people who, and I will not name, that I think it's time for India's Mangalyaan moment in AI. Exactly those words. Because the ability to think differently, to use free gravity, it was different.
The last word hasn't been heard, right, on how to build foundation models. If we take inspiration from how the human brain works, human brain does all of that computing at an estimated 20 watts in power consumption. These days, right, every company, be it Google, be it Microsoft, every company is now negotiating deals with nuclear power companies, right, to power the next generation of data centers because of the amount of power consumption. There's got to be a better way, far more power efficient ways. Yes, my team has done some work showing you 2x, 3x, maybe in some cases 10x gains. But we need to come up with innovations that will lead to millionx gains in power efficiency.
Since you talked about the need for Indians to think differently, so I'll just go back to Rajan, who thought about banking and credit differently. So Rajan, do you think that using technology, fintechs will eventually replace the brick and mortar banks? Or do you think fintechs will force banks to become more like fintech and less like banks? So will banks and fintech coexist, or will they all converge to one model, which is the technology model?
I think the right person or right set of people to ask this is RBI. Because finally banking is a very regulated sector. And it's for the regulator to decide how they want banking to go in this country. But generally speaking about the world, there are various examples. So there are some countries in which there are deeply regulated banks which are protected from some of these disruptions, so to say. And then there are thin layers of fintechs which are allowed to operate at a slightly more higher level with very niche areas. Like in Brazil, you have Nubank. They're not a full bank in Brazil. They have a license for doing money transfers through credit card-like instruments, and then they have a license to take deposits for very specific things where they can invest those deposits in. And their full banking license has very different set of regulations. So in a world where things are changing so fast, like literally 12 months back, there are, I was just talking to my engineering team last week, there are 5 different companies that exist now where we are trying to figure which one to choose from, and these companies didn't exist 12 months back, and all of these companies are going to make our work 2x better, 3x better. In a world that is moving so fast, it has to be the existing systems, going back to the previous analogy of existing systems and all these humans that existed in the past, they built that. We will have to find out how they have worked, why they were chosen, and then build on top of it. There's no option only. Like, there are clearly inefficiencies. For example, we have $420 billion of cash in circulation today. If you count for like 4 to 6% inflation, there's a loss to the person who's holding the cash, right, to the extent of $25 billion. There's $750 billion in savings bank account. And these days, millennials and Gen Zs have become smarter. That led to some of the stock market boom in the last 3-4 years. But they're looking for alternatives on if they're putting money in savings account also. And the risk-free rate in India is somewhere determined by the benchmark repo rate, which is at 6.25% today. But if you're keeping money in savings account, it's not like you are completely beating inflation. There's still a lot of inefficiency. And a lot of people don't realize that, don't understand that. If you're earning less than 50% repo rate, 40% repo rate on this $750 billion, there's still almost the same amount of loss from inflation that is happening on cash. And people will get to learn more and more these things through better coaches and thought partners, and they'll be able to make more informed choices. So there is no choice that we have. We'll have to become more efficient from where we are today. But the pace at which that will happen is a very, very nuanced and complicated subject. There is a lot of existing architecture, and these kind of things can lead to financial stability related questions also. So that has to be very well thought through and then decided by a committee somewhere by the right set of regulators.
But quick follow-up, big data firms have far more data than startups will be able to have. Although Rohini talked about the importance of entrepreneurs and startups pushing the curve, but do you think fintechs can compete with big data? I mean, Amazon obviously has more data, or even Netflix or Google, than a fintech firm.
See, I agree with you. They have. So actually, let me say this. Like, right, where do we fit in as humans, right? If you're saying there's so much of AI that is going to change things, and they're all thought partners. They're like very intelligent. They have access to infinite memory, and they can instantly recall that. These are like compression models which have never been built before, and it's a spectacular technology. But where do we fit in finally? We fit in our agency, right? Finally, we have to choose. Even if the customer support is talking to the customer, my agent is talking to the customer support of some other company, finally I'll get a response, and I have to choose whether to be angry at that response that I got or be happy with that and just move on with my life. So I can still choose to be angry that, hey, this is a very bad response. What are you talking to me? This you don't understand, you don't want to service the customer properly, and that will lead to another response by the thought partner. And again, I have to choose whether I'm satisfied or not. I got the resolution. So that agency is what we all contribute to the world. That's our value. And that's where small startups will always remain very relevant, because over time, like the larger companies, somewhere it becomes bureaucratic and you lose that sort of agency, right? And people follow a certain system, and that's where startups come in, and with the agency they have, the kind of focus they have on smaller problems, they find niches that eventually become very large. All the big companies in the world finally are like that. So that doesn't change as long as we all exist, and there's no true AGI that comes in.
So you mentioned agency also of the customer. So that brings me to the issue of financial literacy and digital literacy. Because again, when we are talking of things like access, which Rohini mentioned earlier, we need people to have that. And I know Ashok has some interesting research on financial literacy and digital literacy. Can you share some insights on how do you see the importance of digital literacy or financial literacy?
I see on the right side, I have Rajan, who is a supplier down here, and there are some regulators like, let's say, Mridul Sagar, ex-regulator, right? But I bat for the household, right? The household at the end of the day has to take a decision, a financial decision, how much I have to save, how much I have to invest. Now, there could be an agency which is there, and that's the agency which we talk about financial literacy. And it has to be financially inclusive. It has to be representative to the whole Indian population. So some of our research basically worked with women entrepreneurs, and we tried to see in this growing digital landscape, if we are given digital financial services, if you give them a financial training as well as a digital training, which will work for them? Will they improve their financial decision making? So fortunately, some part of it has worked. So for us, the digital skills have improved. But unfortunately, the financial literacy has improved. The knowledge has improved, but it has not translated to good financial behavior. So then we thought about the possibility that it is possibly because we have given them training on a workplace, or maybe the training should not be given on that age group. So right now, there is a research team at IIMK-NSE, which I am also a part of. We are giving training to young students of age 11 and 12, because we find that the financial attitude is forming at that time. So why don't we give a financial knowledge training, which would basically change their financial behavior? So once there's a gap between financial knowledge and attitude is reduced at school level, which can improve their financial behavior over time. This is also good for the NBFCs or banks, because you would have a more careful customer. You would have a more careful lender. You would have a person who would be thinking about saving his money rather than spending it all the time, right? You would have a person who use productive loans rather than using it for unproductive purposes. So that's the way the research is going in India. And that's a very important area of agency which we are trying to solve. And we want to see that whether giving at the school level works out, then we should basically make it as a public policy to improve financial literacy at school levels. So which could solve our financial access problem, inclusivity problem, and decision-making problem of households, future households, in a much better way.
So while we are trying to improve their agency, obviously they are still exposed to a lot of cyber threats and financial risks. So what is your view, Rohini, on how can we manage cyber security risks that the general population gets exposed to?
See, first of all, I think today we know that there is a lot of problems of fraud and people getting scammed, etc. So there's a lot of that going on, which goes back to, it may sound trite, but it goes back to awareness. Because I think in a country that is getting digitally enabled, whether it's from perspective of, in fact, I was going to talk about that even to the earlier thread, but I think the ability for people to, and I'm in my mind, the common person I'm having in mind is let's say, middle income woman sitting at home, right, who may not be going out to work. How do you get that person to be digitally aware? That is probably the biggest challenge that the country is facing. But I think the ability for AI, since we are talking a lot about AI, to also look at patterns at macro level, ability to look at digital signals, be able to look at certain fraudulent pockets. Some of those becomes a lot more feasible and even accessible if you are using the right technologies to be able to help in some of the triages. But you see, it is not a one-size-fits-all, because at the end of the day, if the country is moving in a direction of increased digitalization, and if you're going down the path of further e-commerce and the fintech revolution that we are part of, it will have to go hand in hand. Now, of course, there are organizations, startups like Equal, etc., who are also going down the path of being able to create agency at the consumer level. So it is not just at the provider level, but also at the consumer level. Can you have AI being able to have an interception to be able to create a diversion to then figure out if this is a fraud call? So there's the technology elements of it, but there's a lot of people element that comes into picture, especially if you think about financial services and issues of fraud.
So something you mentioned, how do we improve the digital literacy of the, let's say, the poor woman entrepreneur? Can AI help in doing that, to improve digital and financial literacy of the poor entrepreneurs, women?
Yeah, I would say so. I mean, so in fact, one example is, there are examples at all different levels. On one hand, I've also seen Google's team up with some singers who created this beautiful song that went viral on YouTube. Google ke sang milkar gao, scam lage to mauka gawao. Right? So one is awareness, right, about all of these scams, the way these scams spread, and how do you kind of protect yourself. But also there are things you can do at the technology level, because Android, for instance, my colleagues have been working on, can you ultimately, even in a very privacy-preserving manner, analyze the conversation and start to warn people that, look, this conversation seems to be taking a turn where it looks like a scam. And in fact, my colleagues from Google Pay, they very proudly tell me that, yes, they have employed all these AI-based methods, and their estimate is that they, just last year alone, I think their estimate is they helped save fraud on at least 41 million transactions and kind of covering a lot of money.
I think, just to add to what Manish is saying, I think, some of the basic cybersecurity hygiene factors, passwordless, multi-factor authentication, some of those things will have to become hygiene, especially we've got young folks in the crowd here. I think for you folks at your own personal level, are you following multi-factor authentication? Are you following basic hygiene factors in terms of how you manage your passwords, etc., right? So I think those things you will have to learn, because as your life becomes more and more in the digital world, your ability to be both aware as well as pretty smart about managing your life, your assets, your aspirations in the digital world will become important, that you learn aspects of cybersecurity and privacy.
So on that note, since you guys are the creators of these new technologies, which has impact on all our lives, without going into the debate of whether technology will replace jobs or create new jobs, what kind of skills or mindsets do you think professionals should try to adopt to survive in this digitally turbulent world? Any advice?
Yeah, so to me, it starts with fundamentals. Certainly, I think everybody should start to educate themselves on certain fundamentals. And the other thing is just learning to learn. You have to, instead of fussing about, okay, what are those skills that are going to prepare me for the next 10 years or 20 years and so on, just be willing to learn. Because technology will keep evolving, the world will keep changing at a very fast pace. You have to be just prepared to keep learning. And some of the fundamental kind of skills that at least often people have been talking about are things like empathy, creativity are going to become more important than ever.
Any thoughts?
Yeah, I mean, see, today, like for example, Rajan also was saying about your personal assistant, right? Today, I mean, I'll give you a very simple next step. Whatever next you are doing, if you pause and think, how will AI help me do this better, differently, faster? That is the first question you need to ask, because today it is so accessible, so easy to use. I mean, for me personally, I don't go into any meeting without first asking a co-pilot, how should I prepare for this meeting? And the ability for AI to go into all kinds of files, into the web, in fact, it asked everybody on this panel what all backgrounds they have and helped me prepare before I got here. I mean, basically, the point is that your ability today to do anything that you're doing, make AI your friend. Make AI your friend, that mental attitude. There is no some big list of things that you need to prepare for. Make AI your friend today.
Let me try to end with some crystal ball gazing. Let's try to hear your bold predictions about the future. So what would be, each one of you, if you were to try and make one prediction about the future disruption in finance, technology, or fintech? Rajan, what would be your prediction?
I would say probably the UI will not exist the way we see it today. Yeah. So that will lead to maybe in India, for India specifically, for example, UPI is used by 300 million people. It'll probably be used by 800 million people because the kind of UI that we find intuitive, many people do not. It'll lead to people understanding things far better because they don't have to search for it. They can just speak in natural languages. Another prediction I'll make is on what you were asking earlier, like what do people need to learn more? I think languages. So we are moving to a level of abstraction which is natural languages. So world moved from assembly to Python earlier, where we used to speak to hardware in very low level languages like 0, 1, but we moved to Python, which was a big thing. Now we're moving to English, Hindi, and all these other languages. So our ability to understand the languages, being able to negotiate with AI will matter much more than probably learning about maths and social sciences, etc.
Ashok, your prediction for the future?
On a lighter note, I want my AI to catch all the students who have copied on my exam using their AI, right? But that's a lighter note. But I see great potential of AI in education, particularly for a faculty like me, where I don't have to use a lot of time to grade, which is a very monotonous exercise. And instead, basically, also create content which resonates with the students. That could be one of the most important thing. And secondly, on research front, I would believe that AI and the gamification can solve some of the pressing issues which we are trying to look at from the point of view of financial inclusion, or could be training at what ages, continuous training, etc., and looking at their behavioral patterns over a period of time.
One bold prediction?
Yeah, so at the macro level, I see a world of abundance where we have free energy, where pretty much we have cures to all of those diseases and so on. But of course, humans are pesky animals, right? They always create problems for other humans. So I do worry about how do we then utilize AI in a manner, right, that we amplify the good of it rather than the potential to do harm. And then at a very micro level, building on the theme that Rohini started talking about, right, is this inclusivity. Whenever I've been challenging our team working on languages, right, I often talk about that laborer's daughter in Chhattisgarh, right? How do we give her access to the same level of information as you and I, right? Those of us in this room who are the privileged ones who understand English, how do we give her access to that same level of information in her native language? Now my aspirations for that laborer's daughter are bigger. Now I think about how do we enable her to do Nobel Prize winning work in the future, because she will have access to the entire scientific literature of the world, any kind of learning and so on, right, would happen. But mind you, Nobel Prize winning work in the future is going to be require a far higher bar, right, than a Nobel Prize today, because enabled by AI, a lot of what counts for a Nobel Prize today, right, will become ordinary.
Rohini, your prediction?
I think predictions in technologies is, I think the only prediction I will make is that the pace is only going to increase. It's only going to increase, and I think each person, your superpower is going to be your curiosity. Your curiosity, because the questions just remain to be asked. Answers are there.
There is this saying, prediction is hard, especially of the future.
Yeah, that's a good one. So the panelists have specifically requested me to take a couple of questions, so I have to oblige. Can I have any question from the audience quickly? Keep it short and quick. Yeah, over there. Go ahead, go ahead. You can stand up and just speak quickly and loudly.
Yes, very good evening, everyone. So, my question is, what framework are needed to govern the integration into financial institution, and how can we ensure that AI-driven decision-making remains transparent, fair, which is very important for us?
How can AI-integrated decision-making be fair?
Yes.
So I think there is a lot of work that organizations are very intentionally doing on the broader area of responsible AI. And responsible AI, one of the key elements of that is fairness. Now, fairness as a term is actually, if you've thought about it deeply, is actually quite nuanced. It's much more than equity, it's much more than equality and inclusiveness, right? So I think there is a lot of tooling happening, there is policy making that's happening. Today, if you say that are all, let's say, hiring machine learning models, are they all fair? No, because many of them, the data that they have used from the past, the data has biases. That is why organizations have tools and techniques to help understand if the data that was used has hidden biases in it. But it is not just a tooling problem. It's also organizations' ability to understand what are the techniques they are using. But the broad area of fairness is, to me, part of a suite of considerations that one needs to think about, including privacy, security, inclusion, accountability, transparency, that are responsible AI areas that many organizations, including Microsoft and Google, are working on.
So just to add to that, I think Deputy Governor in the morning, Rajeshwar Rao sir, he gave a simple answer to that. He said that it has to be explainable. So if explainability is not good, we'll have to create systems where humans are auditing it for explainability, and hopefully 95, 98%, 99% time explainability is good directly from the models, but if it's not, there's a system in place where you ensure explainability is there, and that will lead to fairness, just like our judiciary system, for example.
I would disagree on that a little bit. The reason I would say that is because human beings, we think we are fair, but we are not always. There are hidden biases. That's number one. Number two, explainability is one of the principles in responsible AI. It's slightly different from fairness. If you say explainability directly leads to fairness, you're making an assumption that any human who's able to look at an explainable model is always going to make a fair decision.
I wish this had come up a little early so we could have had more time, but in the interest of time, I have to close. So big round of applause to our fantastic panel. Thank you, everybody. Thank you.
A big thank you to all our panelists. This was a very interesting conversation. I request Dr. Tithankar Patnaik to felicitate our distinguished panelists. I request the quiz winners of the second and third panel to please come near the stage. The IIMK mementos, could we have them, please? Do we have the quiz winners? Yeah. Dr. Patnaik, we have the quiz winners. So, could we have you on the stage one more time, please? Yes, yes. So we have Dhruv. And Arjun. And we have Sampurna. Thank you. As we continue, we now focus on a topic that is at the heart of the financial markets, market innovations and growth. Capital markets are evolving rapidly, driven by innovations in trading, regulatory changes, and investor behavior. We have an esteemed panel with us today to discuss how market innovations can drive faster growth. We are joined by Shri Anant Narayan, whole-time member SEBI, Shri Subodh Roy, MD Crisil Ratings Limited, Shri Nilesh Shah, MD Kotak Mutual Fund, Professor Arvind Sampath, he is Professor of Finance at IIMK-NSE, and this session will be moderated by Dr. Tithankar Patnaik, he is Chief Economist at NSE. Could we have all the panelists on the stage, please? We'll have a group photograph. Before we before we move into the panel discussion, could we have the quiz for our participants? So we have the QR. Let's have the first question. Next. I think this is the last one. Congratulations, Arjun and Venkatesh. You're the winners of this quiz. We'll have you after the panel discussion. Thank you. I hand over to Dr. Patnaik.
Thank you, Ashana. The theme of AI, the theme of intelligence has permeated the program today. It didn't matter what panel we had. We had banking in the earlier part of the day. We had technology right after. But the only questions that we were discussing was technology. That's it. That was the only topic. And frankly, when Rudro, my friend of many years, was asking questions, I was thinking, there goes one of mine, there goes another. But I will give my panel the full flexibility to answer those questions anew. Thank you, Rudro. So some of the topics that I want to look at, after all, we are at NSE here, and the idea is to see how AI, how technology affects capital markets. And so some of the topics that I would like to explore with my esteemed panel here today would be in market innovation, the need for regulation to keep pace with technology. How would technology affect the core of our activities here, market microstructure of the markets? How would it affect investment strategies, market access? How would we look at sustainability, ESG? How would we look at market integrity? And of course, we do have this collaboration now with IIMK-NSE. So it would be amiss on my part to not discuss what could be done with the industry and academic collaboration in this regard. So I would start with the regulator in our midst here, sir. How, sir, can regulators balance the need for fostering innovation? Innovation is everywhere today. The idea is to support innovation with the imperative of course, maintaining market stability and, of course, investor protection. How would we balance that act, sir?
Thank you, Tirthankar, and thank you, NSE and IIMK-NSE for putting this together. Actually, this question that you asked goes to the core of what the regulator's role really is. So those of you who've had the misfortune of reading the SEBI Act, which is not an easy act to read, it starts with the preamble of defining the 3 pillars by which SEBI has to swear by. The first pillar is investor protection, the second is market development, and the third is market regulation. All 3 put together, the role of SEBI is to ensure there is sustained capital formation in the country. Often, if you look at the press, if you look at the coverage, it appears that SEBI is this watchdog with a danda looking to beat up people. That's only a very small part of the role. The easiest way to ensure nothing is going wrong would be to close all markets. Then nothing wrong can happen. But that does not lead to sustained capital formation. So we've got to anyway find this balance between ensuring investor protection and ensuring market development such that sustained capital formation happens. Now, many of you have tired of hearing me say this, but I will say it again for the nth time. There are 2 types of errors that regulators like SEBI can make. The first is the type 1 error, where we allow bad things to happen. So if a Harshad Mehta happens, if a Ketan Parekh happens, then all of us here will say, what was the regulator doing? Sleeping at the wheel. Sabko pata tha ye ho raha hai, sirf tumko nahi pata tha ye ho raha hai, tum log so rahe the. So as regulators, we are petrified of any type 1 error, and we want to avoid it at all points of time. The less talked about error is the type 2 error, where in our zeal to prevent type 1 errors, we come with a regulatory framework that is so onerous that even good people cannot do business. And we don't talk about that enough. But I can assure you that at least SEBI does look at both type 1 errors and type 2 errors very, very closely. We try and consult with market participants to get the right balance between type 1 and type 2 errors. And this is where, the analogy with type 1, type 2 in statistics kind of fails in my view. In statistics, it is impossible to minimize both type 1 and type 2 errors simultaneously. However, in regulations, I think with adequate consultation, with adequate application of mind, you can minimize both together. And that remains our goal. It has always been our goal. It continues to be our goal. Going forward, given that the landscape of capital markets is probably going to change dramatically in the next 5, 10, 15 years, with all that's happening in AI, all that's happening with quantum computing, all that is probably going to happen in robotics and the real economy, I think we will see more of these changes coming through. And our task is cut out to ensure that we minimize type 1 and type 2 errors, even as we ensure that capital formation continues in the country.
Sir, if I pick up on that theme, just to pick up on that theme. So one part is, of course, investor protection. The other dimension would also be providing a level playing field. With technology, one of the themes that one hears about India is, from a macro perspective, the great digital divide. The gap between people who have access to technology, who are able to use technology, and the others who are catching up. In capital markets, this gap in some sense becomes exacerbated because of the much higher stakes involved. How do you see that, sir?
So let me break this up into 2 parts, Tirthankar. First, I think this bridging of this digital divide, we are actually doing a reasonably good job, and we is not regulator. I think it's the whole ecosystem, including mutual funds, including the exchanges. So let me throw some numbers at this. As of March 2020, the number of unique participants in India's capital markets, in securities markets, which comes under SEBI's ecosystem, was about 4.4 crore people. Today, as of January 2025, that number has crossed 13 crore people. So it's actually more than tripled in the last 5 years or so. And especially after the pandemic, we did see a lot of fresh people, especially young people, coming into the capital markets ecosystem, both via mutual funds as well as directly into the capital markets through demat accounts, etc. The unique number of mutual fund investors today has crossed 5 crore. Now, 13 crore is arguably still a long way to go, because the number of PAN Aadhaar linked numbers, unique numbers, is, I believe, something like 60 crores. That's what the CBD data shows. So you can argue that 13 crores has a long way to go, depending, of course, upon disposable income, etc. But the pace of growth has been quite rapid. I think, in fact, there is a need to differentiate it, Thankar. If you ask me, one area which requires a lot of money to flow in is this area of startups. After all, if we have to create new businesses, if we have to become the next, create the next DeepSeek, if we have to create or be a part of the next revolution of robotics, etc., you've got to make sure that greenfield, fresh startups have a line of funding available. Now, here is where the challenge really comes up between investor protection and ensuring that people get access to capital. And here is where I think there is a lot of work to be done by the collective ecosystem, where people who are risk aware, people who are discerning, people who are financially secure and therefore can take on risk, should be allowed to take on this risk without the regulator worrying too much about investor protection. I know this is controversial, but globally you have this ecosystem of accredited investors who are discerning people, who have financial heft, who understand finance, who can do their own due diligence, who know what risk management is, who are risk aware, who are risk capable. Do they really require the same level of protection that a 250 rupees SIP investor in mutual funds requires? So I think making that distinction and ensuring that accredited investors are allowed to seamlessly invest and fund growth into startups which are high risk kind of situations might be one way to ensure that we join the rest of the ecosystem, the global ecosystem, in leading the change rather than following the change.
I would fully agree, sir. In fact, in terms of numbers, we have you call a unicorn, which is a startup with $1 billion valuation. In India, you have over 100 of them at this point. In fact, in 2022, India led the world in terms of having new unicorns. We did 30, if I remember right, in that 1 year alone. And to your point about accredited investors, about 20 basis points of all the investors that trade in the country, just about 20 basis points, contribute to roughly 75% of our turnover, if I look at activity in the cash markets. So the concept of an accredited investor becomes very, very logical in this case, where there is scope for providing an easier way where they can understand the reward, risk return reward, that ratio. But I will now make a pivot, actually. I'll look at investments. And so from investments, I wanted to ask you, Nilesh, mutual fund Sahi Hai has worked out rather well in this country. So let me just give the context to these things. Across the world, what happens is when markets become more and more matured, households' direct investment into equities comes down. The share of households who invest directly into equities come down. They go more into indirect investments, managed investments like mutual funds and ETFs and so forth. In India, somehow, both have taken place. So while we have seen, as Anand pointed out, the number of investors has increased significantly, the mutual fund Sahi Hai has literally become very Sahi Hai. So the number of investors today who have mutual fund accounts is about 5 crores. How do you see this panning out, particularly with access to technology becoming easier now?
So, good afternoon, everyone. First of all, we need technology or AI through which I can go to lottery buyers and tell them that भाई लॉटरी के धंधे में बेचने वाला ही पैसा बनाता है, लेने वाला कभी पैसा नहीं बनाता. But India's most educated, literate state spends more money on buying lottery than investing in mutual fund or equity. Then I want to use AI to go to people who are keeping $400 billion or 35 lakh crore of cash at home and tell them that भाई इसके ऊपर कभी पैसा नहीं बनेगा. करेंसी नोट हमेशा दुनिया में डिप्रिशिएट होता रहेगा. म्यूचुअल फंड में डाल दे, थोड़ा ऊपर नीचे जाएगा आज की तरह, बट इवेंचुअली तेरा पैसा बनेगा. Then I have to go to all those people who are swinging between greed and emotion, greed and fear, and who are willing to invest a 2% guaranteed return into anyone who is borrowing money. The latest one is Taurus in Mira Road. So I have to convince all those people कि भाई जो दिखता है वो सच नहीं होता. You have to invest in regulated entity. We may give you shock for a while, but eventually we give you pleasure. But ये लोग तो initially pleasure देंगे, बाद में shock ही देंगे. So I need to create AI and technology so that people's greed and fear can be managed and they become decision maker through rationality rather than emotions. This is top-down approach. Bottom-up, I have to be worthy of their trust and confidence. People put money because they trust. There are many PSU banks which were making losses, but people didn't run to take away deposit from them because they trusted those banks. Mutual fund industry has to become as trustworthy. Now, trust is gained over a period of time. When I started my career in Templeton, Sir Mr. Charles Johnson, founder of Templeton, told us that mutual fund will be like a bamboo tree. You have to keep on watering it for years and years and years, and one day it will grow. At that point of time, I neither had the maturity nor the vision to appreciate that statement. But today when I'm living that, I feel, yes, mutual fund is like a bamboo tree. आज 5 करोड़ investor तक पहुँचे हैं, कल 50 करोड़ तक पहुँच जाएंगे.
Sir, you said it very nicely, but there is a deeper question there, and this is to all panelists. And one is a regulatory aspect there. How do we make things easier? But the fact remains, we reached 11 crore investors in January. We reached 11 crores, I don't know the exact number, but in digital assets much sooner. We have a lot of interest in this country for things like online gaming. Lottery is just one example, sir. You have a regulated market with the regulator having investor protection as their very first goal. And yet, people move towards areas where they see a better risk-return trade-off. Probably that's the only way to look at it. And they use technology. There is no nudge needed from them for them to move towards things like online gaming and lotteries, sir. How do we prevent this? How do we control this? Or is there a direction we should be taking? I should start with you.
Good afternoon. So, very interesting question, Dr. Itankar. I think one of the things I've been telling in my classes quite a bit, and also when people ask me about investments, is there is something I always feel is missing, which is the marrying of the investor/trader's risk appetite with the nature of investments in the market. So, while on the one hand we are talking about lottery and the other things, there are people who are even looking at markets itself as that it gives them a certain high. I'm talking about the behavior, right? So, you look at investors putting money in certain kind of investments. Many of them, you spoke about the number of investors tripling in the last 5 years. But for me, the greater danger there is a lot of them have only seen one side of the market. They've only seen the up market and they think there is a high doing that. And they think this is something that give me a similar utility to whatever else I get utility from. So, one place we have a lot of work to do is marrying the risk profile of an investor with the nature of investments and the asset classes in the market. I see a lot of mismatch of both. There are investors who should not be taking risks beyond a certain point, are in over-leveraged positions in certain asset classes they don't have any business coming into. And there are investors who have the correct risk appetite, who are unaware of the kind of asset classes where they can invest their money in. So these are the starting points for me in the next few years, where if we have to really build from where we are. All right, we've got people's attention, but the next thing is, can we ensure that their risk profiles are correctly marrying into the nature of investments?
Arvind, I'll make life a little difficult for you. Can you propose some solutions in this case?
Okay. Can I be a little radical in my solution?
Yes.
Okay. So today, if you look at the kind of apps and the kind of services people use, every app, everything collects certain kinds of data. AI is the solution for me, because with AI tech, one of the things we can actually do is we can figure out what is the actual risk profile of an investor. It's not that difficult to figure out somebody's risk profile based on certain behavioral aspects. We don't need to technically go through a questionnaire. We have the data. The data is collected by whatever apps is being used, and I'm hoping there is going to be some moral hazard here, that people know that the data they're giving is out of voluntary. We can easily find the risk profile, and why not target the, I mean, we have said mutual fund sahi hai. Why don't you now go a little specific and say, this mutual fund is good for you. This type of fund is good for you. This kind of an asset is not good for you. In a way, I'm happy that whenever I open my Kite or my Zerodha, the first thing I get is 9 out of 10 traders lose money. I think that's the best thing that I've seen in the last 2 years. I think I have to give hats off to the regulator for doing it, because as recent as a couple of weeks ago, a former colleague had pinged me, I want to talk to you about options trading, and I had a heart attack. I said, why would you want to do that? Why would you want to do something like that? I know your risk profile. You shouldn't have any business doing that. And the easiest way is use the technology, use the AI, profile the risk, and then you've got your mutual funds and other investment advisory services where you target the customer with the correct kind of an asset class. I think that itself would be a very good starting point. That would be my radical solution. You've got the tech. You've got the data of the investor behavior. It's not that difficult to then map it into risk profile and simply rebalance a portfolio of investments targeted.
So it seems Anand and Nilesh, Arvind has the solution to the problems. Is it too good to be true? Subodh, you want to start?
I think my take on this is a little different. I think if you look at human race, they are always driven by fear and greed. So greed will remain there forever. Let's get real. If you look at the stock market, as Arvind has spoken, when the market is going up, greed comes into play. Everybody believes that they can make money irrespective of quality of a stock, irrespective of what happens in the economy. You see a lot of money coming in. And then you see times like COVID where people suddenly move back and they start looking at debt. So I think fear and greed will always keep on driving the investor. What probably the question that we need to ask ourselves that whether people are taking risk that can actually jeopardize the system, jeopardize their families. That is something we should be very careful about. And if I look at currently, I mean, we have been just discussing about microfinance space. We know there are families who have taken a number of loans which they can't service because they've been moving one loan to another, and that has happened. So we have to have a system in place which tracks all kind of borrowing by the borrowers very, very centrally to ensure that people are not borrowing beyond their capacity. I think that is something that is very crucial, and this is where it's very important that we track all kind of data available in the system in a manner that neither a family nor an individual over leverages. As long as he's not doing it, he's taking risk within his capacity. What sir was saying, that different people has different ability to handle a risk. For example, a rich person, probably he can bet 10 lakhs and it doesn't matter if he loses that in one night. For a poor guy, even 10,000 can be a big amount. You have to just ensure that risk is taken in a calibrated manner. While we can stop some of the avenues, like we can stop the apps, we can tell people don't gamble, but people will figure out a way of gambling. It happens all the time. People are placing bet all the time while it is illegal. So I think that will keep on happening. We have to keep on finding ways of ensuring that system is not put at risk, larger finance system is not put at risk, and individual families don't suffer because people are doing excessive borrowing. So that will be my take, Tirthankar.
So if I kind of bring all these together, one of the points is that we need to support innovation, but we need to be careful about investor protection as well, and therefore the idea of a class of investors who's allowed to take, a class of investors that is allowed to take a little more risk, it makes sense. The idea also is for the big majority, the point is to understand that putting capital in managed funds will be far better than putting it in cash, or worse, putting it in areas where there is a get-rich-quick kind of intention. And what you're saying, Arvind, is that if you have a technology mindset, if you have an AI kind of framework that allows you to understand the risk-return trade-off at a unit level, and that should help you, judge what kind of, portfolios that people should be ideally having. And you both are saying that this should be centralized.
I'm saying there should be better data availability for everyone to ensure that we are not putting the larger system at risk. you're not putting families as risk to the extent possible, because I know still you will not have some data. Let me be candid, but to the extent possible, those data should be available. And to your point, I mean, where you are coming from, if I'm getting it correctly, that individuals should also be sensitized about the risk-return trade-off they are getting into, so that they take calibrated risk, and I think which is a fair point.
So Anand, is this feasible without impinging into individual liberty, freedom?
So long time back, when I was in the banking system, I was taught how to handle media questions like this. You're not media. So the question, the lesson I was given was, irrespective of what question they ask, you answer what you want to answer. So it's even more useful for a regulator, by the way. But let me try and put all of this together. To your original question, there is so much of financial inclusion happening on the banking side, this Jan Dhan Yojana, etc. Are we not keeping pace as far as the securities ecosystem is concerned?
I agree.
One, our pace has been frenetic of financial inclusion. And I agree with Professor Sampath that I think the debate has to be, is this too frenetic? Are we getting too many people coming into the markets without realizing the risks? Second, there is a fundamental difference between the RBI issue of financial inclusion and the securities market issue of financial inclusion. RBI get everybody to open an account, period. There is no debating that you want people to be included in the banking ecosystem. For us, yes, mutual funds sahi hai, but mutual funds are also subject to market risk. Both go together. So you cannot be included unless you are completely aware of the risks and willing to take on those risks. Yes, we are there for investor protection, but we cannot protect you from volatility. We cannot protect you from markets going up and down. That is the nature of the markets. And you have to be aware of that. So I think it's extremely important that the pace of financial inclusion in securities market, frankly, should be slower than the pace of inclusion as far as banking is concerned. Now, I also agree with Professor Sampath that ideally, as we mature as an economy, as an investing population, we should be risk aware in the sense we should know what our risk appetite is, individual. And that's a very, very individual answer. Some people can go in a roller coaster ride, some people can't. Now, I come from, like many of us here, I come from reasonably humble backgrounds. I've seen hard days growing up. So I cannot take risks. So my risk appetite is naturally lower. So understanding what that risk appetite is extremely important. We don't spend enough time on that. Then, once you've decided what your risk appetite is, you have to do an asset allocation which ensures that you maximize your return for that risk appetite. Harry Markowitz said this, that the closest thing to a free lunch is diversification. So you have to diversify your assets and make sure that you know what your risk appetite is and you've got assets which are commensurate with that risk appetite on a portfolio basis. By the way, there is work for us here. I don't think we've managed to go beyond equities as an asset class. We need commodities, we need real estate, we need InvITs, we need REITs, we need munis, we need fixed income. There's a whole bunch of asset classes that we are probably not tapping enough, which we need to grow so that asset allocation can happen appropriately. But ideally, and Rome was not built in a day, we'll all get there. Ideally, once you know your risk appetite, you build a portfolio. Last bit, all of us have to be aware, the more you trade as an individual, the less you make. That's a reality. It's shown by every single research. And this 9 out of 10 for FNO is not just FNO. Even in cash equities, if you get in and get out all day long, unless you're a high frequency trader with algos and with a lot of institutional investments, as an individual, you're a loser. So knowing this risk, now that doesn't mean that you don't trade. It is your hard-earned money. You please do what you want to do with it, but be aware of the risks. I think this risk awareness and getting the investment strategy right is going to be a crucial part of our journey as we go along.
And how will technology help us in this regard? What kind of technology-based solutions could be used for this?
So again, expanding on what Professor Sampath said, personally, and this is not a SEBI view, this is my personal view from my own personal experience. When you have a legal problem, you go to a lawyer. When you have a tax problem, you go to an accountant. When you have a medical problem, you go to a doctor. Managing your financial planning and managing your financial wealth is not an easy job. it is a specialized area. Investment advisors are frankly people who only get paid by you, not by the producer. This is one class of people whose fortune is tied to yours and whose interests are aligned to yours. Now, unfortunately, we don't have too many investment advisors in the country. We have about 1,300 of them or so. We have about 2 lakh mutual fund distributors. I don't know what the exact number is right now, but around in that ballpark. They are people who get paid by the producers, by the mutual funds, by the actual portfolio managers, and so on and so forth. Ideally, we should have a thriving ecosystem of investment advisors who should be able to do all that I described to you, assess your risk appetite, tell you what the asset allocation therefore needs to be, define that for you so that they can maintain it over a period of time. Now, this can also be done by technology. You have plenty of apps possible, plenty of technology solution possibles, which can act as an investment advisor. So marrying the two can actually work very well. Of course, there are plenty of other things where technology can help, but I'm saying at a basic level, this can be very useful.
Thank you. Thank you. Nilesh, I will just pivot again. I want to ask you something about a point that I made earlier about how academia and industry can work together. See, we keep talking about bridging this gap of financial literacy, people who know and people who don't. We keep thinking about a digital divide between people who have access to technology, particularly in the financial markets and so forth. But we have this, India is one of the countries with a large number of universities. We have 1,200 universities, 45,000 colleges. And we see a crying need for people who have come to the market and yet do not understand the market well and end up making losses and then going away from the market. That has not happened in the last few years or so, but how it will happen eventually, going by market history. How can academia and industry work together? And I'm not asking this to Arvind now. I want to ask you, sir. How do you think academia and industry can work together for a better future in this direction?
So one, I'm most qualified to answer that because my wife is a professor. So I've dealt with academia all through my life. See, there are multiple ways in which academia and practical industry can work together. For example, do I or my fund manager know anything about technology and artificial intelligence? Answer is no. Today, if I want to learn about it, where do I go? There is Upgrade, which is available, which is teaching AI. But could there be more tailor-made, customized solution for a busy executive so that they can enrich their knowledge? Second, there are many areas where we want to invest, but we don't have sufficient knowledge. What do I know about nuclear fusion? But I know that's going to change the power sector. What do I know about some of the stuff happening on the medical side? But I know that's going to impact my pharma holdings. So I need an access to research in academia where we can replenish our knowledge and bring it to the level which will allow us to make wise decisions. Convert this onto the sales and distribution side. Again, financial awareness is a big issue. At Kotak Mutual Fund, through our Investor Awareness Protection Fund, we trained 75,000 teachers in India across Central Board of Secondary Education, CBSE school. And we found that many of them were receiving this kind of financial education for the first time. Now, if teachers themselves are not aware about financial concepts, what are they going to teach students? So again, how can we work with academia to create financial awareness program? And how do we ensure that it is engaging and fruitful? So there are multiple ways in which industry and academia can work together, right from investment side to marketing and sales sides to probably operations and data analytics. Have we made a beginning? Yes, we have made beginning in Mumbai colleges, where with a couple of colleges, the students come as intern with us. There are a couple of advisory board with whom we engage. But I think this needs to be scaled up much, much higher.
So NSE, for instance, does more than 7,500 investor education classes through a year, programs through a year. And there are a number of players in the ecosystem who combined together do much, much more.
So if I can interrupt you there, I have been doing since 30 years investor awareness program. ऑडियंस भी वही रहता है, मैं भी वही रहता हूँ और 30 साल से वही बोल रहा हूँ भाई SIP कर ले, बट अब तक उसने SIP ओपन नहीं की है. तो गुजराती में कहावत है भैंस आगर भागवत, वही हम पढ़ा रहे हैं.
Arvind, how do we solve this problem?
It's a very, very good question. So I'll try giving some views at different levels. So one of the first levels is I'll give an anecdotal evidence. If you look today, you ask somebody either in academia or in the industry, how do you price an option? Everybody is going to pick up a Black-Scholes formula calculator and give you the option value. Whether it's right or wrong, we'll debate later. But how many people know that the Black-Scholes formula was a collaboration between academia and the industry? So there was somebody in the industry who wanted a solution to the problem, and there was somebody in academia who did not have access to the data. And both of them combined and produced, at least in my very not so humble opinion, the last great invention in finance. After which I'm yet to see something which is path-breaking, which changes the way we look at the world. So Black-Scholes came from a collaboration between academia and the industry. And I see that something like that can be solved even today. We have industry with data sets that I would love to get a hang on. It's like giving my small kid a ice cream. I'll keep having it forever. There are some data sets I would love to just look at and study. And I'm pretty sure that some of the data sets that you have, this is again going to another Nobel laureate, Eugene Fama. If you look at some of his videos, some of his greatest works, he did not start the work just like that. He had a friend who said, look, I have these tapes of data, I'm planning to erase it. And he said, okay, why do you want to erase it? Give it to me. I'm a theorist, let me theorize what your data can tell me. And then they produce some great results. So there are people like us who can come up with our theories and conjunctures. And there is people in the industry who've got the data sets that we will not get. And that's at a very higher level. But when I come to a little on the lower side, I think I agree with sir. And one thing I'm very worried about for the future is, while we are happy to have a lot of India educated and getting them into the literary system, I think we have to introduce ideas of core economics and finance as a mandatory subject in their primary level. I'm not talking about college level, that comes much, much later. But I think introducing children when they are very young, I mean, talking to them about money, talking to them about what is a market, or where does money go, how does money multiply, how do you lose money? I think that's a starting point. We can create curiosity straight then and there. So these are two different ends of the spectrum where I see we can solve problems. At one end, we can solve the first world problems. At the lower end, we can solve probably the problems of the common person on the planet.
That's a fair point. That's a fair point. Subodh, one question to you. People understand equities much better than they understand debt. What gives? Why?
Interesting question. I think when it comes to debt, people do understand probably fixed deposit, but certainly not bond market. And if you look at our bond market, Tirthankar, we are growing well, but the depth of bond market continues to be shallow. So if you look at total bonds, that is there as a proportion of GDP, we are at around 19%. And if you look at markets like US, it is around 1.2 times of GDP. On equity side, we are really moved up because we are at around 1.3, 1.4 times of GDP. But bond side, there is a big lag. And the retail participant per se is very, very lower because most of the time investors are, private investors, private placement happens, mutual fund comes into play, and then pension and insurance are the other ones. So somewhere I think there is a strong need to sensitize larger base of investors that better return can be made in the bond market for a given risk. Because when you move to the bond market, please understand there can be some level of risk. Irrespective of rating category, it can be AA, single A. There is some element of risk, but return can be much better. We have done an analysis and we believe that for a A-rated paper, you get best return best risk adjusted returns. So I think it's very, very crucial that we go out to the larger bunch of investors and sensitize them, because in their market, they believe that bond, first of all, there's not a lot of retail bond that comes in the market. That's number one. And second, if you also look at the trading volume is very, very low. It's like 0.1% of total outstanding bonds we have. So on equity side, it's fairly liquid. So liquidity is an issue, issuances are an issue, and knowledge also to an extent is an issue. And people were actually putting in money in debt mutual funds for some time, but then tax treatment became unfavorable some time back. So even that channel is also stopped. So there are certain challenges, I think, not something that cannot be addressed, but I think, your point is valid that interest in debt market tend to be much lower than equity market, largely because of knowledge and availability of bonds, both.
Thank you. See, at this point in the panel, I have noticed my fellow panelists sanguine about technology, knowing that technology can solve problems. Ideas are clear that the way India is progressing, the way we can bridge the gap between people who should know and what people know can be done through technological means in a various in a manner. Of course, things have not worked out so far to the extent we would have wanted, or things have gone too fast in terms of people who have come to the markets haven't really seen how a negative or a bear market looks like. I, for one, I've seen early 2001 markets, then 2008 markets, and then again the taper tantrum of 2013. That experience is like no other, something that textbooks do not teach you. But at this point, with the panel's permission, I would like to throw open questions to the audience, from the audience. Let's see, with the discussion that we've had so far, okay, we've seen that investor protection for us is important. India has done well in terms of allowing investor protection and letting markets grow, knowing that it's good for investors to grow well, but it's also important to know that there can be losses if they don't do their homework well. So the nudge of 9 out of 10, 9 times out of 10 you losing money, or 7.58 times out of 10 you lose money if you do intraday trading makes a lot of sense. The idea that you should go for SIPs rather than investing it yourselves also makes a lot of sense. And our panelists are also saying that you can have solutions, after all, from a technology perspective, that AI-based solutions can help you understand the risk-return trade-off at an individual level. So can we take a few questions to our panelists?
So before that, Tirthankar, with your permission,
yes,
can I just make a couple of quick points? One, on the previous debate about data and industry and academia partnership. I've had the privilege of being on many sides, on industry side, on academia side, and now as a regulator. And I've had this debate with my mentor, Dr. Subbarao, and other people in RBI as well. I think it's not just industry academia. There are plenty of stakeholders involved. There is industry, there is policy makers, there is public, there is regulators, there is academia. Often we talk past each other rather than to each other. And I've been here in NSE, NSE, NYU, I believe, used to have this, collaboration, and we used to have papers, etc. I remember one particular conference where it was entirely a bunch of academics with nobody from industry discussing some very esoteric topics which, frankly, industry was probably not interested in. And I'm glad that we made a departure now where you're at least getting in people from industry and, having this discussion. But I wish there were more people from industry, to be honest. That bridge has to happen. I can tell you, sitting in SEBI, we had this research advisory committee where academics would come and tell us what they want to do research on and ask us for data. And none of the research made sense to us. It was just some esoteric stuff which, frankly, we were not able to connect with. Now, on this bit about data, I just want to clarify. Unlike most jurisdictions in the world, we believe data is a public good and should be available to everybody, not just to the exchanges or the depositories or the clearing corporations that are sitting on it. In fact, our policy is very, very clear, subject to confidentiality, privacy, etc., which obviously you should not get data which be able to allow you to guess who the person behind the trade, etc. is. Subject to that, up to 2 GB of data, I think that's the number, you can ask from NSE in a particular form and they will give it to you free of cost. So all sorts of data is available. We are the only country in the world which gives provisional data on how much FPI is brought in or took out in a particular day. And then the final data comes out on T+1. No other country in the world does this. Our data is there for everybody to use. My strong urge to academia, please seek that data. It's available. Nobody is going to deny you that data. Don't say data is a problem. It is absolutely available. There was another quick point I wanted to make. You said we are sanguine about technology. I am not at all sanguine about technology.
Okay.
Let me quickly correct that. As a regulator, our job is to worry. And frankly, with all the digitization that is underway, we are always worrying about data theft, about privacy, about resilience, all the time. The stuff of nightmares for us is all the data available in the depositories about which Indian is holding how much securities tomorrow comes out in the dark web. Can you imagine what a disaster that would be? So from a technology perspective, we are not at all sanguine. We are always worrying about how we can make the system more and more resilient. It's a thankless job, but it has to be done and somebody has to do it. Finally, on technology, I think the opportunity part of technology has to be emphasized here. Nilesh Bhai talked about fusion, and there's talk about, the previous panel talked about crypto and the quantum computing and AI and robotics. I think is going to be a big area. The nature of the economy is probably going to change in the next 5, 10, 15, 20 years. We tend to underestimate short run, or rather overestimate short run, but underestimate the long run, right? Imagine a world where energy is abundant, as the previous panel mentioned, where goods and services are practically being produced for free. What is the nature of economy going to be that time? And therefore, what is the nature of capital markets going to be at that point of time? I'm too old to figure out the answers to this, but amongst the young people here, you are going to define what the world will look like 5, 10, 15, 20 years from now. Our challenge is to ensure you have the tools available to create that future rather than be surprised by it. And this is going to, I think the nature of capital markets is going to change over the next 20 years in a way we can't imagine.
Sir, what I meant about technology was that the way you would fight any misgivings in the market, any misdemeanors in the market would also be technology based. So that was sort of idea. Yes. So let's throw open the floor for questions. Suresh had a question. Yes. Excuse me. There.
Good afternoon. My name is Suresh. I'm an adjunct faculty with NISM. Just a point on what Professor Arvind made, and which was kind of, I wouldn't say negated, but clarified by Anant, WTM of SEBI. I don't think, and keep putting myself in an academician's shoes, I don't think there is dearth of data available in public domain today. And perhaps India is one of the few countries where so much of data is available. As if I were to quote in Hindi like Nilesh Bhai, "Dhundega to Bhagwan bhi milte hain," they say. Okay, there is so much of data. We have AMFI putting out data, we have AMCs putting out data, we have NSE putting out data on the website, BSE, CDSL, NSDL, a regulator putting out data. You have so much of data on SEBI monthly bulletin. So I think we need to take that step as academicians, search for availability of data. There is NSE Data and Analytics, which gives out historical data, subscription-based. WTM has clarified there is some free of cost, some at minimized subscription. So I think we need to also kind of push the ante from our side, having been both on corporate and academic side, I can say that, before kind of pushing the ball on the other side. Just a comment. I thought I'll just
Thank you, sir.
clarify.
Point very well taken. Yes, please. Can somebody pass the mic to that gentleman? Kindly keep your questions brief.
So good afternoon, sir. So my question is basically with the proliferation of analytic tools, right? So do we expect the field of quantitative finance to be at the forefront of capital markets going into the future, given the processing capabilities that we have, given the mushrooming of AI and ML? So do we expect the field of quantitative finance to be at the forefront of capital markets going into the future?
5 साल के बाद मैं यहाँ पे नहीं बैठा होगा, कोई कंप्यूटर ही बैठा होगा.
Next question. Yes, please. Sushant, can we just pass the mics quickly, please? Thank you.
Good afternoon, everyone. So, assuming there are good market innovations in the capital markets, but there are many constituents in the market, such as the sub-brokers, brokers, or investors who are not able to keep up with it. And then again, it would raise regulatory concerns. So, is there any way that they can foster growth with foster all of them and then move together without any concerns being raised from any of the parties?
You think it's an unequal place? The market isn't.
Yeah, I'm meaning that if there's an innovation also, and many people are not able to keep up with these, such as the brokers or the sub-brokers or even small-time investors, then there is regulatory concerns over them. So is there any way that everything can be fostered together while moving forward with these innovations?
So let me try and put 2-3 angles to what you mentioned. Yes, sometimes the pace of change can be frenetic, both initiated by the market and initiated by the regulator. What we do try and do is to ensure that there is an adequate glide path for whatever changes are being made. So for instance, T+1 was implemented completely as of Jan 2023. There was a 2 or 3 year glide path before that actually came through. Similarly, we are doing T+0 on a beta basis. We are doing something called trading on the back of blocked accounts in secondary market. So a whole bunch of things we are doing with a glide path. Second, I think the opportunity space for intermediaries as a whole is only growing. As the pie of investors in the equity, in the overall capital markets in India grows, the role and the pie for the intermediaries is growing as well. So nobody needs to worry about that. I mean, the margins may be coming down with efficiency, but the pie itself is growing quite dramatically. And you're seeing that. 30 years ago, 40 years ago, brokers used to charge a lot higher compared to what they charge now. But actually, the broking income is actually higher now, given that the size has grown so much. Finally, look, change is inevitable. The reality is we all have to adapt to change. Regulators have to adapt to change, as do market participants, as do intermediaries. Those that adapt better and can predict the future better tend to do better. There will be winners and losers along the path.
Thank you.
Further questions? Yeah, Kaushik, please. Mic for Kaushik.
Hello. It's great to hear all of you, and Nilesh Bhai, Anand, both of you have also looked at fixed income, and Anand, you've come from the banking side. Nilesh Bhai, you've seen fixed income, now you're into equities. The way I see the taxation system in India, indirectly it is incentivizing most people to go into equities. So if I put money in fixed deposit, I'm taxed at 30%. I used to put money at VPF, but now that is also taxed. Mutual fund, debt mutual fund, indexation gone. So you're indirectly telling me you go to the equity markets. Now we know that demography-wise, young age population is below 30. Most of them have not seen cycles like you people have seen, and people think markets just go up. What would you expect? It'll be only frothy, right? So I'm not surprised that people are just going into equity markets without even understanding the risk. But in a way, the way the taxation system is, because you just have 12.5% long-term capital gains, that also has been raised. So instead of reducing the 30%, that 12.5%, the risk can go up to 20-30%. Isn't it better to give some incentive for people to come to the fixed income and, from a portfolio allocation kind of strategy?
Not strictly linked with technology, but it's a very valid question.
So I fully support your argument that mutual fund should have taxation benefit. Anand bhai, please de dijiye.
मेरा आंसर बहुत सिंपल है. This is way beyond my pay grade. This goes into another department completely. So I'm going to recuse myself and ask Nilesh Bhai to answer.
So on a serious note, if you see number of people who are paying tax in India, versus number of people who are actually generating income, there is a big gap. Number two, there are many other investments which are getting tax advantage, like insurance, like new pension scheme. And yet they haven't grown as much as, let's say, mutual fund. What we need is a level playing field. Whether it's bank deposits, whether it's mutual fund, whether it's PMS, whether it's AIF, whether it's insurance, whether it's NPS, give us same level playing field. Don't create all these tax advantages and loopholes. Now, we have to live with what we get. So today, in debt mutual funds, there is fund of fund, which gets you, after 2 years, long-term capital gain at 12.5%. They'll invest 40% in equity, 60% in debt. You get 12.5%. That's good enough for an informed investor like you, Kaushik Bhai. Baad mein milna, I'll give you which fund to invest.
So that, ladies and gentlemen, brings us to the end of our panel of the day. Sir, you may not agree with me, sir, but I do kind of feel sanguine about technology. I should be worried. I agree with you. I should be worried. In fact, if you take the BRSR reports of the 1,000 companies, the very first fear that they have is cyber risk. Technology is something of a worry. Anything could go wrong. These are systems which are very, very complicated, very complex, and the chances of things going wrong are very, very high. So from a regulator's perspective, the caution that is needed is I mean, it could not be overemphasized. I fully agree. But having said that, there is also room for growth. Technology is an innovation. Sir, alongside investor protection, market development is also a SEBI goal. So from that perspective, technology is something that has been fostered by the regulator, and we have seen that happening in our markets. In fact, what gave me grief, ladies and gentlemen, what gave me grief was one of the questions. I was talking with Nilesh Bhai about it. The question was, which country got T+0 settlement cycle first? 35% of our audience answered US. No, that's not a good idea. See, we went to T+2 somewhere around 2005. We went to T+1 in January 2023. The US shifted to T+1 in May 2024. The US has never had T+0. India has had T+0 from the beginning of 2024 in a staggered manner. So with technology, I think there is need for some belief in us as well. Yeah. Thank you. Thank you, ladies and gentlemen.
Thank you so much. I thank all our panelists for a very fascinating and engaging discussion. I request Dr. Tirthankar Patnaik to felicitate all our panelists. I request Professor Sampath to felicitate our panelists. Thank you so much. Do we have the quiz winners here? Arjun. Do we have the quiz winners here? Okay, we'll do it in the next session. We'll do it in the next session. We'll take a short break and we'll assemble here in 5 minutes, please. 5-10 minutes. Our next panel discussion is on macro financial stability in the era of disruptions. We'll begin this session at 4:20. I request everybody to be here by then. Thank you so much. Theme in today's world, macro financial stability in the era of disruptions. With global economic uncertainties, geopolitical risk and inflationary pressures, maintaining financial stability is a top priority for policymakers and market participants. To discuss this, we have with us a panel of distinguished experts: Dr. Poonam Gupta, Director of NCAER, Dr. Ranil Salgado, Senior IMF Representative, India, Shri Neeraj Gambhir, Group Executive, Treasury Markets and Wholesale Banking, Axis Bank, Shri Saugata Bhattacharya, Senior Fellow at Center for Policy Research and member of RBI's Monetary Policy Committee. I request the panelists to please come on the stage. The session will be moderated by Dr. Mridul Sagar, Professor of Economics, IIM Kozhikode. Let's have the last quiz on the screen. Could we have the QR on the screen?
So this is the last panel we have before Mr. Subbarao gives his valedictory address. So at this panel, we'll focus on macro financial stability in the era of disruptions. We discussed a lot of disruptions since the morning. But to set the tone, I have requested Poonam Gupta to actually give her keynote remarks, and she has a small PPT. So over to her without any further ado.
Hi everyone, it's a pleasure to be here. Many thanks to the organizers, Mridul and Tirthankar. I do have a PPT which somebody is going to play for me, and we had decided that I'll pretend to be doing this when I know I can't change the PPTs from here. So if somebody could please upload them, that would be great. I have a very short presentation. I have been given about 10 to 11 minutes. So I'll take a minute and a half on each slide when they are put up. Rather than wasting the time, let me start with the presentation, and you can read it when it comes up. So I start with a few questions and I end with a few questions. The questions that I start with are very simple. Has India become more stable macroeconomically in the last few years? And the answer is yes. But is India an exception? Is it the only country that has become more stable macroeconomically? And there the answer is no. A whole host of emerging markets have become more stable over time. When I say over time, I really mean last 2 decades. Right after the Asian crisis, almost all emerging markets strengthened their macroeconomic frameworks, which resulted in more stability. And the end result is you don't see a typical BOP crisis or a sudden stop crisis happening in almost any emerging market. So much so that around the mid-2000s, the IMF had started to worry about its business model. You know, if countries don't undergo crisis and they don't seek funding from the IMF, then what will the institution do? But have things changed since then? does evolving disruptions mean that they will pose a challenge to the stability that we have come to get used to in the last 2 decades? And if so, what should we do about it? And what is the next generation of macroeconomic frameworks that countries such as India and other emerging markets should be looking to build? So when I said India and emerging markets have become more macroeconomically stable, and it's because of the stronger economic frameworks that they have, what do I mean by that? What I mean by that is more flexible exchange rates. Just remember 1990s was the decade of fixed exchange rates. Since then countries have moved on. They have flexible exchange rates. They do not have full floating exchange rates. I don't think there's any emerging market which has a full float. They all have managed floats. They have stronger fiscal positions and which have been built under credible fiscal frameworks. Yes, COVID has disrupted the overall trend on stronger fiscal positions, but I'm taking a 2-decade view, so it still holds. Most of the countries have built better monetary policy frameworks and more independent central banks. Most of the countries that we are talking about are doing so under inflation targeting, mostly flexible inflation targetings. A very important element of this framework was that countries started to build larger forex reserves and reduce the exposure to foreign currency in their debt portfolios. So the crisis of the 80s in Latin America and 90s were because of the buildup of foreign exchange exposure in the debt portfolios of countries and they not building a large enough forex reserves. Bank regulations have become more prudent as well, especially after the global financial crisis of 2008-9 and the European crisis that followed in the decade after. So as a result of which, there is more macroeconomic stability all around us and not just India. So India has certainly become more stable as well. Just remember the last time it had a full-blown crisis was more than 3 decades ago in 1991. And since then, India has been doing exactly what I laid out on the previous slide, which is a better monetary framework, better regulation of the banking, a large forex cover. It continues to be quite cautious about building forex liabilities. One area in which India stands out compared to other emerging markets is its very large debt and deficit numbers. But because of the way they finance it, it has not been a macroeconomic risk. So therefore, for most part, India has been stable. It has not had a full-fledged crisis. Instead, what it has had is what we call emerging market sell-off episodes, which impact all emerging markets at one go, and India has not been immune to those. But compared to the BOP crisis or the sudden stop crisis, these are short-lived. They don't become systemic. They do not have a very large impact on growth rates, and they are the kind of crises that do not require assistance from the IMF. And so will this macroeconomic stability continue? Absolutely, in foreseeable future, and the reasons are strong frameworks and institutions that have been built in the last 1 decade. FRBM not in the last 1 decade, it has been about 2 decades old. Inflation targeting 9 years ago, IBC code, and in some of my presentation I show how the Indian economy has also become more resilient to the generic shocks which have impacted its growth rate in the past. Oil prices. Oil prices themselves do not get impacted a whole lot by geopolitical tensions or economic news, and in addition to that, they do not impact the Indian growth rate as much. Agriculture has become more resilient to rainfall at least. International capital flows remain as fickle as ever, but the country has learned to cope up with that, and there has been a period of political stability. In addition, there is a commitment to macroeconomic prudence in the governments, in the regulators, in the central bank. as a result of which macroeconomic stability is likely to continue in foreseeable future. What about the evolving disruptions? So what kind of disruptions are we talking about? Here I have listed 4 geopolitical, and I call it trade under Trump or everything else under Trump. It is a big, big shock. We don't know how it will get unraveled and what implications we will have. Increasing financial integration and ever more frequent episodes of what I'm calling emerging market sell-off, which get triggered by global risk aversion. Climate change is an event that has been building slowly and its implications are not fully understood, but also technological adoption and what it means for growth models of the countries, of all emerging market and developing economies, and also what it will do to employment. The question is, why should we discuss these disruptions in the same breath as we are discussing either macroeconomic stability or the toolkit which is useful to address cyclicality of an economy, which is fiscal and monetary policy? To my mind, all of these disruptions and risks are more structural in nature, and the way to address them should be structural in policy as well, structural policies basically. How you evolve your trade policy, how you evolve your geopolitical relations, building climate resilience in the economy all along, and reforms to continue to elevate the competitiveness of the economy while keeping your own macro house in order. What is the role of fiscal and monetary policy? Limited when it comes to addressing these challenges, except that these challenges mean that the ups and downs of growth rates and other economic variables can be wider, which means you need nimbler and more flexible frameworks. But it also means that you need policy buffers at all times to be able to use them when any of these shocks hit in isolation or cumulatively. So what are the, and I think I'm ending with this slide, second last slide. So what are the evolving issues that interest me? The issues that interest me are the following. I don't have an answer. It's for the audience to think about and maybe the panelists to dwell upon. At the current juncture, when the economy has been growing at a robust pace, when macroeconomic stability is here to stay, I think the futuristic questions are the kind that have interested me in the past few months, which is a financial sector growth ready? Do we need to make the sector more competitive, especially when it comes to the banking space? And what is our approach towards NBFC sector, both in terms of its role in the economy, but also its regulation? Are we preparing a central bank and a regulator of tomorrow? Or are we just so fixated on inflation targeting as a framework, primarily as an observer and primarily as a commentator, but also as a policy maker, that we are not discussing sufficiently all the other things that a central banker and regulators have to do? What should be our approach towards exchange rate flexibility and reserve management? We have seen some action happen recently which did not go very well. But do we know what our approach should be? I have an answer, but it's for you all to think about. And what about the macroprudential measures, which have been largely absent from the toolkit? How do we want to go about them? As I said, India's public debt is high, and it's a bit of an anomaly. In particular, some of the states are under distress. Fiscal rules, for most part, are not being adhered to. What is our approach towards it? So, as a semi-academic, I would say that once a rule or a framework has been in place for as long as 2 decades or nearly a decade as far as the inflation targeting is concerned, then perhaps it's time to rethink them and make them nimble for the ground reality of today, which is the kind of challenges that we are talking about. What is our approach towards public capex versus private investments, public debt or private debt? What is our approach towards current account deficit? Is 1% current account deficit too low, just the right amount? And if we are, comfortable expanding it, what should be the way? In my mind, FDI is very, very important. And that's the last bullet point here. Are we too narrowly focused on domestic entrepreneurship and apprehensive about FDI when the evidence shows that FDI can be a very good growth enabler? So just to end it all, in my view, the Indian economy is resilient for most part, but it would be useful to continue to evolve both the frameworks and regulatory capacity to stay ahead of the curve, to be ready for the growth of tomorrow. We ought to have a very good balance between growth, productivity, and stability. And perhaps we should ask ourselves, prudence for the sake of prudence, or is there a way to be smart about, navigating any potential trade-off between prudence, growth, and productivity? Thank you.
Thank you, Poonam. Very much appreciate the time. The time was not a constraint in terms of the content from the think tank. I think she has flagged a host of questions which our panel would, I think, eminently debate. So, Agatha, let me come first to you. So, I know you are the person who would be key in the coming minutes when the minutes will be released for the MPC. And but let me not come to that. I'll come to you later. What I want to start with is this criticism about inflation targeting framework, which seems to be coming to the fore over the last 1 year, not just in India but worldwide. And I'll come to you on the worldwide angle. But in essence, we had the economic survey raising the issue of terms of trade. And we then had an article from the chief economic advisor, which very eminently listed 7 important facts about flexible inflation targeting. So do you agree with that criticism? Do you think inflation targeting is working well? Do it need something to be fixed there, or how?
So Mridul, thank you for this opportunity, NSE, for the opportunity of participating in this forum. Look, as Dr. Gupta mentioned, I mean, frameworks need to be continuously reassessed. So whether inflation targeting, my own sense is the flexible part of the inflation targeting has more or less served us well in terms of times of crisis, etc. It's done a fairly good job. Obviously now, I mean, given the fact that we are essentially trying to use a demand management tool, interest rates, to try to address a supply-related problem, needs to be addressed. There are multiple ways, and first off, I mean, this needs to be debated and discussed. I mean, there is no doubt about it. So long as the Act mandates inflation targeting, that's it. You are targeting headline inflation. There is nothing that can be done about it. Whether that's the appropriate framework needs to be debated, discussed. I mean, multiple issues. I mean, first the new CPI basket will come in, then there's a review scheduled for the flexible inflation targeting framework, etc. People have suggested, I mean, in terms of monetary policy, the first thing is it should be clear. The target should be very, very clear. Dr. Subbarao is here. I mean, he managed an incredibly difficult set of economic circumstances during his tenure. But as of now, I have no doubt in my mind that a target should be established, one unambiguous target. All the inflation, I think India is at the middle, the via media between the...
So a point target and not a target band.
We already have a target band. I mean,
we do have flexible with the...
Absolutely, we already have a target
We don't
band.
have a target band, but we have tolerance limits.
That's right, I mean, tolerance limits is the target, which is part of the inflation, the flexibility in the inflation targeting. People have suggested some weight be given to headline inflation, some weight be given to core inflation. Again, so that the point is, so long as the target is given, so long as markets anticipate, because that's a very critical part of transmission of monetary policy. So long as that is established, I think we are okay with looking at, but I do not think we should go back to the old multiple indicators approach in terms of monetary policy.
That's good. Poonam, last year you were working with Barry Eichengreen, and sort of those articles were pretty defensive about what the inflation targeting is pretty good and sort of defending. Is there a rethink on that, or that broad line you still have? And what needs to be fixed in that? We did read some of your recent writings as well.
So, you know, when you think about the inflation targeting, the proof of the concept lies in the fact that once a country has adopted it, it has not moved out of it, which means the countries are finding it useful. And so I know Ranil is going to be talking about cross-country, but let me just take 15 seconds. So while writing that paper, it was a second paper, we analyzed the experience of some of the large emerging markets. And we realized that most of the countries, they do have a target and a band around it. Some of the countries only have a band, but all the countries have revised their framework at a frequency of 1 to 3 years. So if you want the framework to, so first the framework has worked and therefore it has been retained, but also there is this inherent mechanism to continue to revise the framework. Now let's come to India. The framework is flexible, as you said, as Mr. Bhattacharya said, and it is more similar to the previous multiple indicators approach than we appreciate. And I take pains in explaining this in research papers. Whether you do text analysis, whether you read the reports of the members, it's more multiple indicators than we appreciate. So my views haven't changed, that the framework has worked well, but whatever recent discontent there has been, it's about, because many other things that were needed for the framework to continue to well for as long as 9 years have not kept pace. CPI basket is one of them. The technical capacity to be able to forecast growth and inflation has not been built. Household inflationary expectations are totally misaligned for as far back as I remember. That has not been done. So I think we can't just build a framework and forget about it, especially for a large and fast growing and complex economy such as India. 9 years is too long a period, right? And again, so in one of the many op-eds I've written on inflation target, and I don't know why I took it upon myself to defend it, because I was very worried they'll junk it in favor of something which does not work as well. I have pointed out to the fact, I don't know whether it went into the op-ed or not, that if you're being given a dated basket over and over again, discuss with the government rather than all other kinds of skirmishes coming out, that you're giving me a basket which has been dated by 13 years. Just build your own basket and show how things should be. And we have tried to do that in the paper. We have tried to calculate the right basket.
Yeah, but in all fairness, that was because the consumption expenditure survey didn't go through on the 2017. So we had a dated basket.
There are many other
so
ways.
that will get corrected now, I believe.
Yeah, yeah.
So, but you would say you still switch to core instead of headline? Is that what you are arguing in terms of CPI?
No, headline with the right basket. Headline with the right basket.
Headline with the right basket.
When you do that, your share, not just the share of food will come down. There's so much churning within food that we don't know about. We don't know when, when you reduce the weight of food, what will gain. Maybe it will be services. Maybe inflation will be higher. Maybe it will be as volatile. We don't know, right? It's a black box.
Absolutely.
Right?
I think that's a very fair point in what we have. Ranil, is inflation targeting at risk worldwide? Like, are there rethinks about central bank autonomies and inflation targeting frameworks? And do we have something more meaningful to replace, or it's just the criticism?
So I'm going to not surprise it. I mean, I'm not going to be, I'm going to agree too much right now. So I agree with both Dr. Bhattacharya and Dr. Gupta that inflation targeting globally has had an excellent track record, right? So since New Zealand started it around 2000, if anything, it's expanded its mandate, not narrowed. And as far as I can see, no country is yet considering pulling back. Yes, there's been increasing, shall we say, political pressure around inflation targeting and maybe too much of a focus sometimes on inflation and failing to meet inflation targets. But I think it's served those countries quite well. The international experience also is, it is primarily a headline inflation target, right? And for emerging markets, headline inflation is even more important than for advanced economies because it tends to more set expectations, the headline number, given the vulnerabilities for both food and fuel, energy prices, when you strip out core versus headline. That all said, I think the international experience also says to take advantage of the flexible aspect of inflation targeting. So one of the first lessons New Zealand learned when they moved to inflation targeting is they were too focused on near-term inflation targets. So over time, they gradually increased it, and the standard today, as in India, is you have a medium-term target. So the country does not, even if you don't have almost all countries have some type of tolerance band, but there are exceptions, right? You have to exceed the upper end or be below the lower end for a period of time before the central bank has to report it. So that is to build in flexibility. And I think central banks, in some cases, can take more advantage of the flexibility. So for example, if you think there's certain aspects of prices that are temporarily spiked, the central bank can argue in the narrative, in its commentary, when they make a statement or in the minutes, the members can also argue that there's an opportunity to see through these temporary shocks. I think that is some of the lessons that the international experience is suggesting.
Great. Neeraj, I'll come to you in a minute, but because I've liquidity. Before that, let me raise the issue of where rates are. I mean, there was this, some people started believing that the interest rates were a factor in the slowdown of the Indian economy. So some adjustment has been there in the last policy. You as an MPC member change your view from what happened in October and December to what happened in February. We got a 25 basis point cut. I'm sure your minutes which are coming out shortly will explain the reasons, but if you want to share a couple of things, and more specifically, is this rate right now? Is it with the current economic condition, is this where it should be in respect of the neutral rates? Of course, you have a right to say whether it should be accommodative, below the neutral or higher than neutral, but where do you see this?
So I'll keep this very short. I know you're trying to extract some forward guidance out of, so I mean, the first thing is the forecast inflation trajectory, whatever, both of the Reserve Bank and the survey of professional forecasters, a bunch of economists who responded, both of them show a very, very close, a very, very converged rate coming down to about 4%, 4.2% at the end of FY26. That's what gives me some comfort. There are multiple risks in this current environment, as you know. So, I mean, since the December policy, and people say that, maybe in December you use this as a currency defense mechanism. It was not. I mean, in December, the last inflation print was 6.2%, which was above the upper band of the inflation target. It would be really, cutting rates at that point in time putting it mildly, would not have been good optics. So that's what comes in now. Very briefly, MSME rates. I had written this in my last minutes in the December meeting.
I think the minutes are just out.
So the cuts. Smaller companies do pay a significant part of as part of their interest cost. So I mean, it's going to help, and particularly now that MSME rates are repo linked, EBLR linked, its transmission to that segment is going to be very rapid. Neeraj will talk about this. So that are probably the two reasons that gives me some comfort. Policy at neutral, because that gives you that optionality of the next step. So, I mean, given the current circumstances, it would have been premature, I think, at this point in time, to go to accommodative from the neutral. So,
do I take you still have space? It will depend on the forward-looking data.
Absolutely. I mean, very, very data dependent.
Okay. Poonam, do you have a view on this? Where the rates are?
I generally stay away from talking about monetary policy because I think there's so much more that matters for growth. And again, there is an obsession about each MPC and each policy rate. which means that many other important issues have been crowded out with the euphoria that gets built around this. So I've stayed.
Fair point. That's okay. So, Neeraj, I'll turn to you. I mean, my own view was that maybe it was not so much the rate issue, but the liquidity issue. So, I mean, with inflation at 6.2, it's hard for a central bank to cut rates when the target is 4, so it's above the tolerance limit. If you wanted, you could have cut that in October, but maybe it may have been a close call. I don't know what were the paramount, whether enough forward-looking assessment was there at that stage or not. Q2 results were not out at that juncture. But liquidity was obviously tight. I mean, we are today seeing a reserve money growth of 4.1% year on year. So not enough primary money is getting created. So how much do you think that had an effect on the slowdown? And was the liquidity crunch essentially because of the Forex operations? Is it addressed given the operations which have been done by the Reserve Bank? Or is it still disruptive? Liquidity is disruptive to the production processes. So more needs to be done?
Yeah. Thanks, Mridul, and thanks to you and NSE for giving me this opportunity. Before I launch into my liquidity sort of conversation, just a quick set of data points for our audience. Poonam talked about the fiscal deficit and the debt to GDP ratio. I just want to share some data with you. India's public debt to GDP ratio is currently at about 83-84%. OECD average, sorry, not OECD, Euro area average is 88%. France is at 97%, UK 92%, US at about 113%. So looked at from the lens of debt to GDP ratio, what is developed and what is developing, I think is a bit of a question mark now. And put this in the context of the fact, and I was listening to Scott Bessent this morning talking to Bloomberg about...
Sorry for interfering here. I mean, when you are comparing these numbers, are you trying to say that these numbers are good enough for India, or is there a debt sustainability issue?
What I'm saying is globally, the equation between what used to look like a developed market economy from a debt to GDP ratio point versus what used to look like a developing economy, that equation has completely changed. And this goes to the point that do we need a new macroeconomic framework? Probably yes. And part of the reason I say this is because if you look at three large economies, France, UK, US, they're all running at about 7% annually. This morning, I was mentioning about Scott Bessent's interview with Bloomberg. He said that they're running at about 7% fiscal deficit. For them to get down fiscal deficit by 1%, they need $300 billion of government spending saving. So to get from 7 to 4%, and even 4% in a historical context will be very large for a market, they need $1 trillion of savings. It's a tough one. So how fast will these economies will come down to a fiscal deficit to GDP ratio of what is considered to be acceptable is a big question mark. And what does it do to the market is a big question mark. I just want to start with this initial emphasis, preamble to say that
I would just add that the Trump administration's 1.0 tax cuts would expire at the end of next year. So we need to see what happens to the US debt sustainability when those numbers are...
So my point is that a lot of what Doge seems to be doing seems to be a bit of a maverick thought process, but you look at it from an American fiscal sustainability point of view, it seems like there is no choice. Where is the choice, right? So now come back to your question on liquidity. I think the biggest culprit, if I may use the word, in the dramatic change in the liquidity equation that we have seen is RBI's foreign exchange operations. If you just share some data with you, in September, around 27th September, our FX reserves were roughly $705 billion. We're currently at about 600 so we've kind of lost about $45 billion in terms of reserves. right? That reserves contraction, if the money supply had to remain the same, if the reserve money had to remain the same, this level of reserve contraction would have basically meant that Reserve Bank replaces this asset, which is called NFA, net foreign currency asset, with a net domestic asset, right? That hasn't happened. So Reserve Bank has not actually replaced the loss of NFA with an equivalent amount of NDA.
So they haven't sterilized the flows.
They haven't sterilized the flows.
Whereas I did read from the Reserve Bank earlier that they had almost fully sterilized
Yes.
the flows. But
So the way, I mean,
numbers,
again, there's a bit of a technicality here. At the end of the day, no bank defaults on CRR, which means that every day Reserve Bank supplies the liquidity that the banking system needs through its variety of instruments, whether it is VRRR, STF, MSF, etc., etc. So the question always is, what is the level of sustainable long-term liquidity that is being provided to the system as against, say, an overnight operation or a short-term operation? An overnight or a short-term operation to cover up for this unsterilized loss of reserves creates liquidity stress in the system, right? So if the sterilization also needs to have a timeline to it and a tenor to it. So what's happened in the current context is that a lot of this sterilization is effectively happening through provision of very short-term liquidity, which is overnight VRRs or 3-day, 5-day VRRs. The recent set of interventions by Reserve Bank have actually extended the tenor of it. They've started providing a lot more liquidity through 45-day, 54-day VRRs. And they've also started doing open market operations of longer dated securities, so which means that they have taken the steps to inject more long-term liquidity in the system. But given the loss of reserves that we have seen, and there is another complexity to this, that there is a forward sales also that they have done. And that equation is
almost
turned by
70
almost
billion
$70 billion,
position.
correct. So
If
at
you
some
add
point in time
to-
that, if the flows, capital flows don't come back in, that will convert itself into a further loss of reserves, right? So the cumulative amount of long-term liquidity that Reserve Bank needs to supply to the market, in my sense, is maybe of the order of 3 to 4 trillion INR, 3 to 4 lakh crores, right? And the long-term liquidity that they have supplied so far is far, far short of that requirement, which is why, while Shagato talked about the transmission of the rate cut into the borrowers, for the banks as borrowers, there has been no transmission. The money market rates are pretty much there where they were before the rate cut. So today, as a bank treasurer, when I borrow in the market, I'm actually borrowing at the same rate pre-rate cut. It hasn't made a difference to me. So I think.
So where do you see INR USD, say, 3 months down the line and 6 months down the line?
It's a very difficult question. I mean, I wish I had the crystal ball to answer that question. But again, if you can give me like 30 seconds, I'll share some data with you. We typically look at rupees performance under an EM basket. From October 23 onwards, and I'm using October 23 because that's the time the Reserve Bank embarked on a steady currency, quote unquote, strategy. To now, EMFX basket has depreciated by roughly 4.7%. From that point to now, rupee has depreciated by roughly 4.2%. So if you look at the measure of how much rupee has depreciated in this period of time, we're pretty much in line with where the EM basket is. But of course, people start looking at RER valuations and stuff like that and arrive at a different answer. There is no one clear answer to this question. I think rupee will continue to be under pressure simply because we are at a point in time when, even though our current account deficit is very well behaved, we're less than 1% of GDP, there is a complete dry up of portfolio flows. There is a complete dry up of FDI flows. So a capital account is a serious problem.
But at least the reversal of FDI has stopped in the latest numbers.
That's right. So
yeah,
FDI numbers are close to zero. We've not added any FDI in this period.
Yeah.
I think a lot of rupees performance from here will depend upon what happens to global portfolio flows from here until over the next 3-4 months. And that's clearly a function of what dollar does. And that's a long story in itself, so I'll stop here.
Okay, Poonam, what about, or maybe Ranil first, what do you see as equilibrium exchange rate for India and whether exchange rate is an automatic stabilizer and we should allow it to be flexible is my question to Poonam after that.
Sure. We don't make an estimate of what the equilibrium exchange rate is. We actually are supposed to look at this, but we do it kind of a different way. We look at what is...
You do have EBA and...
I know, that's what I'm going to explain. So what we actually look is at the current account deficit, right? The current account deficit. So, and this is actually getting back to one of Niraj's points. So the way we look at what is a sustainable current account deficit for India is traditionally we've thought a 2 to 2.5% current account deficit is sustainable for India, and then we kind of back out what that means for the exchange rate. But it's not a direct estimate of what is the equilibrium exchange rate. It's more what is an equilibrium current account deficit. But what stands out for India recently is despite a very strong, for us, in our view, of what we would consider a strong current account position. Yes, it's in deficit, but it's a lower deficit than what we think should be sustainable for India. Why, in recent times, has the balance of payment situation deteriorated in the last quarter or so? And it gets back to what Niraj said. It is this shocking development for India that when you look at FDI on net, right? When you look in gross inflows, repatriation of FDI, that's really what's picked up. And finally, Indian FDI investment abroad, it's been zero. So yes, you always have portfolio inflow volatility, but what's really different and interesting right now, and one issue we're trying to look at is why net FDI has dried up for India. When India is the fastest growing large economy in the world, and thus should be attracting a lot of FDI.
But that could be a function of the valuations where equities are, and it could revive in the period of time. It's also the risk aversion which set in after the global geopolitical change in US activities and what the Fed was doing, the interest rate differential. So all these factors were behind this.
Can I just come back? I mean, historically on India, the interest rate differential, if you look at it, has an impact, but traditionally what matters for India is also its growth, right? Especially for FDI. So whereas for other emerging market Asian economies, I'd be more concerned about the interest rate differential. For India, a large concern has to be about growth and growth prospects.
Fair point. Poonam, the exchange rate flexibility, how should we have the exchange rate regime? It's true what you said, that emerging markets can't have freely floating.
Yeah. So again, given the kind of work I have been doing, 25 years since I completed my PhD has been on similar issues. And it's important to look at both India's long-term experience and experience of other emerging markets. So since the early 2000s till now, emerging markets, including India, have become increasingly more open to capital flows, which means that they are impacted by inflows and outflows. And the way to handle the impact is through a combination of exchange rate and reserves. You cannot rely on any one of these two variables and handle the capital flow cycles well. So in India, for example, in the last 20 years, there have been two periods when the burden of this adjustment was given to one of the two variables. So you would recall, Mridul and many others would recall, that right between the global financial crisis and the taper talk, there was an effort by the RBI to not build reserves and let the exchange rate be the sole shock absorber. And it resulted in reserves being stagnant in absolute terms, not even as percentage of GDP, and they declined as percentage of GDP. Exchange rate became excessively volatile, real exchange rate appreciated, and India was impacted disproportionately by the tapering talk. Current account deficit was high, inflation was high, reserves buffers were not built, and current account deficit, I've already said, etc. Real exchange rate had appreciated. Another similar period we saw was in the last year or so, when the sole adjustment became the reserves. Exchange rate was kept flat. And again, for most part, it has not been an ideal situation, right? So an ideal mix is you are adjusting through both. The exact component is not well determined, and this is something that the central bankers have to figure out. So some volatility in exchange rate is needed. Extreme volatility does not work well. You have to build your reserves and you have to use them when it's the time, and it's a combination that works. You asked about the fair value of the exchange rate. I think maintaining your real exchange rate is not a bad idea, right? You cannot become competitive for a long period of time working only through your exchange rate. It has to be matched by real competitiveness. To say that let's just let the exchange rate become, depreciate and we get a bigger share of the global trade market, for most part it does not work like that. You have to have real competitiveness. And I think for most part, being within a tight range of your real exchange rate is not a bad idea.
Okay, we have another 10, 15 minutes, so let me go fast. Are reserves optimal, or are they excessive? Are they costs?
So we do make an assessment of that. So for India's context, we kind of, for all countries, we have, or all emerging markets countries, excuse me, we have a range that is, so we have a metric that's based on things like debt servicing needs. It's based on actually exports, not imports, and a couple of other things, the broad money, measures of M2, et cetera. And for India, the latest assessment is it's within the range, towards the lower end of the range at the moment. But saying that, your second question was, are there trade-offs, right? So in this context, at this stage, I wouldn't say there are trade-offs, but if reserves do go very high, there are trade-offs. There's opportunity cost to holding reserves. There are ways to measure the opportunity costs, looking at interest rate differentials, et cetera. But also a different way to think about it is there opportunity costs overall in terms of investment in an economy? So
I got it. This is very, very interesting that you're finding reserves not excessive. I mean, I think the fund really has changed its view after Geeta Gopinath's integrated policy framework, and we appreciate that, because with the trilemma which we face, I think reserves also become an important issue if you have too much flexibility in exchange rate, and that's what Poonam also agrees. So there has to be some blend of it and stuff, okay?
So can I add something here? Sometimes Poonam and I appear to disagree, but it's on the nuances. So some people believe the IMF just wants purely flexible exchange rates. No, as you pointed out with Geeta Gopinath, and even before Geeta Gopinath, but she has enhanced it. There is agreement that sometimes exchange rates need to be managed. We do. I think sometimes it's on the degree. She said, Poonam mentioned earlier, when it becomes excessive. I think that's where sometimes the disagreement comes in.
She's dying to add something. I wanted to shift to the fiscal because we are running.
No, but very quickly, I can't let Ranil go without taking a jibe at the IMF. IMF is evolving in its view, and that's great. It's just that they're always behind the curve. They learn from emerging markets than the other way around. So, good.
So just to say, we like learning from emerging markets.
So fair point. But let me now turn to the fiscal. And we had Neeraj raise the issue of debt and stuff. You raising issues about fiscal rules. Also, you wrote today about the state finances. What about the center's fiscal rules? In the budget, is it the fiscal rules have been reduced to a single number of the debt? Is it something good? Is it something which has its own risks about the future fiscal sustainability?
So, at NCR, we have been really investing a lot into understanding the states, and that work will start coming out now. So as I mentioned, India's fiscal deficit and public debt is high. US, France, Japan are not the right comparators. India is an emerging market. That's the asset class. That's what you compare it with. You're not issuing the hard currency, etc., for Neeraj. So now, as I said about rules and frameworks, it's important to have them. It's also important to evolve them. You can miss them, you can be flexible about them for a period of time, but we are a large, confident, fast-growing economy, and we need to evolve those rules. So you're right, about the FRBM in the union's budget. It's just that nobody has written about it. And there is only so much that poor academics can do. So all the analysts who get excited about every MPC every 6 weeks, talk about other issues as well. But more important is the state level. So we, as a part of this work, we have actually looked at the adherence to fiscal rules in the last 20 years by all the states. And the compliance is mixed. And it's interesting, of course, the states which are doing well, both economically and fiscally, have been adhering to the fiscal rules. And then they're serial violators. Then the question is, what do we do about them? Given that I'm a long-term rules and frameworks person, I would say there is a need to look at them holistically. And what I've written in the op-ed is the issue is not getting as much attention is because its costs are hidden. The potential growth rate that we can attain when there is better spending, when there is more private sector spending, when there's more competitiveness, those costs cannot be measured. And therefore, we are a little complacent about the status quo.
Okay. Do you want to add to this?
No, so to Puram's point on whether we should be comparing between developed world and emerging markets on a fiscal sustainability point of view because they can get away with their hard currency status. The only point that I would like to say is that where we are currently from a geopolitical standpoint, and the classical, this weekend we're going to have German elections, and one of the strong discussion points in the election is that should Germany do away with the debt break rule, which is basically stopping it from issuing or going overboard on its fiscal spending. And given the events that have unfolded in the last 10 days, I would say, I see a very strong push to increase fiscal spending across the world. And I think that's the reality that we're living in. Okay. And in that scenario, yes, we are in an EM economy. We will be less, there will be less tolerance about our fiscal mismanagement, but there will be pressure across the world to do more and more of fiscal. And in that scenario, how will the rules of macroeconomics will be written out is the point that I kind of leave
So,
for
Gata, how do you see the fiscal impulse, and is it a factor you would raise in the MPC discussions? So the monetary policy, how should it view the fiscal impulse? Coming from this budget, I'm sure you would have taken an assessment of, but also from the angle of future fiscal rules issue.
No, so very briefly, I think India's the fiscal dominance that used to happen in India over monetary and other policies, that has significantly come down. To this government's credit, they have been very, very fiscally disciplined. My own sense is there is a issue of sustainability. It's not in terms of default or anything. I think net of the 41% that devolves to states, I think about 20 to 22% is spent on interest. This is just not sustainable. There is too much revenue expenditure, and that is cutting into other development expenditures, which I think at this point in time is critical for sustaining growth. Growth is the primary target, which overshadows everything else. Inflation, of course, is inflation. Well, I'm not talking from a monetary policy perspective. That's my mandate, inflation. But I'm saying that right now, my own sense is we are lower than what at the potential growth output, and for that, I think the fiscal side needs to be even more. You cannot cut beyond a point, but I think we are going in the right direction in terms of the fiscal frameworks that the government has put in place.
Okay. Let me now turn to the final. Before that, since we are very close to completing the Article 4 and the FSAP, would you like to give some general perception about macro-financial risks in India?
I cannot really do it in the context of completing the, as Mridul mentioned, actually the IMF board meeting on Article 4 and FSAP is today, so tonight India time. So unfortunately I cannot comment on that.
Fair point. So that's okay. Let me turn to the financial regulation aspects. So basically, how do you view, basically, let me turn this to Neeraj. I think he's the best position to comment on it. There has sort of...
Or worst positioned as a regulated entity.
So there is this issue which has been voiced in the market and among other stakeholders, that the cost of regulation has gone up pretty high. Now, how do we balance the cost of regulation with macro-financial stability objective? So is now what is being done the right path?
So I think, I mean, this is a debate on which there will never be a very clear answer as to is regulation good enough, bad enough, over-regulated, under-regulated. I think finding the balance itself is quite challenging in my view, because there is a regulated entity's view and there is a regulator's view and there is a wider sort of public view, which changes from circumstances to circumstances. I think the only 2 or 3 comments that I would like to make is that regulation obviously evolves in response to the environmental changes. So as technology has become a dominant way of doing business in financial services industry, regulation has also evolved to encapsulate the risks that are coming from technology side and to safeguard the system from those risks. So that is very understandable. Clearly in the recent past, we've seen that expansion of regulation.
No, but here the pushback, though I didn't get the, I mean, I have to, I think none of you were there in the morning. Sogata was there when the bank and debated this issue, and I asked him about the LCR regulation. And there was this appreciation of what might happen in terms of the internet mobile deposits in the LCR calibration, where there was a pushback. But there was also this recognition that these deposits can fly like a jiffy. So,
No,
how do we solve that?
So one aspect is LCR, and I have my views on LCR and whether LCR is the answer to safeguard against that risk. But if I can just make this generic comment to say that, yes, of course, we need regulation to deal with these situations. But we also need to look at that as we add to this aspect of the regulation. Are there any aspects which have now become redundant, irrelevant, because life has moved on? Right?
Correct.
So there is this general principle to say that for every one regulation that you bring in, you should find one regulation that you can take out because it is no longer relevant.
So what do you suggest taking out? The SLR?
So, I mean, no, precisely my point. I think that's a brilliant example that we have now moved from the SLR regime to an LCR regime, and LCR is a global regime, but we are still sticking on to SLR as a requirement.
So
not that it's a dominant requirement.
debt markets for most of your years, I know from your history we have been engaging. How do you see if SLR is withdrawn, the government borrowing, how it will
No, but
get
LCR is there. In fact, today I end up maintaining more liquid assets under LCR than I'm required to maintain under SLR.
Fair point.
Right?
I precisely have this.
The point on LCR that I'm making is that India is the SVB crisis happened in US, right? It was a mid-sized bank in US which came under this pressure. India is probably the only jurisdiction which has proposed imposing LCR requirements on mobile banking deposits.
Okay.
Not even US has proposed it.
Fine.
So I think there is to be some calibration on what I'm trying
point
to
taken.
achieve, right?
What about the ECL framework and the project financing norms?
I think some of these things have to be calibrated to our national requirements. We know that infrastructure spending in this country is going to be a big issue, whether banks do it, whether NBFCs do it, whether development finance institutions do it, whether this level of capital requirement upfront what is the ability of these institutions then to able to fund infra needs to be thought through. I think it's a key point for us, and therefore we should not rush into it.
So we'll open up for questions unless, Poonam, you want to add to this anything? No, fine. So let me just open the floor to Q&A and then we move on to the last valedictory. Couple of questions if you want. Yeah, please. Somebody can hand over the mic.
Hello. Yeah. Very interesting discussion. So I'm Sargam from IJDR. I have a, so what is the view of panelists on de-dollarization? Maybe this topic might be a little bit dated also, but is it, so I was seeing a recent report, maybe I think it was from IMF only. So if you look at the reserves component, like especially the dollar reserves, which the emerging markets are holding, it is gradually going down. So do you see that de-dollarization is really happening, especially among the emerging markets? And this recent effort, which I think one of the panelists was talking about, this unsterilized loss of reserves is part of, maybe subtle part of this whole de-dollarization effort, which emerging markets are doing.
So Ranil and Poonam. In short.
I'll refer to the work done by Professor Barry Egan-Green on this topic, a frequent co-author. I haven't done anything myself. So he has done a couple of papers on this issue over a period of time. So he notices first, yes, the role of dollar as a reserve currency has been declining in the balance sheets of central banks. But the decline is small and gradual, which means that dollar remains dominant. Second is what kind of currencies are replacing dollar in the central bank balance sheets. And these are non-traditional currencies. Singapore's, New Zealand, Australia's, to some extent even South Korea. So that's all I can reflect upon. Yes, a decline, a very gradual decline, quantitatively not very large, to the extent that dollar does remain dominant.
Roughly what Poonam said, exactly, Barry's done some work on this area. There's a view of central banks that as part of their reserve management, they need to diversify more. But the diversification has been very gradual. In addition to what Poonam mentioned, there seems to be an increase in gold holdings again after they had reduced. And then because of trade purposes as well, there's some increase in the Chinese yuan.
Hi, Neeraj, you are complaining about transmission not happening. So as we speak, maybe RBI heard you and announced a 10 billion FX swap, 3-year long term. So many more, maybe announcements are yet to come. So would you be more hopeful about transmission in a few months' time? And just another question for broader, the audience. RBI has cut 25 basis points. Suppose RBI did not cut 25 basis points. Would you think rupee would not depreciate or appreciate? Does a 25, 50 basis points rate cut move the needle for currency? Whereas if they don't cut, do you see the sacrifice to growth as more compared to, say, the rupee, which if you think would have depreciated anyway if RBI cut or did not cut 25 or 50 basis points?
So to answer your first question, of course, as I mentioned, the Reserve Bank needs to do a lot more long-term sterilization. I think this is a part of that. So to that extent, yes, it's of course going to help. But it's coming in dribs and drabs. It's not sort of coming in one big package of, let's say, 2-3 trillion INR, which is then addresses the whole liquidity deficit that we're looking at from here until March end. So to that extent, I think it still kind of leaves a little bit of pressure on the market, and I'm hoping that steadily this will get addressed. I think I can also understand from Reserve Bank standpoint that they're dealing with so much uncertainty on flows that if you end up sterilizing all of it at one go, then would you end up sterilizing, rather would you end up injecting too much liquidity in the system that later on becomes a problem. So I think there is a balance that needs to be struck. But I don't expect from here until 31st March rates in money markets to come off, simply because last quarter banks are aggressively chasing deposits. So I think that pressure will stay. We'll see what really happens after 1st of April.
Yeah, the last question.
Good evening, panel. I'm Harshad. I'm a student at IGIDR. So I have a question from a regulatory point of view. So over the past few years, we have seen a rise in consumerization of credit in India. And now we are seeing that some of these have started turning into NPAs. And given these are uncollateralized lendings, what does this say, what is the way forward with respect to stability, given that we have just come out of a NPA crisis in the previous decade?
Harshad, can you just again spell out the full question? Why don't you come ahead and do that? It's not quite audible here.
So, so we have just come out of an NPA crisis in the previous decade, and there has been, in the current decade, there's been a rise in consumerization in India. And we have seen that some of these uncollateralized lendings have been turning into NPAs. So what is the way forward with respect to stability?
Unsecured advances he's talking.
So look, I mean, my perspective on this is that we reach a stage where the credit costs in the system had become quite low, historical standards, right? A certain amount of credit losses are a part and parcel of doing business in banking, right? So I think there is some normalization of that credit losses that is happening at this point in time. Obviously, there are few pockets of business where we are seeing this impact. It's not generalized, it's not across the board. It's only certain pockets where we are seeing this. And banks have, by and large, banking system has calibrated its lending in those pockets. So there has been a pullback in lending to MFIs. There's been pullback on unsecured lending across the banking system. Also bear in mind that these are short-term loans, 1 to 3 year maturity. So the system should be able to address whatever is coming at this point in time. Most of the banks seem to have adjusted their, lending standards, etc. So I don't think it's a systemic issue in that sense. I think we have a little bit more sensitivity to it because we're coming off a very, very low credit cost environment, right? And suddenly some of these costs are coming back into the system.
So ideally, if we would have got an ECL framework, the expected credit loss framework, then this question would have been better addressed. But apparently, the banks are not in a position to do that in absence of.
I'm sorry, I disagree with that.
Yeah.
ECL is an issue of providing for a future NPA today, right?
Right.
It's basically making sure that the balance sheets are fortified against future losses.
But the expected, the unsecured advances, expected losses will get priced in.
Let me just complete. One way to look at an ECL kind of a situation is what is the provision coverage ratio in the banking system, right? My assessment is that the provision coverage ratio in the banking system is quite robust at this point in time. And whatever is happening in the unsecured segment, banks are in a position to absorb these losses without having too much impact on their capital, right? So I don't think ECL framework would have protected you against this. This is a business cycle. It happens in credit cycle. You go through cycles. I think historically, after 2014 to 2018 cycle, we entered into a phase where credit costs just kept on coming down quite sharply. And now there is a normalization process that is happening.
Okay, fine. That's a good view. So do we end it here, I think? So on this note, I think the final word is that the Indian financial system is pretty stable, and we agree with you. We were just discussing some nitty-gritties of this to see, are there fragilities? Are there something we can address better? Okay, thank you. Thanks, panel.
Thank you so much to all the panelists. I request Dr. Tirthankar Patnaik to please come on stage and felicitate. We have mementos from the state of Kerala too. Thank you so much. We have now come to the final session of our conference. We have the honor of hearing from one of the most respected figures in the Indian banking and finance, Dr. D. Subba Rao, former Governor of Reserve Bank of India. This special session will be in the form of a fireside chat with Ms. Ira Duggal, the India Financial News Editor at Reuters. Can we have the speakers on the stage, please?
Very good evening to all of you, and thank you so much for staying with us this Friday evening. But you wouldn't want to miss this conversation with Dr. D. Subba Rao. There's no better way to spend a Friday, literally. So very happy to have you here, sir. And actually a lovely way, the panel before this was absolutely fabulous, engaging, brought together some of the issues that we are facing and debating today. And now, sir, we have an opportunity with you to look back a little bit, but also tie things to what we are seeing today, because in many ways, the more things change, the more they stay the same. And I'm sure you feel that when you hear the current discourse. So I'm going to start, sir, with asking you a little bit about the economy. Not so much about individual data points, but you would see the discourse in the newspapers these days. There has been a slowdown in growth, and once again, we are discussing whether this is a cyclical slowdown or a structural slowdown. You've seen this debate play out so many times through your career, first as a top bureaucrat, then as a central banker. So I have to start by asking you, A, what you think of the current economy, but also what feelings and thoughts go through your mind when you see these same headlines every 5 years almost?
Thank you, Ira. First of all, I want to say that I don't have all the answers, nor am I answerable anymore. So listen to it with a pinch of salt. The question about whether the slowdown today is structural or cyclical, opinion is divided. Some people think it's cyclical, some people think it's structural. People who think it's cyclical argue that there's global headwinds. There is 2 wars going on in Ukraine and the Middle East. There's trade and tariff wars. The domestic headwinds, there is monetary policy was tight for the last 2.5 years, except for the last policy decision. There was fiscal consolidation as well. So given these headwinds, growth had slowed, but this is going to repair. Global situation is going to improve. Domestic situation has started to improve. Reserve Bank has started to cut interest rates. And the public investment done by the government is going to crowd in private investments. So these cyclical trends are going to reverse. And it is a cyclical slowdown. On the other hand, people who think it's a structural slowdown argue that, look, the economy was already slowing down. Throw your mind back to 2016, 17. We'd gone from 7% to 6% to 5% to 4%. So economy was already slowing down. The growth we saw in the last 3-4 years is a rebound from the COVID dip. First, fueled by consumption, because people, revenge spending and all that phrases that you people coined. And over the last 2 years, government spending. But those engines have dried up. Today, where are the growth drivers? There is no consumption. Economy is growing at 6.5%. Consumption is growing at 3%. And consumption has to be our biggest growth driver. For an economy like ours, we can continue to grow only if we put income in the hands of the low income segments. We're not doing that. So consumption is not going to help. Private investment has declined. Private investment was 25% of GDP, it's 12 to 13% of GDP. Exports, the global situation continues to be dire. And it's not just Trump and trade wars. It is also the structural factors, aging factors, demographic changes, secular stagnation. So it requires a leap of faith to believe that the global situation is going to repair in short order. So people who argue that it is structural slowdown ask, where is the structural growth driver? Okay? So in my own view, I think the slowdown is largely structural, partly cyclical.
So is this debate any different from the debate you were having when you were there? Some of these issues, surely you think back to having had this conversation again and again, many times over the cycles.
Yeah, we had gone through our own version of great moderation just before I came into the Reserve Bank. Then we had a global financial crisis, and then stagflation and policy paralysis. So we've gone through cycles.
That's true. There's another similarity between the current situation, Dr. Subbarao, in some way, and when you were there. So, one of the factors that, in a rare comment, the finance ministry attributed to this slowdown was some of the central bank's regulations. The RBI had tightened personal loan rules. They were sort of keeping liquidity very tight. And I think late last year, in one of the economic reports, the government actually put it down in words, which is rare, blaming part of the slowdown on the RBI's policies. As I was just sitting at the back, took me back to the government saying, we must walk alone. Yeah. These frictions, particularly on regulation, not just on interest rates, do you see them becoming more and more sort of extreme? Do they become tougher to maneuver with the government? Because in interest rates, you have 3 variables, growth, inflation, and a rate. But a judgment on regulation is very difficult to make, right? On whether it hurts growth, whether it's prudent right now for future gains. How did you deal with that in your time?
You're talking about India or around the world?
India.
India. See, differences between central banks as monetary authorities, and in the case of the RBI as a regulator, and the government are somewhat hardwired into the system.
Hardwired?
Because there is the issue of monetary policy, the growth inflation trade-off that was discussed in the earlier session. We can get back into that if necessary. But that trade-off is always there because there is a horizon difference. There is the government which has driven by electoral cycles, or short-term horizon where there is the central bank which is enjoined to take a long-term view. So there is that horizon difference which creates a friction between the government and the central bank. It plays out around the world, it's played out in our country as well. On regulation, the differences are more subtle because the markets, financial sector people understand that, but the larger public don't understand the nitty-gritty of regulation. And government's interests on regulation are varied, actually they don't have my own experience is that the government doesn't have an interest on a specific regulatory issue. They have an interest in generally regulation being loose enough to drive economic growth, somewhat akin to the growth inflation trade-off, but they don't play out as prominently. In individual cases they might, okay, but they don't play out as prominently. Yeah.
But do you not think that, and the chief economic advisor made this point in his economic survey this time around, that there needs to be a clearer way to do a cost-benefit analysis of regulation? And I'll tie it back to your period as well in a minute, but is that something that you think is a direction we need to take? Is that something that, sort of something you debated during your time as well? Announcing a regulation will have some impact today. It will have another impact, 2 years, 3 years down the line. And again, stakeholders will have different reasons to want it or not want it.
No, it's very appropriate that we are discussing this when lots of students are here. Of course, we must have a cost-benefit analysis, but if we can have a cost-benefit analysis, it's very difficult to quantify costs and benefits, especially putative costs and benefits of a particular regulation. Regulators do that. The RBI does that to some extent. I'm sure that the other regulators in the financial sector do a cost-benefit calculus, but not in exact numbers because it is difficult to quantify what will be the cost if a regulation had been implemented or had not been implemented. And if you ask the regulators to quantify every cost and every benefit, I don't think they can move forward. It's very difficult.
So just to put, the one proposal that was there in the economic survey was to say that there is a board-level committee which at the RBI or at SEBI which weighs some of these cost benefits. Sorry to throw this at you, but would you be in favor of something like that, or do you think it will delay regulations too much? And
Excuse me?
do you think, a cost-benefit analysis done at the board level, at the regulatory board level? Because I think the concern here also is that one person is making the judgment. Should there be a bigger judgment at a board level of the regulator?
I have no experience of that, but the Reserve Bank is a fountain of knowledge. The hierarchy is data to information to knowledge to wisdom. And I think the Reserve Bank has the capacity internally to move forward, to move higher up there. Having a consultative body is good. Just like the Reserve Bank consults stakeholders before monetary policy decision, they do consult regulators, maybe not on as systemic a basis, but they do consult regulators, they do consult markets, stakeholders on an informal basis, on an individual basis, and that feedback is reflected into a regulation. Whether that should be formalized, I am not very sanguine about that because it might tie the regulators' hands. They need that flexibility to act as an institution without having to be tied down by a decision of a body that is external to the Reserve Bank, because, I didn't have an MPC when I was there.
Yes, you didn't.
But now there is an MPC. We had something like the Technical Advisory Committee. It's not exactly an answer to your question, but I want to say this as well. And the TAC minutes we used to put out, one of the charges, criticism against me was that most of the time I did not agree with the advice of the TAC. And many of the members of the TAC were put off. Like they thought that we were disrespecting them, that we had consulted them, but we were not following their advice. The response I gave to them was that as the governor and as the Reserve Bank, we have more information than other people. Okay? So when I act, I'm acting with, from a much larger universe of knowledge than do individual consultants or individual stakeholders. So there is bound to be a difference of opinion between outsiders and the central bank or a regulator which has enormous amount of knowledge coming in. It's not just people like you coming and telling me. There is so much of information you get when you're inside the system just by a process of osmosis. If I come into a conference at the doorstep, somebody might tell me something. That'll stick in my head. So there's a lot more information input into a regulator set that happens as part of the job. Okay, that's why there's bound to be a difference between experts and regulators.
So you're basically saying if you tie the regulator down too much in too many processes,
well, I'm saying
there is
that
a downside to that as well.
I'm also saying that regulators are operating from a larger and deeper universe of knowledge.
Dr. Sabra, I want to take you back to one other experience of yours, which I think would be very, very useful to hear in the current point of time. And this is something you have publicly admitted, that there was very rapid loan growth, which then led to an NPA crisis later. And perhaps somewhere you sort of thought that could things have been done differently, although in retrospect, it's always easy to make that. Currently, we're in a period, and in the morning, Dr. Rajeshwar Rao was here, and he was talking about how technology could potentially lead to excess financialization, lots of loans, small loans, just credit for personal consumption. And there is pressure. The RBI wants to try and curtail that, but that was one of the reasons the economy did slow. How do you balance that? How did you deal with it when you were faced with that very rapid loan growth, where you knew that if you perhaps came in and stopped it, you would then be blamed for a slowdown?
Yeah. It's very difficult to identify a bubble in real time. I mean, this is not just in India. It's been proven by experience. If, in fact, it's possible for anybody to identify a bubble building up in real time, we would never have a crisis. And people have, I think, some Nobel Prize has also been given for this, that the financial system can withstand pressure much longer than people expect it to, right? So pressure builds up to a point where when implosion happens, it's catastrophic. That's the nature of the financial system. And so when we were talking about NPAs in real time, we did, I accepted responsibility for the build-up of NPAs, which started in my tenure as the Reserve Bank governor. But again, this is not so much to defend myself, but to explain, which is that it is difficult to identify a bubble because there's always a worry that you're anticipating a problem that doesn't exist. Like just as you mentioned, I fear NPAs building up and scorch the system, and I'm actually cutting down growth. So how do you balance that? Are you making a correct judgment about this? And NPAs built up during that time for a number of reasons. A lot of people attribute it to crony capitalism. Crony capitalism was only one of the reasons. I can go on citing all those reasons, but that's not the point here. The point is that it is difficult to predict a bubble building up in real time, so they build up to at least the risk level before you identify them.
I'm curious, did you have pressure from the government at that time to keep that loan growth going? I'm just curious to know.
No, not
on that front.
Not on the central bank, certainly. People have talked about it, but certainly not on the central bank, no.
So I'll come to the growth inflation trade-off, which was being discussed, and I think Poonam ma'am made a really important point that these frameworks can't be static. I mean, you have to keep evolving with the times. How do you see the current inflation targeting framework? Do you see it as appropriate even now? Do you think that there is rethink needed either on which inflation to target or what the band should be or how frequently it should be revised? In the current context of this growth inflation debate, where are you on the framework?
About inflation targeting? See, the objectives of monetary policy are price stability, growth and financial stability. Price stability, growth and financial stability. But these three objectives do not rank pari passu. Price stability takes priority over growth and financial stability. So under the inflation targeting framework, if inflation is beyond the target, the primary responsibility of the central bank is to bring inflation to the target range. But once inflation is in the target range, the central bank is enjoined to keep in view financial stability and growth concerns. The criticism against inflation targeting framework has been that in its obsession of delivering on inflation targeting framework, central banks are sacrificing growth. particularly the Reserve Bank is sacrificing growth. Therefore, there must be a review of the inflation targeting framework. I don't believe that we must throw away the baby with the bathwater. We must, I worked in a pre-inflation targeting framework. I believe the inflation targeting framework has been a force for the good. So I don't think we should throw it away. But we should see how to marry concerns of growth and inflation and how to manage the trade-off. People believe that there is a trade-off between growth and inflation. When inflation is above target, central banks raise interest rate. The purpose of raising interest rate is actually to cut demand. Yes. And when you cut demand, growth goes down. So there is some growth-inflation trade-off inbuilt there. But that trade-off, that tension, is only in the short term. In the long term, low and steady inflation is a necessary condition for growth. I also want to say this. In a poor country like India, out of 1.4 billion people, 800 or 900 million people are low income. For them, inflation hurts more than growth. And I think it's very important that we keep our focus on inflation. The other debate has been, even though you've not asked earlier, in the earlier session, this question came up about core inflation, headline inflation. See, there is a problem about the appropriateness of the CPI basket. It needs to be revised. But the fact remains that food is a big component of India's inflation basket because 900 million people live at that level. Food is a big component. It is food inflation that they experience in the market every day. It is food inflation that sets market expectations. To believe that RBI must target an esoteric number that people don't relate to, but abandon food inflation, I don't think is correct. So we must continue to target headline inflation, but change the basket if necessary, simply because we are a low-income country.
So, but actually, before we went to inflation targeting, many of you were cautious, you, Dr. Reddy, because you knew that there would be situations in India where food prices would go up because of supply shocks, which is what happened last year. There was, heat-related disruptions which pushed up food prices. Core was very low, but they had to keep rates high, and you had, perhaps some amount of the slowdown you're seeing now is because rates remained high. Those dilemmas will remain with inflation targeting. Do you sometimes think that the multi-indicator approach was better? There was more flexibility with the central bank?
I don't think so.
No.
See, the multiple indicator approach was something I worked under. I think it gives too many degrees of freedom to the central bank. And it makes it difficult for the market to predict how the central bank will behave, because no matter what you do, you can justify. And there is somebody like analyst like you who will justify whatever we do. I think there must be more accountability from the central bank about what their targets are, where they're heading. So I think the inflation targeting framework, warts and all, is still better than the multiple indicator approach, even though I enjoyed that freedom.
Okay. So I'll move to another aspect of your period where your experience and your challenges will be great learnings right now, and that is a challenging global scenario. I mean, you faced one of the most challenging global scenarios. We are in a year, this year, when everything the RBI is doing in many ways is getting dictated by what's happening globally. I mean, some global local factors as well, but on a daily basis, the intervention, then infusing liquidity, they're just reacting to what is happening globally. How did you deal with a situation where you were at the reacting end and had very little control in some ways? It must have been a challenge. It must have been a huge challenge.
Yeah, it's certainly a big challenge, because we not only have to respond to what's happening in our market, but to respond to what's happening outside. During the global financial crisis you referred to, in fact, this is the point that emerging markets consistently made in the G20, in the IMF meetings, etc., that the crisis originated because of some sins committed in America and in advanced economies. Okay, we were all one system, it transmitted around the world, so we got hit as well. But you, America, Europe, you're responding to your situation, whereas we have to respond not only to what's happening in our market, but what you're doing. So you must tell us. Not that the Fed will call me up and say, okay, Governor, RBI, tomorrow we're going to cut interest rate. That's not the point. The point is that we must know beforehand how you're reading the situation. And to their credit, I must say that the US Federal Reserve and the Treasury actually responded to that. They used to have a conference call of emerging economy central banks and tell us their understanding of their situation. If you read the Federal Reserve statement, their FOMC statement, RBI MPC statement, RBI MPC statement is 2-3 pages. It has 3 paragraphs on the global situation. The FOMC statement, does it have anything on what's happening in India? What's happening in Korea? In one G20 meeting in Korea, one central bank governor for an emerging economy, I would not name him, he actually asked Ben Bernanke, Ben, when we do our policy, we say, what is happening in America? What's happening in China? What's happening in Japan? Do you ever think of us when you do your policy? And the response was a sheepish smile. Okay? So we do have to respond to global situation. That's a given that we are takers of the global situation. We do not create the global situation, not yet. I hope we get there sometime.
What do you think of the current situation, Dr. Subbarao? Massive changes possibly in trade, in supply chains, in tariffs. I mean, I've been reading tons of reports from economists, and even they are, at a loss to explain how this is going to play out.
I'm at a loss too,
but thoughts
I'm no more informed than anyone else. Trump has been in office, today is 21 Feb. He's been in office for just a month, and the world is already overwhelmed by his policies, his threats, his tactics, etc. And just 2 comments I want to make, which is that first, as far as Trump is concerned, he's made all these threats. Canada, Mexico has given them reprieve, China, tariffs on aluminum and steel, reciprocal tariffs is talked about. It's not clear to what extent it's going to go forward. It's not clear to what extent they will retaliate. It's not clear what sort of deals they might reach. There's too many moving parts, and I don't think it's possible for anyone to make an informed guess. The second comment I want to make is this, which is that for all Trump's bluster, it's unclear to what extent he can carry it forward. Because he's not only threatened to slap tariffs, he's also promised to cut taxes. He's vowed to deport illegal immigrants. So tariffs on imports, cutting taxes, deporting illegal immigrants, all these 3 things are going to fuel inflation in America. To what extent is the American public going to countenance this inflation? There'll be a cost of living index problem, and there will be some backlash. And Trump is ultimately a politician. And the ostensible objective of Trump's threats or tariffs or whatever is to reshore manufacturing to America, generate jobs in America, and reduce America's trade deficit. It is not clear that it's going to achieve this. In fact, what might happen is the opposite. Because of tariffs on Canada, on Mexico, on aluminum and steel, the cost of car manufacture in America is going to go up. Production might go down. Some jobs might go down. So jobs will go. Manufacturing will not come back. Trade deficit might actually increase. And Trump is ultimately, I think, a captive of what happens on Wall Street. Wall Street is going to react to this. So it's not clear that he will carry through all this bluster. And we in India and around in emerging markets, we've got to be prepared for that.
How do you think we can be best prepared? I mean, just not in terms of individual policy decisions, but do you think there is sort of, coordinated monetary policy, fiscal sort of, package or statement that needs to be made?
Monetary policy, fiscal policies are concerned, but about tariffs, The point is, From an Indian perspective, America is a big deal because America is our largest trading partner, is one of the few countries with which we have a trade surplus. From an American perspective, we're a small player because China, Mexico, and Canada account for more than 2/3 of American trade deficit. India accounts for just about 3.5%. So we're a small player. But Trump has still threatened, and this not only when before Prime Minister went there, while the Prime Minister was there, after the Prime Minister came back, he's been threatening India. And we've already made concessions during the budget, before the Prime Minister's visit. During the Prime Minister's visit, we promised to import more energy, more defense. We're talking about an FTA. We're talking about actually reducing our trade surplus with America. And if the FTA, let's assume the best possible scenario for India is that we have an FTA, or at least a limited FTA before September. That's the deadline. And Trump continues this tirade against China and other countries. That's the best of all possible worlds for India, right? Then we can hope to improve, trade around the world, because last time Trump imposed tariffs, we benefited from the trade diversion. Okay, this time same thing might happen because it is not tariffs against China. Tariffs against China hit other East Asian countries because they're all interlinked. So we can take advantage of that. Also, as a +1 destination in China +1, we have a prospect of becoming the +1. That is provided we can get our act together, And that's a big if, because we've got to improve our productivity, we've got to improve ease of doing business, we've got to improve our credibility. That's a big, big deal.
Just to tie it back to where we started, the domestic economy, isn't this the time when it's really important to do something, which lifts the animal spirits, as everyone has been talking about? Whatever reforms it is, package of reforms, but you have to get the domestic economy fired up.
That is true, Ira. I keep, sometimes the Prime Minister, the Finance Minister have never asked me. But so I keep imagining that if the PM said, okay, you keep criticizing us, tell us one big idea that you must implement. Tell us one big deal. Apart from generalities, the skill gap and infrastructure gap and improve the efficiency, create jobs, what is one big idea that you can give the Prime Minister? I'm unable to crystallize in my mind. That one single idea that'll get our act going together. As Dr. Manmohan Singh used to say, there is no single idea answers for India. Okay? All single idea answers of India are wrong. Okay? It's too complex a country.
That is a great learning from him. Dr. Subbaraw, 2 last questions. One actually is linked to this, and I borrowed this question from my friend and veteran journalist, Menka Doshi, who was making the observation that perhaps with the Trump world, the age of central banking leading the world is over. This is going to be the next few years of fiscal policy and political maneuvering, sort of dictating everything around the world, right?
I'm no longer a central bank. I don't think about it so much. But central bankers, GFC, a global financial crisis, central bankers were blamed for sleeping at the wheel, for generating that crisis. And one of the things was inflation targeting. In pursuit of inflation targeting, they neglected financial stability brewing in the underbelly of the financial system. They neglected regulation. And they brewed the crisis. But one thing very surprising happened. Months after GFC, central bankers became masters of the universe, right? And they were being lauded. Time magazine had Bernanke was the man of the year. Central bankers as known figures all over the world. In fact, politicians became jealous of central bankers, right? That they were figuring more prominently. Whether politicians can take over central banks, I think if wisdom prevails, that won't happen. But because central banks, I believe, have played a stabilizing role, have been a counterpoise for governments which are driven by short-term election cycles. So central bankers have a role. And if wisdom prevails, they should not go, but I don't know. You know?
No, I didn't intend to say they would take over central banks. I meant that they will dominate. The politicians and fiscal policy will dominate the narrative more than central banks.
I don't think so, because there are limits to fiscal policy, okay? And there's limits to monetary policy, but at least monetary policy has a clear objective. Fiscal policy, we talked about debt, you know, and in fact, I wanted to comment. I didn't want to comment, but I will comment now. There was some international comparison. I'm sorry, first let me answer your question,
No,
which is
please
that
go ahead.
fiscal policy has limitations because governments cannot keep borrowing ad infinitum. There are limits to how much governments can borrow, okay? And whether international comparisons are fair, somebody read out, Mr. Gambhir read out numbers of US so much, China so much, Japan so much, Europe so much, India is only 80%, we are safe. We are not safe. International comparisons are misleading. Debt to GDP, I can go into models and all that, but you know, as long as we have a primary deficit, our debt is heavy. But an indicator of that is interest payments are the single largest component of expenditure of the central government and every one of the 29 state governments in the country. They are the single largest item of expenditure. Interest payments are the fastest growing item of expenditure for the central government and every one of the 29 states in the country. And this is a consequence of too much debt. So anybody who says that our debt is within safe limits, I think is wrong, in my view. Debt is a big problem for us. We need to bring the debt down, and we need to do expenditure restructuring. You know, within the limited amount we have, how do we spend more on important things, less on unimportant things? But yes, so fiscal policy has limitations.
Dr. Subbarao, my last question before I throw it open. Oh, sorry, somebody's got a question.
My name is Govind.
Is that the question?
Go ahead. Actually, we can go straight to audience.
Yeah.
All right, all right. Actually, we can then open the floor to questions. I was just going to ask you about your book, actually, Dr. Subbarao. You have a new book out. Is that your reflections on some of your best and sort of toughest challenges?
Yeah, well, a new book out is, I wrote a book, when I wrote my first book, Who Moved My Interest Rate, which is narrating my experiences as the governor of the Reserve Bank of India, that was motivated by a strong sense of purpose, that book. Because I believed, the experiences that I went through, my challenges and dilemmas would have some relevance, hopefully some guidance for future policymakers. And some people, especially young people who read that book, said, "Sir, why don't you write a book about your entire IAS career?" I pushed back against that suggestion because lots of civil servants have written. I've been basically a civil servant since I became a central banker late in life. And civil servant memoirs are a crowded genre. I was not sure I would add value. But during COVID time, I started writing, and that book came out, and it had a mixed reaction. But I did write about some of my experiences. If you give me 2 minutes, I will tell you. People have asked me, which has been your most challenging assignment? People expect me to say, being the governor of the Reserve Bank of India, being finance secretary to Government of India, being finance secretary to the state government. Actually, because lots of students are here, they ask me these questions. Okay, so in my IAS career, I had the responsibility, a job of bottling liquor. In the mid-1980s, I belonged to the Andhra Pradesh cadre. We had a chief minister called NTR. How many of you heard of NTR? He was a movie hero. Yeah, many of you. Fewer of you. Okay, that's okay. And he was not only a teetotaler, he had contempt for drinking. So he wanted to impose total prohibition. Finance department people pushed back saying, "Sir, how can we impose total prohibition? Excise revenue is the largest source of revenue. We can't afford to forego that. If we forego that, we can't implement your other schemes." So NTR knew that this is all nonsense. But anyway, he accepted the suggestion. He said, if I can't impose total prohibition, I'll at least make sure that people don't drink adulterated liquor. We're going to supply government liquor in bottles. And they decided that the government will set up bottling plants in every one of the 23 districts of the state. And for some strange reason, they posted me as officer on special duty for Arrack bottling. That's a very mysterious title. Officer on special duty for Arrack bottling. And you know, IAS toppers, every year they're interviewed. And what do they say why do you want to join the IAS? I want to join the IAS and change the world. Is this the way I'm going to change the world? Bottling liquor? And I go to weddings and I go to parties and say, what are you doing? I'm bottling liquor, okay? And this is a no-end job. This could not be done. Yeah, no way I could do it in 9 months. I thought I was being set up for failure. So I went home, brooded for 3-4 days. The clock was ticking. But then I picked up a team, and then I learned on the way. And in 9 months, we had all the 23 plants fully equipped, fully staffed, fully programmed, 3 days before the deadline. And I learned many lessons. One of the important lessons I learned is that, you know, because they're students, I want to say, when you go to leadership seminars, you read books, what do they tell you? They tell you that the secret to success in life is to discover your passion and pursue it. Forget it. That is not my experience. The secret to success in life is to do whatever you're enjoying to do with passion. Because life does not always give you the opportunity to pursue your passion. So whatever you're enjoying to do, do it with passion.
A huge round of applause, Dr. Subbarao. I'll end it at that. I think there are questions from the audience. I'll hand it over to Dr. Sagar.
Sorry, I interrupted you, but
I have a question.
No, so you have to stay. It's like the RBI press conferences. They never end. Dr. Sagar is going to...
Okay, he's good. Thank you. Thank you, Ira, for that wonderful session. Thank you.
Thank you. This was such an interesting...
Madam, excuse me. A couple of questions. I'm okay, but I don't know about...
Yeah, as a question. Sir, my name is Gopen Gupta, and my question is, in India, we lack mass transportation. Since last 30 years, you can just imagine, in a place like BKC, you're stuck up, you know, like traveling in all traffic.
I'm sorry, I can't hear
What
you.
I'm saying, is it, okay. In India, since last 3 decades, you can just see mass transportation. Even to come to a place like BKC, you are stuck up in traffic. So not much of improvement. My main question is, that just imagine this internet connectivity and we talk of AI and ML. In the age of, data, everything has to be very fast. So in the digital age, we select so behind, even our calls drop, 2G, 4G, you keep 3-4 lines or whatever, so you'll fail with the world, you know. You work 24 hours or like working from anywhere. So, just imagine the telecom industry since last 4 decades. I would like to know the position. So aren't we where we were 4 decades back?
I'm not in the correct age group to answer that question, you know. I moved out of the working age people. So
okay, next question, if anybody has. Please pass on the mic.
Sorry, I didn't mean to undermine your question, but it's just that I cannot think of an appropriate response. I think, I think, digitally, yes, it's important, but we also need, as human beings, we need physical connectivity as well. Yeah.
So your point taken, I mean, we have this debate about how to create international financial centers in India and all this thing, but let's move on with.
Mr. Subbarao, thanks for this, insights that you shared with Ira. Look forward to reading your book as well. You've been RBI governor at a very difficult time at that point of time, and you didn't have an MPC to guide you, but RBI, obviously, internal members were there. My question is, how do you see the role of forward guidance? Forward guidance because the world has become so uncertain. Currently, RBI, I think, is not giving any forward guidance because we don't know after 2-3 months what will happen. And in advanced countries also like ECB and all also has reduced the role of forward guidance. So in your view, going forward, that was a key tool for monetary policy.
Yeah. Forward guidance was a very fashionable idea, in fact, a sexy idea that came up during the GFC. And, it started with Bank of Canada, but everybody thought that giving forward guidance is not just an obligation, but also helps the central bank take on some accountability for the outcomes of their policies. But then central banks found over time, including during my time, that you're tying your hands by giving forward guidance. Because markets want specific forward guidance. Markets want forward guidance in times of pressure. Central banks are least able to give more specific guidance during times of pressure. So there is an asymmetry there, what the markets demand and what the central banks can supply. It's not just the experience of the Reserve Bank of India, it's the experience all around. Like, for example, just to put this in context, the Bank of England said that they will start cutting interest rates when unemployment comes below a certain level, which they said is unlikely to happen before 2015. Actually, unemployment came below that level in 2014. But the Bank of England was not able to act on their forward guidance. But they tied their hands by giving a very specific guidance. So there is that tension there. And it lies to the intelligence of the MPC and the central bank management to give some guidance that is of some value to market participants. Not too much English, as they say, English that is adds value. But, how do you communicate that? Just to give another example, sorry for saying, because examples make things clear. In the Reserve Bank of India, we wanted to say, by this policy action, the rate has moved close to the neutral rate. So we were worried, not worried, we discussed for about 1 hour whether we should say close to the neutral level or closer to neutral level. That's just one letter. Close to neutral level or closer to neutral level. It made an enormous lot of difference. Okay? So central bank is agonized about language, about communication, not only about what they say, but how the market might receive it. And every central banker has had communication follies, including me.
So I can endorse this because on the MPC, my experience was similar. When we were discussing resolution, I mean, each word, it almost one full day goes fighting over these kind of minor languages difference. But, they make a huge difference. I mean, there are clear examples like Mario Draghi's whatever it takes, which saved the euro area. So sometimes the forward guidance works, but there are others like Ivan's rule, which backfired badly for the Fed. So we don't have a prior notion, but I think a state-dependent forward guidance may be much better than time-dependent forward guidance.
If you just let me make one comment on this. One thing they teach in communication is you say something to the other person and say, what have you understood? Okay? Like, what have you understood from what I said? That is communication. A central bank, by definition, cannot do that. It cannot say that I'm going to say this, what have you understood? It cannot go to the markets and say, tomorrow I'm going to say this, what will you infer from this? So that's not possible. So central bank is tied in communicating.
Okay. Can we end, or one last question, please? Because we also
good
people
evening,
are waiting to go back,
given
the transport bottlenecks which have already been discussed here.
Yes, so this question might be a little controversial in nature, but I'm interested to know the impact of freebies on a government's fiscal policy. And the follow-up to that is at where do you draw the boundary between a freebie and necessary or social welfare?
And the first question?
The first question is basically the impact of freebies on
policy.
That's what.
Okay, let me answer the question on freebies which I've got, which is that I have written about it, I've said it, which is that, there is competitive populism, especially at the state level. We saw this in Maharashtra election in this state. We saw this in Delhi election. We are not sure they're paying off anymore because if every party is competing and offering, no party gains, okay? It's a lose-lose situation. I admit that in a country like ours, where 900 million people, as I said, are vulnerable, maybe 200 to 300 million people live at levels which are subsistence level. There is an obligation on the government to give some sort of support, safeguards, but there's got to be limits because these freebies are at the margin being financed by borrowing. And borrowing, by definition, has to pay for itself. A debt has to pay for itself. If you take a student loan, your earning in the future is to pay for it. But states and even the central government are borrowing to finance these freebies. Where's the money going to come from? Okay? If it's all being spent for consumption. So there's got to be a code of conduct, limit on this. The Prime Minister made a statement 3 years ago saying that Revdi culture must go. Within 2 weeks of that, the BJP was the leader in the UP election offering freebies. Okay? So I think every party in the country is guilty, every state government is guilty, the central government is guilty. Nobody is going to ring the bell because everybody, no party, no government is going to say we're going to restrain ourselves. There's got to be a code of conduct, and that's got to be engineered by the central government. I think the finance minister, the prime minister must say that we're going to have a dialogue with the state governments, and we need a code of conduct, just as we've had GST, center-state collaboration, just as we've had FRBM, center-state collaboration. We must have a code of conduct on freebies.
Okay, sorry, one last question because we have to give lady the chance. I mean,
yeah,
so
some lady, please.
Hello?
Where's the girl? I cannot see.
Short question.
Hi.
Please stand
hello,
up.
Sir. So my question is, do you believe that recently there has been a lot of inflow of funds to the stock market, especially so earlier this day there was a discussion on how the bank deposits rate have been falling and investors have been diverting their funds to the stock market. And so do you believe that the stock markets in India are inflated in the sense that a lot of transactions are only happening in the secondary markets, but those funds are not really getting translated into the more productive section of the economy? So otherwise you would not see such a fall in the deposit rates, right? Because if the investment is basically channelizing to more productive side, then the deposits will come to the bank, so which we are not seeing. So do you see this is a problem, and how do we tackle this thing? Yeah.
The question is on whether too much money is flowing into stock markets for quick gains.
Thank you. That's a very good question, but I am not equipped to answer that, because I don't follow markets, etc. But like we discussed during the day and the sessions that I attended in the afternoon, some sort of discipline is important, some sort of information dissemination is important, all this financial literacy, etc., So I cannot give a more specific response to that. Thank you.
Okay, so over to you.
Thank you so much. What a fantastic way to end this eventful day. Truly honored to have you here, sir. I request Dr. Tirthankar Patnaik to felicitate our distinguished speaker.
Such a spicy valedictory address and discussion, some spice from
if during demonetization, somebody gave me something like this, I would have shown what's inside here. But now I'm not going to do that. Thank you very much.
So let me bring it to the close by thanking all of you for having come here. I mean, this has been a wonderful conference, the second annual conference. And I have to particularly thank Tirthankar, Ashiana, and Prasenjit, his team, who really worked very hard for the logistics and making this conference a success, and my colleagues from the IIMK, whom you have seen in various moderations and stuff. A lot of thought went into it. I am so happy that the conference went in a grand, delivered some key issues were discussed. And while final answers may not be there, I think this will set the ball rolling in thinking in trying to solve public policy issues. And that was the objective of the conference. And thank you. You can always reach out to Urupika, the Center for Macroeconomics, Banking and Finance of IIMK, for further issues if anybody has on research and stuff in these areas. We are happy to help. Thank you.